Okay, sir, coming to our financial instruments, the background of this is, see, even though this is viewed as a chapter for our study mat point of view, this is a mixture of three standards. Ind AS 32, whose title is Presentation of Financial Instruments. Ind AS 109, the Recognition and Measurement Principles, is the main accounting standard here. Ind AS 107, not at all important, disclosures relating to financial instruments. Now, broadly, we are going to cover these two, sir, Ind AS 32 and Ind AS 109. Now, between these two, Ind AS 32 is a dry standard. It contains definitions and high core principles of equity and financial liability. But Ind AS 32 will lay down the entire base for accounting of Ind AS 109. Okay, so Ind AS 32, though it's a slightly dry concept, but still from a conceptual point of view and Ind AS 109 point of view, Ind AS 32 is important. Disclosures not much important, sir. As such, I have included in the book, but they are not very important from an examination point of view. Anyway, now coming to the term financial instrument, what it means is, first and foremost thing, financial instrument is a contract. Now, if there has to be a contract, at least how many parties are required? Two parties are required. Now, in these two parties, to one party, the contract, whatever these fellows have entered, a contract is a financial asset to one party, and to the opposite party, it is a financial liability, or it can be his own equity instrument. So a contract which is a financial asset for one party, and to the opposite party, either it is a financial liability or it is a equity instrument. Now, this entire contract is called as financial instrument. Now, when I say we have to learn accounting of financial instrument, means there is nothing called as accounting of financial instrument separately. You have to learn accounting of financial asset, you have to learn accounting of financial liability, you have to learn accounting of equity. So overall we call it as financial instruments accounting. Now, there is no accounting for financial instrument per se. We have accounting for financial asset, financial liability and equity instrument. Now, the person to whom this contract is becoming a financial asset, he is referred as a holder. He is referred as holder of financial asset. And the party, the opposite party to whom this contract is either becoming a financial liability or own equity instrument, he is referred as issuer. So broadly, we are going to learn accounting in two parties books. One is holder books, one is issuer books. For a holder, the contract always is a financial asset. For a issuer, it can be financial liability or it can be equity. Sir, for this fellow only, confusion is there. For him, confusion is not there. Why? He has only one answer, financial asset. He will always say financial asset. But the issuer, whether he will call it as a financial liability or equity, that depends on so many stories there. So Ind AS 32, whatever is there, presentation of financial instruments, in this standard, definitions are there, some accounting principles are there, but 90% of the stuff of Ind AS 32 is only revolving around whether for an issuer entity, a contract is a financial liability or whether it is an equity instrument. Entire Ind AS 32 predominantly will revolve only about this concept, whether it is a financial liability or whether it is equity. Okay, sir, financial liability, so what? Nothing. If it is financial liability accounting you have to do. If you call it as equity accounting you have to do. And a financial liability accounting is not covered under Ind AS 32. For that, you have to go to Ind AS 109. Sir, what if I call it as a financial asset? I am a holder. For you also, accounting is covered under Ind AS 109. So, accounting specifically is covered under another standard. Each particular standard gives you theoretical base, the definitions, and whether it is a equity or financial liability for you. Broadly, only this much. Now, let's come. Sir, a definition that fellow used of financial asset, financial liability in a term, and also equity. Now, they have to define what is financial asset, what is financial liability, what is equity. Now, a financial asset is any asset that is cash. He is outrightly telling that cash is a financial asset for you. That means you are having cash in hand, cash at bank, bank balances. All these are outrightly financial assets. Not only that, an equity instrument of another entity. That means you are X Limited. You invested in equity shares of Infosys Limited. So from your point of view, from X Limited point of view, this is an asset only, no, investment. And where did you invest? In the equity shares of another company. Another company ka equity share, if it is becoming an asset to you, that asset is a financial asset. So first is cash. Second one is equity shares of another company. If you are holding it, that is also a financial asset. Third one, contractual right to receive cash or another financial asset from another company. Now, first look cash he told. Next he told equity share of another company. If it is your asset, that is a financial asset. Now he is telling contractual right to receive. Receive what? The first two. Either cash or any other financial asset. Who is any other financial asset? Equity instrument of another entity. That means if you have a contractual right to receive cash from somebody, a contractual right is also a financial asset. If you have a right to receive shares from somebody, that contractual right to receive shares also is a financial asset. Example, I sold goods to you on credit. You owe me money. Do I have a right to receive money from you under a contract? Yes. Debtor is a financial asset. I gave loan to this sir. I have a right to receive money from them. Now in future after 20 years, it doesn't matter. Do I have a contractual right to receive money? Yes. It's a financial asset. So debtor, contractual right to receive cash. Loan given, loans advanced, contractual right to receive cash. These are all financial assets. Next. Prepaid expenses. Can it be financial asset? Next month ka salary paid off now only. That's an asset, but not a financial asset. Why? I have a contractual right to receive services, not cash. So we should have a contractual right to receive cash. Then it is a financial asset. Any receivable is not a financial asset. Next. Tell me. Reliance Industries issued debentures, redeemable. They issue today, they are redeemable after 5 years. Every year they will pay me some coupon payment. I purchased the debenture. What do you think? Financial asset or no? By purchasing a financial asset called as, by purchasing an asset called as investment in debentures, what right I have? I have a right to demand coupon payments for the next 5 years, and at the end of 5th year I have to right to demand principal payment also. That means I have a contractual right to receive cash. If I have a contractual right to cash, that is a financial asset. Now what if I change the example and tell you that fellow issued debentures, next 5 years he'll pay interest. After 5 years, they won't pay me principal. In place of principal, they will convert that into 10 equity shares of Reliance Industries. That means I have a contractual right to receive cash for 5 years, interest. After that, I have a contractual right to receive equity shares of Reliance Industries. Tell me, equity shares of Reliance Industries is a financial asset or not? Yes, I have a right to receive a financial asset. A right to receive a financial asset is also a financial asset. Therefore, investment in redeemable debentures financial asset. Investment in convertible debentures also is a financial asset. Are you understanding, sir? Third. Coming to fourth one. Contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. What is the meaning of this is? To keep it extremely simple, let's think like this. Sir, you all understand what is a call option? You understand what is a call option? Call option, how many parties are there? Holder, writer. Holder will have right to buy. Writer will have obligation to sell. Now, let us say this fellow is holder of call. In his hand, one call option is there. E call option ka exercise price is 1000. This is, or else right, maturity date 30th April. Today he is standing on 31st March 2025. Already share ka market price is 1400 today. But he can't exercise the option today. He can exercise the option only after 1 month. But looking today, you tell me, sir, is the option looking good or bad from this holder point of view? Call option meaning right to buy. Market price today is how much? 1400. I can't exercise now. I can exercise only after 1 month. But looking at the rate of difference there, next 1 month, sir, 1400 will not become 900, no, sir. It will be around 1400 or it may rise also. So there is high chance of option getting exercised. So things are looking favorable or unfavorable of him? Favorable. or in fact he need not even hold it till next 1 month. No, today also he can square up. You are a holder, that means you are a buyer of option. You can also sell the option today. If you sell the option today also, you will make a gain. That means a particular position is a favorable position to you. If you cancel this contract, if you sell off this option right now also, you will make money. Therefore, this is a financial asset. Favorable positions are financial asset. Now, if this fellow is a holder, another background scenario, there will be writer also. Tell me, sir, இதே position, same thing, is it favorable or unfavorable for the writer? If for the holder it is favorable, for writer also it's favorable. No, it can't be like that. No. So if it is favorable for the holder, it is obviously unfavorable for the writer. So for him this is unfavorable. For this fellow it becomes a financial liability. That means the way at which the market price is looking today, eventually writer has to pay money to the holder if they are going for a cash settlement. Writer is a loser, holder is the winner here. So the holder will call it as a financial asset, the writer will call it as a financial liability. So that is D point. Potentially favorable. Potential means future favorable looking, but it will be settled on a later date. Potential is about future. Next. Financial liability. A financial liability is any liability that is a contractual obligation to deliver cash or other financial asset to another entity. Now, come to C point above. What is C point above? A contractual right to receive cash, a contractual right to receive other financial asset. Here, contractual obligation to deliver cash is a financial liability. Not only that, contractual obligation to deliver any other financial asset also. That is also a financial liability. Example, I purchased goods, I did not pay the money. I took a credit period of 3 months. As on today, do I have an obligation to pay money? Yes. It's a contractual obligation, not any obligation. Every obligation will not become financial liability. Contract is must. So there is a contractual obligation to deliver cash. Definitely financial liability. Creditor is a financial liability. I took bank loan of 100 crores. I'll repay at once over a period, installment, whatever it is. But do I have a contractual obligation to pay or not? So bank loan is a financial liability. I issued debentures, redeemable. Next 5 years, every year I have to pay a coupon of 14% interest. And at the end of 5th year, I have to redeem at par or premium, whatever it is. So for the next 5 years, I have an obligation to pay cash for coupons. At the end of 5th year, I have an obligation to pay principal amount cash also. Contractual obligation to deliver cash. Next. If you remember, while doing Schedule 3, I told you one example of short sale. Short sale, what is happening? Stock lending scheme. I borrow share from somebody. I sold it off. Later, I will again buy and I will repay the share. Correct? What's the first entry we wrote there? I borrowed the share and I sold off. Bank account debit to one financial liability. Why did I call it as financial liability? Is by borrowing share from him and selling off in the market, now I have an obligation to buy that share in the market and deliver it to him. What obligation I have? I have an obligation to deliver a financial asset. Obligation to deliver a financial asset is also a financial liability. That is what that fellow writes there. See there? Contractual obligation to deliver cash, contractual obligation to deliver a financial asset. These two are financial liabilities. Next. D point you read above. What is D point? Potential favorable situations are financial assets. If potentially things are looking bad for you, then you may end up paying money to the opposite party. Same example. Holder ke favorable, writer it will be unfavorable. Holder is calling it as financial asset, writer will call it as a financial liability. That's next one. C point will come and talk after some time, sir. Because that's something called as F2F test. We'll talk about that later on. Next. So financial asset over financial liability over definition. Financial asset lesser, cash is a financial asset. Equity instrument of another entity is a financial asset. Contractual right to receive cash, contractual right to receive any other financial asset is also a financial asset. If potentially favorable situations you are there, contracts are going to end favorably for you, that is also a financial asset. 4 points. Financial liabilities. First one, contractual obligation to deliver cash is a financial liability. Contractual obligation to deliver any other financial asset, financial liability. Potentially unfavorable situation, you end up paying money to somebody, also a financial liability. there is one more point which I postponed. It will talk about that later on. Now coming to equity instrument. Equity instrument official definition is, sir, in a company, all the assets you sell, money will come. With that money, repay all the liabilities. After all the liabilities are over, last whatever is left, that money belongs to somebody. No? That somebody has got a paper in his hand. A paper is called as equity instrument. So equity instrument is that instrument which evidences a interest in the residual net assets after paying all the liabilities. All the assets you sold, all the liabilities you pay, whatever is left or whatever is left belongs to somebody. That somebody is called as equity instrument holder. In a general example, imagine a company under liquidation. If a company is under liquidation, after paying all the liabilities, who will eat that money? Equity shareholders. Why? How did he become equity shareholder? In his hand, what is there? Equity share is there. That equity share is an equity instrument. Equity instrument is equity in a word is a very broad word. In that, one classic example is equity share. It's not like equity share is the only equity item. There are multiple equity items. We'll come to that one by one. Now watch this. The ordinary plain equity share is an equity instrument. You tell me, sir, what is the characteristics of plain equity share? Can an equity shareholder demand a dividend? No. If the company pays, it will pay, but you can't demand dividend. Can equity shareholder surrender their share and demand payment? No. That means an equity shareholder cannot create a obligation on the company to pay certain dividend. He can't create an obligation on the company to repay the amount. That means from a company angle, if you see, company does not have any contractual obligation to deliver cash. If you have contractual obligation to deliver cash, it will become what? Financial liability. Equity instrument should not have a contractual obligation to deliver cash. Important point. Number 2. Moreover, by issue of equity shares, is the company promising any return? Will I say that buy my company share, I will ensure that you will get 25% return every year? Will I promise like that? No. That means equity instruments are the most risky instruments. They are the instruments where the company does not guarantee or underwrite any kind of return. If I promise anything to you, you are not an equity instrument holder. Because, sir, when I make a promise, your reward is limited only to the extent of that promise. Suppose I told you, you gave me 1 lakh rupees. I told you that I will give you 10%. Everybody is giving 10%, sir. Okay, sir. I will give you 15%. Give me money. You gave me money. If 1 lakh I earned 30%. But I will pay you only 15%. How can I call you owner? Owner is somebody who is taking unlimited risk and unlimited return exposure he should have. Somebody who is happy with a meager return, fixed returns, that fellow cannot be called as owner. That's why we don't call it as equity. Equity ka fundamental characteristic is he cannot create an obligation on the company for fixed returns. He can't create an obligation on the company for repayment. He is somebody who is taking unlimited risk and unlimited return ka opportunity. That these three are the characteristics of an equity instrument. Now I will tell you one example. You tell me whether that is an equity instrument or not. A company issued irredeemable preference shares with a discretionary dividend. I issued irredeemable preference. Sir, you can't issue, sir. Shut up, sir. That is example. India lo you can't issue. Foreign standard, no. So, company issued irredeemable preference share. Irredeemable means principal amount I will not repay. Dividend 12% I told, but that's not mandatory. Discretionary. I may pay, but do I have an obligation to pay? Do I have an obligation to repay? No, that means I don't have any obligation. If I don't have any obligation, it can't be called as a financial liability. So automatically it will become a equity instrument. Clear? Another example. I issued compulsory convertible debentures. Compulsory convertible debentures. Interest discretionary. Next 5 years interest. If I want, I will pay, otherwise I will not pay. Name interest. Nature is dividend only. I may pay, may not pay. That's my wish. And the debentures are not repayable. They are convertible into 1 lakh shares. So do I have an obligation to repay debentures? No. I have obligation to issue shares. Is shares my financial asset? Other company ka share is a financial asset for me. My own company ka share, how is it a financial asset for me? That's an equity. Are you understanding, sir? So I issued debenture today, named debenture, but that's not a redeemable debenture. That is a convertible debenture. Interest discretionary. I don't have an obligation to pay interest. I may pay, but I don't have an obligation to pay. Repayment, not there. Sir, then how will you close it? I will convert that into 1 lakh equity shares. Equity shares, sir, you have an obligation to issue equity shares, correct? Obligation to issue equity shares, it's true, but tell me, my own company ka equity shares, the financial asset. That means I don't have an obligation to issue financial asset, no. If I don't have a contractual obligation to issue financial asset, it can't be a financial liability. Therefore, it becomes a equity instrument. Clear? Examples and all I have given here, sir. You can go through it later on. We can again talk. We'll see accounting of all that. Next. Next one, sir. Sir, in the book I have written a little bit about derivatives because some students innocently come off to FR without covering SFM. So for those people, what is derivative? What are the various types of derivatives? Forward, future, option, how it will work? A little basics I wrote there, but apparently it looks like you are not that innocent. Anyway, we'll talk about derivatives more when we do accounting of derivatives, okay? Later on. These are just for small kids, not you. Okay. Sir, derivative general definition is, it's a contract whose gain or loss is dependent on the value of the underlying. So, in a very, very crude sense, if I should put it, derivative is a betting contract, sir. There are two parties. Suppose, sir, you and me both are betting on India-England test match. She says India will win. I also say India will win. What bet can we play? So I should say England will win. Then there is a bet, right? So both the parties cannot win. One party will win, another party will lose. Now whether which fellow will win, which fellow will lose, depends on the outcome of the match. So there is something else which is deciding our gain or loss. These contracts are called as derivative instruments. Now, generally, sir, who can be that underlying? That can be anything, whatever you and me decide. Today it will rain or not. That is one betting. So who is underlying outcome there? Rain. If it comes, one of us will win. Otherwise, another fellow will win. So, but generally speaking, most of the examples, they take equity shares as an underlying asset, interest rate as an underlying asset, index, Nifty Sensex as underlying assets, interest rates are taken as underlying assets, commodities are taken as underlying assets. So, based on various underlying assets, people start betting transaction. Now, for doing a bet, I need not invest anything, no, free only, no, sir. So, most of the betting transaction, initial investment is zero. Whether you will win or not, only time will tell. And your gain or loss is dependent on the price of something else. These three are the characteristics of derivatives. You can see the three conditions. Sir, derivative is a contract whose value depends on the value of the underlying. This is the definition what you study in your AFM. But in FR Ind AS 32-109, this is the definition. These contracts require zero or a very small initial investment. First one. Second one, the value of the contract is derived from the value of the underlying. Number three, such contracts are to be settled on a future date. Three are the essential characteristics of a derivative instrument. Now, I'm sure you must be knowing what is forward, future and option. I'm not going much into that, but whenever it is there at the time we'll talk about that. Now, look at this point. In this entire chapter, sir, when you have a derivative contract in your hand, a derivative can have four fates. Four fates it can have, any one of these four. A derivative can be classified as a financial asset. A derivative may be classified as a financial liability. Derivative may be classified as an own equity instrument, or derivative can be scoped out of the standard. Scoped out means you are a derivative only, but your accounting is not covered under our standard. Get out. Sir, then where is it covered? Nowhere. How to do? We will see that. But overall, if somebody asks you, what is the accounting of derivative? You should not jump to an answer like that. You should first ask, how is the derivative classified? What is the nature of the derivative? If it is financial asset or financial liability, one type of accounting is there. If it is equity, one type of accounting is there. You are scoped out. As accounting is not there in the standard. It's like that. Now, one example we will see here. Come here. Theoretically important, sir, on this practical questions do not exist. Only one big question is there, but that's a theoretical question. Contracts entered on non-financial assets to be executed in future. Now we'll start this with an example. Watch this out. Suppose, guys, A Limited entered into a contract to buy 1 kg of copper at 3 months from B Limited at rupees 600 per kg. Now, a contract is going to be settled at what time? 3 months time, not now. It will take at least 3 months time to settle the contract. Now, you think only from A Limited's point of view. You are A Limited here. What is the rate at which you agreed to buy? 1 kg 600 rupees. Okay, now, at 3 months time, A Limited, B Limited. A Limited will buy the copper 1 kg and he has to pay an amount of 600 rupees. This is how the contract will be closed by way of gross settlement, also called as physical delivery made. Okay, now, first and foremost thing, this particular lines if you study, do you feel that it's a derivative or not? Is it a derivative or not? Is there any initial investment? Is there any initial investment? No. Is the price locked? Is the price locked? When price is locked, and transaction is going to be settled on a future date, definitely one party will suffer a loss. One party will definitely make a gain. How will I know? To wait. Sir, after 3 months, imagine, copper ka price is 700. What's the meaning of this? He is buying copper worth 700 but paying an amount of 600. So he is gaining by how much? He is losing by how much? 100. If it is 500 rupees, he is losing by 100, he will be gaining by 100. Or you understand, sir, depending on the price of the copper, one party will gain, another party will lose. Who will gain, who will lose? When will they know? In future they will know. Time will tell. Today investment is zero. This is a classic example of forward contract. Forward contract, sir, price is identified today. Parties will take either a buy position or a sell position. Who will win, who will lose, the time will tell. Are you understand, sir? This is a forward contract. Pakka 100% derivative. Now, how to do accounting of this derivative is not covered here. That's covered in a standard called as Ind AS 109. Next standard. This standard what is covered is, so the kind of contract, is it within the scope of our financial instruments or not? Only that much is our limited discussion. Now, sir, if I remove the word copper here, okay, and I put Infosys share, now I will not ask you whether this is covered under the standard or not. Why I will not ask you is, what did you agree to buy? Infosys share, and Infosys share is a financial asset. So you are making a contract to buy a financial asset. So obviously it is covered under the standard. I will not get any doubt there. But this particular example is based on what? Copper. And who is copper? Copper is a non-financial asset. So two parties made a contract on a non-financial asset. So underlying asset is not a financial asset. When it is not a financial asset, should I really study this under financial instruments or not? That is the doubt I am getting. If the underlying asset was equity share of any company, why will I get a doubt? But if you put gold, silver, copper, any metals or any soya bean, onion like this, these are not financial assets. So you are playing a betting game on a non-financial asset. Now I get a doubt. Sir, some fellow entered into a contract to buy onion, sir. How is it financial instrument? I am a power generating company. I entered into a contract to buy coal. How is it a financial instrument? A derivative. But how is it financial instrument? The underlying asset is not financial instrument. No. So that's where we get a doubt. The standard asks you one thing. Case 1. A Limited is engaged in copper business and will close the contract by way of physical delivery to meet his own usage purchase requirement. That means we have to see what is the intention of the party or objective of the party when he is entering into the contract. A Limited, why did you enter into this contract? A Limited says, are you mad or what? Copper is my raw material. After 3 months, market price may increase. Safe side, I locked the price now. Okay. Now, after 3 months, market price may be 700, maybe 500. Whether it is 700 or 500, he will anyway buy the copper at what rate now? 600. His goal is not just gain or loss. He wants copper for his own business purposes. So you tell me, does he have a speculative intent or no? He does not have a speculative intent. And contract is settled in net cash settlement, gain or loss of physical delivery. I am not here for doing a betting transaction. I want copper availability after 3 months. So I entered into a contract. So ultimately contract will be closed by delivery of copper. Speculative intent is not there. E kind of transactions are scoped out. The standard says we do not cover your accounting. It is a contract entered today for a future purchase. Sir, what accounting will I do today? Nothing. Sir, then when will I do accounting? When will you buy copper? After 3 months. At the time, right? Purchase account debit to bank directly. Don't do any accounting for the next 3 months. Scoped out. Derivatives are scoped out. No accounting is covered. Case 2. A Limited will close contract by way of net cash settlement. What is the meaning of net cash settlement? Net cash settlement meaning is, if at 3 months market price of copper is rupees 750 per kg, A Limited agreed to buy at what rate? I locked the price at 600. Market price is 750. I am in a gaining position or losing position? Gaining position. 750 item I am able to buy only at 600. I am gaining or not? Gaining. Gaining by how much? 150 rupees. There is no copper delivery and all. Copper is used for betting purposes. I told copper price will rise beyond 600. That fellow told that much scene is not there. Bet up, bet. Ultimately price went to 750. I won, he lost. He will pay me 150. Okay, now here how the contract will be closed is gain to A Limited will be market price is 750. I agreed to buy at 600. 150 rupees is the gain. And therefore A Limited will directly receive an amount of 150 from B Limited. E contract is settled in net cash settlement. Losing party will pay money to the gaining party. Tell me, sir, who is the underlying asset here? Copper A. But settlement is happening in cash. That means, is this fellow interested in copper, cash? He is interested in cash. And cash is a financial asset or not? Yes. Therefore, this contract is covered under this standard. So, this is covered. Understand the logic behind why some things are scoped out, some are not scoped out. First one is scoped out because you are not interested in cash, you are interested in copper. Copper being a non-financial asset, it has got no connection with your financial instrument standard. Out. Here, betting is happening on copper, but settlement will not happen in copper terms. Settlement will happen in cash terms. So, cash is a financial asset. No, so you are covered under the standard. Okay, sir, covered. No, now tell me accounting. Not yet. That is in Ind AS 109. We will cover it. Here only scope. Case 3. A cheating case. A Limited not engaged in business of copper. They have no connection with copper business. Okay, but A Limited will only take physical delivery of copper. Now you tell me, sir, how will you handle this case? First case, he was in copper business. He will take physical delivery. We told scoped out. Second example, he will outrightly do net cash settlement, scoped in. Third one, he is not at all engaged in copper business, but still he will take only physical delivery. What about this? He will take physical delivery only. Then what will he do after taking physical delivery? He will sit on that copper. He will sell it off. That means what, sir? I pay 600 to you. I take copper from you, whose worth is 750. Spotlight will sell it for 750. That means effectively what happened? 600 I paid to you. I will receive an amount of 750. Net my gain is how much? 150. That means it is in substance equal to doing a net cash settlement. Meaning at 3 months, A Limited buys copper at the rate of rupees 600 and sells at market price of, let's say, 750. Therefore, gain is equal to rupees 150 in cash. This is in substance net cash settlement. Therefore, scoped in or scoped out? Scoped in. Scoped in. This is scoped in the standard. It's like somebody wants to escape the standard, sir. That fellow, what he will do, he'll put a physical delivery clause only. Outside he will sell. That is as good as net cash settlement. So you are covered under the standard. You can't cheat the standard. At least not here. Case number 4. If you can't cheat the standard, how will you make money, sir? You should know how to cheat. But here, not possible. Case 4. A Limited has the option to close contract by way of physical delivery or by way of net cash settlement. What will be your answer here? Contract law, both the choices are there. My wish. If I want physical delivery, they'll give me physical delivery. If I want gain or loss, they'll directly give me gain in rupees. Or if I lose, I have to pay in rupees. Yeah. Scoped in, scoped out. How do you know that? See, there is a cash settlement option. That much is there. It's looking like it is covered under the standard. But here, his objective and intention also is important. Suppose, sir, I am engaged in copper business. I really need copper. And my past history, I have never done cash settlements. I always took it on physical delivery basis. Sir, when you always took it on physical delivery basis, why the hell did you keep a cash settlement option here? Listen guys, cash settlement option sometimes may be kept for safety reason. For example, after 3 months I want copper, sir. Some natural calamity happened. That opposite fellow is unable to deliver copper to me. I can't stop my production, no sir. I have to buy the copper outside. So, but outside market the prices have increased. So what I will do, I'll choose net cash settlement. If I choose net cash settlement, what will happen? I will get the gain portion from him. Outside I will buy at a higher price. Overall, more or less it will be like the same contracted price I will be buying up. So for safety reason also I might have kept a net cash settlement. I kept net cash settlement, not that I am interested in doing that. That's why the standard says, when you have a choice like this, examine your settlement mode in your previous transactions and your current intention. If you intend to take only physical delivery to meet your own usage requirement purposes, then you are scoped out. Otherwise, you are covered. Scoped out. So, in case the answer is it depends on your past history of settlement in similar contract and your current intention. That's it. So, this entire thing I have summarized here. Contract settled by way of physical delivery, exempted from Ind AS 109. Contract settled only by way of net cash settlement of gain or loss, or contract entered for the purpose of delivery and selling the commodity in the market immediately for a speculative gain, also a deemed net settlement case only. Here also you are covered under the standard. Last one, option exists to obtain physical delivery or net cash settlement. In this case, you check the current intention and history of past settlements in similar contracts. If it can be established that objective is to obtain physical delivery, though cash settlement was done in insignificant cases. In the past 100 times if I entered into this contract, 95 times I have taken physical delivery. 5 exceptional emergency situations I had to take net cash settlement. That's okay. Broadly, predominantly your objective is to take physical delivery, therefore you are also exempt. Here, it's not about your speculative intent. That's for easy understanding we tell. Actual reason is not that. Actual reason is, am I going to take copper or am I going to take or pay cash? Copper, non-financial asset, scoped out. Cash, financial asset, covered. That is the main part. But instead of telling that, speculative intention is easy to explain. From that angle we explain, but as such the logic is about financial, non-financial part. Next. So, this is whatever you have seen is one example of a derivative which is scoped out of the standard. Then there are derivatives which can be classified as financial asset, financial liability, equity instrument. Now, these two also we have covered. You know where? This fellow. Call option, derivative. One fellow holder, another fellow writer. Compare the exercise price with today's market price. You will understand whether the call option is looking favorable for you or unfavorable for you. If it is looking favorable for the holder, it is a financial asset. So it means it is unfavorable for the writer. For him, it is a financial liability. That means a derivative getting classified as financial asset you have seen, derivative classified as financial liability you have seen. Just now also you have seen derivative scoped out of the standard. One more is there. Who is that? Derivative getting classified as a equity instrument. That also you will see in the following examples next. Next. Sir, a small chart whatever is there now. Contracts to be settled in own equity instruments. That means our company entered into a contract with our opposite party. A contract end result is our company will issue our own shares to the other party, or that other party will the other party will give to us our own shares. Once again I will explain. Sir, I and this sir entered into a contract. After 3 years, I have to give my shares to him. First example. Example number 2. I entered into a contract with this sir where he will deliver my company ka shares to me only after 1 year. In both the cases, what is common? Settlement is happening in our own company ka equity shares. In one case, we had to deliver. In another case, he will deliver my own company ka shares to me only. So in one case, we will give our shares to them. Other case, they will give our shares to us. In two cases of commonality is ultimately contracts are settled in our own equity instruments. Am I clear till here? Now, in this importantly, we have to cover fixed to fixed assets. Most important conceptual. And then compound financial instrument ka meaning we will study here, but accounting again in 109 it is there. Yeah, these are all simple stuff, so there is nothing much in this. Let's start with fixed to fixed asset. Okay, now the first concept we are studying, major concept we are studying in financial instruments is this only, sir, fixed to fixed asset. What this concept says is, where our entity issues fixed number of own equity shares for fixed amount or value of consideration, that contract is classified as equity instrument. So there is a contract our entity has entered, sir. Under this contract, our entity has to issue fixed number of shares for fixed amount or fixed value of consideration. Two things should be fixed. Number of shares to be issued should be fixed. The amount or value of the consideration which the company is going to receive, that also should be fixed. If these two things are fixed, a contract under which this is happening, a contract is classified as a equity instrument. So two things should be fixed. Now, what are the two things? One is number of shares. Next one is value of consideration. These two things. Now, if this is fixed, this is also fixed. We are going and giving a classification of equity. If this is variable, but this is fixed, or this is fixed, the second one is variable, or both are variable. In last three cases, sir, are contracts, even though they are settled in our company ka own equity shares, still they are classified as financial liability. So whether a particular contract is an equity or financial liability depends on whether did you pass the F2F test or not. F2F test means two things should be fixed. Number of shares to be issued should be fixed. The value of consideration what the company is going to receive also should be fixed. If both are fixed, then the contract is classified as a equity instrument. Okay, now if any one of these are variable, then the entire contract will be classified as a financial liability. Okay, now let's see some examples, sir. We'll get a more understanding of this. Now, sir, a company issued debentures today. They raised an amount of 10 lakhs. Okay, these debentures are convertible into 10,000 equity shares at year 3 ending. At the end of year 3, a 10 lakh rupees ka debenture is convertible into 10,000 equity shares. Now, from company's point of view, analyze this. Sir, who will classify equity liability? Issuer or holder? Who will classify equity liability? Issuer. Who is issuer here? A Limited. Company point of view, decision. Not from holder point of view. Holder it doesn't matter, sir. If it is equity also, if it is financial liability also, for the holder it is always a financial asset. We are talking classification means we are talking from issuer point of view, not from holder point of view. Holder does not have much of choice there. Okay. So, A Limited point of view we are discussing. So, ask yourself, number of shares to be issued. How many number of shares we have to issue? 10,000. So, here it is fixed. 1F is satisfied. This time value of consideration. Value of consideration is whatever you have issued for, which is 10 lakh rupees. This is also fixed. So, FTF test is passed. If FTF test is passed, a contract is classified as a equity instrument. Therefore, a debenture contract, whatever is there, is classified as a equity instrument. That's the summary of this. Now, big deals are, anyway you are going to issue equity shares, no? Anyway it is classified as equity. No, sir. Not like that. It will be classified as equity only when FTF test is passed. Moreover, you must understand one thing. In your balance sheet, debentures is forever. Ultimately, it will get converted into equity shares. Today it is debenture. For how many years? 3 years. After that, it will become equity share capital. Correct? Once it becomes equity share capital, anyway equity only. I am not talking about after 3 years what will happen. After 3 years, once you issue real equity shares, stupid ordinary equity shares are anyway equity only. I am not asking after 3 years onwards what will you call it. Next 3 years what you will call it. Name debenture, sole equity. Name lo debt is there, heart is equity. Meaning or implication of this F2F test is like this. Watch this, guys. Suppose at 3 years time, market price of the share and value of 10,000 shares. Tell me, sir, market price of the share is 130. 10,000 shares ka value is how much? Multiply, sir. 10,000 into 130. How much? 130 lakhs. 13 lakhs. From investor's point of view, think. Investor gave to the company how much money? 10 lakhs. How much is he getting now? 13 lakhs. Is he happy or sad? He is reasonably happy only. He invested 10. He is getting shares whose worth is 13 lakhs. So this fellow is reasonably happy. Now, 180. 18 lakhs. Very happy. Now, 10. What is the meaning of this is, when share price is increasing, they are happy. When share price is decreasing, they are sad. Normally when share price increases, who will be happy? Normally, equity shareholder. That fellow will dance. This fellow is also dancing. He is equity shareholder? No. He is a debenture holder. But inside heart is equity. Substance over form. Legally, your name is debenture, but your heart is equity. Like how equity shareholder wants share price to increase, this fellow also wants share price to increase. If share price falls down, equity shareholder will cry, this fellow also will cry, and company is not going to compensate. Because you agreed for fixed number of shares, you took that risk. You took a risk which is equivalent to the risk of a equity shareholder. That's why I'm giving you the status of Your named debenture, but you won't sit under non-current liabilities and all. You'll sit under top category. Equity, non-current liability, current liability. This fellow will sit under equity heading, not under current liabilities, non-current liabilities. You're getting it, sir? That is the implication of this. Now, the first example. Let's take another one. Company issued debentures. Again, same. Raised 10 lakh rupees. Will be converted at year 3 into equity shares worth rupees 16 lakhs. I made a promise that after 3 years, I'll not pay you cash. I'll give you what? Shares only. But how much shares? Shares whose worth is 16 lakh rupees. Now, as on today, from company's point of view, think. What is the value of consideration received? How much did you receive? 10 lakhs. So this is fixed only. Now if I ask you, number of shares to be issued, 16 lakh worth shares I have to issue. So 16 lakhs divided by market price of the share. When market price of the share at the end of 3rd year. If market price is less, I will issue more number of shares. Market price is high, I will issue less number of shares. That means number of shares to be issued is fixed or not fixed? Not fixed, it's variable. So this is variable. Now that this is variable, your F2F test is failed. Therefore, a debenture cannot be called as an equity instrument. A debenture will become financial liability. Debenture will be called as a financial liability. Are you understanding, sir? Now, implication. Implication is more important. Watch this. Now, at year 3, market price of the share. Number of shares to be issued. How many shares I have to issue? 16 lakhs divided by market price. Now, first scenario, sir, market price is, let's say, 400. How many shares I have to issue? 16 lakhs divided by 400, which is equal to how many shares? 4,000 shares. Market price is 100. 16 lakhs divided by 100. How much? 16,000 shares I have to issue. Market price is 10. I have to issue 1,60,000 shares. Market price is 1 rupee. I have to issue 16 lakh shares. Now, how many shares I have to issue, I do not know. But no matter how many shares you issue, this fellow's face of feeling will not change. Why? Sir, company share price dropped to 1 rupee. He'll cry, no. He will anyway get shares worth 16 lakhs. Share price increased to 400. He'll feel happier. No. He'll still get shares worth only 16 lakhs. So from this fellow's point of view, he invested 10 lakhs, he'll get a return worth 16 lakhs. That means the rate of return he is earning, fixed or not. If somebody's return is fixed, that means company is fixing return for him. Somebody who accepts a fixed rate of return, how can he become a owner of the company? Forget legality. In form point of view, owner is somebody who eats last. Whatever is left should belong to him. But this fellow will take only 16 lakhs. Not a rupee more, not a rupee less. So his returns are fixed. Once an instrument return is fixed, it cannot be called as a equity instrument. So that's why they put this F2F test. F2F test passing ka meaning is risk and rewards are assumed by the other party. F2F test failed means risk and rewards are not assumed by the other party. If the other party is not assuming risk and rewards, why will I call you as a owner? You are happy with a fixed return, no, you are outsider. That's why they call it as financial liability. Are you understanding the logic behind it, sir? So this is the background of FTF test. Now, watch this example. Now, what standard says is, okay, let me put an example. Suppose, sir, I have to pay her 2,000 rupees. In my pocket, 100 rupee notes are there. How many notes I have to give her? 20. I have 500 rupee notes. 4. I have 2,000 rupees note. 1, I have 10 rupee note. 200. That means, irrespective of the number of notes I am giving, the worth I am paying is same only, no? Correct? What the standard says is, you are issuing shares as if it is a currency. And how many currency notes you have to give depends on the value of the currency note. So you are using shares like money. Even though you are issuing shares, it is as good as you are paying fixed amount of cash to him. Giving variable number of shares is equivalent to paying fixed amount of cash. Obligation to issue variable number of shares is obligation to pay cash. Obligation to pay cash is a financial liability. That's how the standard links it. So financial liability definition ki F to F test failure case ki link is there. Are you understanding, sir? Now, if I should show you one small point which I omitted earlier, come here. Financial liability is any liability that is, read C point, a contract to issue variable number of shares or fixed number of shares for a variable consideration. What is that? FTF test ka failure will become a financial liability. Are you understanding, sir? Definitions, if you first want to read completely and then go into the standard, it won't happen. You have to first walk, then automatically clarity comes. Okay, one last example, sir, then we'll move further from FTF test. Okay, answer this case. Okay. Sir, I am A Limited. You will think only for A Limited, sir. This follows a reporting entity. Okay, A Limited. At a distance, there is one B Limited company. These four fellows hold 100% shares in B Limited. They are shareholders of B Limited. Now, A Limited entered into a contract with that shareholders. What contract? At 6 months' time, they will give us all 100% shares. Some number, let's say 10,000 shares. At 10,000 shares in B Limited, they will give us. And in return, at 6 months, we will give them 13,000 shares in our company, issued by A Limited. A contract is entered today, but will be executed after 6 months. As on today, A Limited, how will they classify this contract? Equity or financial liability? One is consideration, you have to check. Next, you have to check the number of shares to be issued. You have to evaluate this from A Limited's point of view, sir. Okay, tell me. Number of shares to be issued is how much? This is fixed. What is consideration? Consideration is what here? Why am I issuing 13,000 shares? Simply, no. We will receive 10,000 shares in B Limited. So consideration is 10,000 shares in B Limited. At 6 months' time, we will receive this. You tell me, is that fixed or variable? Is it fixed or variable? Good. This is variable. How is it variable? Sir, after 6 months, what is the worth of each share in B Limited? How will I know today? It can be high also, it can be low also. Sir, what is fixed there? Trap, number is fixed. Number should not be fixed. Consideration ki value should be fixed. Shares ki number should be fixed. Point very important. Look at this. Normally, F2F is not something should be fixed. Shares ki number, consideration ki value. Here, shares ki fixed number, consideration also number fixed. That is irrelevant for me. Consideration also value should be fixed. So here consideration is a variable consideration. Gone. It is a financial liability. Are you understanding, sir? F2F test clearly. One last example. I told this one last. I lied. Okay. Now, X Limited writes a call option on its own 1,000 equity shares towards A Limited at an exercise price of 600 rupees. Maturity 3 months. Premium collected today rupees 50 per share. Yeah, you will think from X Limited's point of view. Sir, call option holder will have call option holder will have right to buy. So call option writer will have obligation to sell. Who is writer here? X Limited. Who is underlying asset? Our own shares. That means I have an obligation to sell my own share. Selling my own share is what, sir? Issuing share. Instead of saying issuing shares, I'm doing overaction like I'm selling my own share to you. That's as good as issuing share only. Okay. Now tell me, sir, from X Limited point of view, number of shares to be issued, is it fixed or not? How many shares? 1000 shares. Value of consideration, how much will I get? Rupees 600 per share. That means this is fixed. This is also fixed. F2F test is passed. Therefore, a call option, whatever X Limited has written, a call option is an equity instrument. F2F test passed. There you see one example of a derivative getting classified as a equity instrument. Copper example derivative, scoped out. We have seen that. Call option, same call option, sir. If it is not on own shares, if it is on Infosys company share, then X Limited and A Limited are playing betting game on Infosys share. One fellow will have a favorable position, one fellow definitely will have a unfavorable position. Favorable position ki financial asset, unfavorable position financial liability. So derivative getting classified as financial asset, financial liability, scoped out. Now you see in this example getting classified as an equity instrument. Derivative all four phases you have seen. Understood? Now come here. In the first scenario, sir, first example, where F2F test was passed, debentures case. Sir, after 3 years from my balance sheet, the debenture will be removed. A place to who will come? Second case, where F2F test is failed, E-case law also, after 3 years, a debenture will be eliminated. A place to who will come? Here, after 6 months, when I issue these shares, in my balance sheet, what will come? Share capital. Here also, if this call option gets exercised in future, ultimately in my balance sheet, what will be there? Once a share is issued, as anyway equity item. I am not talking about what will happen after the issue of share. I am talking as on today, a contract is what? Sir, what nonsense? Why do you want to know that? Why do I want to know that? Come here. I entered into this contract, you paid me 50. I received 50. Now, if 50 ka treatment depends on whether this contract is an equity or a liability. If you tell me financial liability, I have one type of accounting weighting. If you tell me it is equity, there is altogether a different type of accounting weighting. So your accounting is dependent on your classification. After 3 years, stupid, everything will become equity shares only. After 3 years, who is asking? I am asking next 3 years of what accounting I should do. That is dependent on today's classification. That's how Ind AS 32 assumes lot of importance before you do Ind AS 109. Are you understanding, sir? Contract nature is important. Without knowing the nature, how will I account it? Okay, so that's the background of FTF test. Now, next concept is, I understood. Sir. Compound financial instrument. It's important, sir. Compound financial instrument. Now, these are instruments where CFI, instruments where which has the nature of equity, which also has the nature of financial liability. Equity ka nature is there, financial liability ka nature is. Both are there in a single instrument. This kind of instruments are called as compound financial instruments. Now, the accounting of CFI is extremely important from an examination angle. That again is covered in Ind AS 109. Now, we are just introducing to what is the meaning of CFI. That's it. Okay, now, debentures redeemable at 5 years, but interest is discretionary. If you observe the nature of this instrument, after 5 years definitely have to repay. So I have a contractual obligation to deliver cash. So principal portion we have a obligation to pay. Therefore this is a financial liability. And as regarding the every year interest, just like equity shares ka dividend, this is also discretionary. So we don't have a obligation to pay. Since you do not have an obligation to pay, E portion is looking like what? Equity. Overall, we call this as a compound financial instrument. That is one example of this. Now, I'll tell you another example. You will explain that. Irredeemable preference shares with mandatory dividend. Irredeemable preference share with mandatory dividend. Yeah, principal is not repayable at all. Therefore, that is sounding like what? Equity. Dividend, name a dividend, but every year compulsorily I have to pay. Contractual obligation to deliver cash. Therefore, it is a financial liability. So, I have a equity also, financial liability also in the same instrument. Overall, it is called as a compound financial instrument. Clear? Two examples. What if it is a irredeemable preference share with discretionary dividend? That is pure equity instrument. That's not a CFI. That is not a CFI. Why? There is no obligation to pay cash anywhere, nowhere. Okay. Now, last example. This one you have to think a little bit. Sir, this is redeemable, or else wait to write. Here it is there. My hands also I should say. Redeemable or convertible debentures with mandatory interest. No, half issue is solved there only. Interest is mandatory. Interest portion, definitely there is a financial liability. Now, what is pending is either it will be converted. Of course, when I say converted into fixed number of shares only, or redeemable at the option of the holder. That is one case. At the option of the issuer entity, another case. Case 1, case 2. In both the cases, interest is mandatory. But in case 1, whether he wants cash, he wants shares, the holder will decide. Depending on what you ask, I have to comply. What is the meaning of option with the holder? If the holder at the end of 5 years, if he asks cash, we have to pay cash. If he asks shares, we have to give shares. Tell me, sir, how will you classify? Equity or financial liability? Why financial liability? Simple. Sir, I do not know what he will do after 5 years. But if he asks cash, can I say no? No, I can't say. I have to pay. Whether I will pay, he will ask, all that is different. Do I have an obligation to pay? Contractual. Yes. Therefore, it becomes a financial liability. So, here you have to remember that the principal amount is a financial liability. What is irrelevant is, sir, I believe that they will take only shares. That is irrelevant. You are not supposed to estimate what the other fellow is likely to do. If he asks cash, you can't say no, sir. That is a contractual obligation to pay cash. Definitely the principal amount is treated as a financial liability. Come to the other case. Option is with the issuer entity. What is the meaning of this? Whether I will pay cash, where I'll issue equity shares, that is my wish. Suppose you are all the investors. After 5 years you came to me, sir, we want cash. I told, get lost, I'll give shares only. Can you do anything with that? No. Can you create an obligation on me to pay cash to you? No. So company does not have a obligation, contractual obligation to deliver cash. There is no financial liability. Sir, company badly wants to pay shares only, sorry. Cash only, sir. They don't want to issue equity shares. They don't want to dilute their voting power and all. 100%. Pakka cash only they will pay. What will I do? No. Intention to pay cash. Obligation to pay cash. Same or different? For a fact, I know that I will pay cash only. But still, is that called as obligation to pay cash? Or expectation to pay cash? Expectation and obligation are not one and the same. Obligation means you should not be in a position to say no if somebody asks cash. If I am only saying yes, that does not mean that I have an obligation. Okay, so when you do have an obligation, then financial liability. Voluntarily, if you are paying, that's not called as obligation. Okay, so irrespective of your intention is irrelevant here. Contractual obligation, do you have an obligation or no? I don't have. Therefore, the principal amount is classified as a equity. Till here, any doubt? I have a doubt. You told mandatory interest. Therefore, E portion is ఈ సెకండ్ సినారియోలో సార్ ఇంట్రెస్ట్ ఫినాన్షియల్ లయబిలిటీ, ప్రిన్సిపల్ का repayment is equity, interest का repayment is financial liability. So overall का this is a compound financial instrument. Very happy. Come here. Interest mandatory, financial liability. Principal mandatory, or principal is also a financial liability. Overall it should be. But what are we studying? Compound financial instrument. Now you observe closely here. Always things are not so simple as they appear. Interest ka obligation is there, financial liability. I do not know whether that fellow will ask cash or shares. I do not know. But if he asks cash, we have an obligation to pay cash. Therefore, principal also is a financial liability. But overall, it is a compound financial instrument. It won't be a overall financial liability. It is still a compound financial instrument. Now, how is that? E point. You have to listen, sir. It's important for us. Because this has got something to do with the accounting of CFI later on. Okay, watch this. Now guys, Reliance Industries is there. This fellow issues redeemable debentures at par. My question is, if he is this fellow is issuing debentures, this fellow is buying, no sir, this fellow is the investor. Now, they are issuing at par. How much interest rate they are offering is, let's say, the coupon rate is equal to 14%. That means, on every 100 rupees value you give me, I will pay you 14 rupees interest. Who is committing that? RIL is committing. Investor, why is he buying this? Is in his mind, no sir, he is thinking like this. A Reliance company is a risky company. Of course, government ka friend only, but not government, no. So, risk is there. Business ka risk will be there, no sir. If tomorrow RIL is caught under some fraud, do you think BJP government will go and say our friends only? No sir. Let them sing, let them die. I don't care. I don't know who you are. You simply took a selfie on that. So, this fellow mindless, some RR is there. RR is required return. 14%. He calculates all the risk. He reads the credit rating of RIL. Okay, for a company risk, I want a return of 14%. Surprise, coupon rate is also 14%. Feelings matched. So this fellow bought the bond. Case 1. Case 2. Issues convertible debentures at par. Coupon rate 12.5%. This fellow, sir, purchased this bond also. Now, if you observe closely, in his mind, how much return is there? But his second bond is offering a coupon of only 12.5. But that bond is compulsory convertible into equity shares. They won't pay principal amount there, compulsory convertible into equity shares. You know, whatever it is, on his investment, he wants how much return? 14. But the bond is giving a coupon of 12.5. Ideally, he should not buy the bond. Bugger bought. Why? Why? What his feeling is, there is no option, compulsory convertible bond. Compulsory convertible bond. You know why they will buy like that? He feels that I want 14. Anyway, they are paying how much? 12.5. So I am losing how much every year? 1.5. 1.5, 1. Like that for 5 years I lose. Whatever amount I lost in the form of lower coupons, that I will recoup it in the form of higher equity shares value. If the par value of the investment is 1 lakh, if you go with first option, you will get 1 lakh only after the end of 5 years. But here you are getting 10,000 shares. This fellow believes that, greedy fellow, after 5 years, 10,000 shares ka worth will be higher than the 1 lakh rupees and it will cover all my losses in the initial years. And I'll get even more also. With that feeling, he tempts and he accepts a lower rate of interest. Last one. Issues redeemable or convertible debentures at option of holder. Coupon rate 10%. In his mind, how much return is there? Stupid will still go and buy this third bond, even though they are giving a coupon of only 10%. Why? he has a choice now. What choice? If he wants cash, he can take cash. If the company's share price is crazily increased in next 5 years, he will go and select a conversion option. But at the safe side, he has the option to take cash also. Company does not perform well, he'll take cash, maturity value, and he'll get out. Now, life loss or options are not free. You want a choice, you have to pay. Now, when I passed my 10th standard, I told my father I want to join CA. My father said, you are very fickle-minded. After joining MEC, if you don't like it, you don't have much of options left. So, nobody trusted me to clear CA. So, what they did, they forcibly made me join MPC. So, I studied physics, chemistry, writing this IIT exams and all. My plan is, even if I don't like MPC, I can still join CA later on. But if I like MPC, I can pursue that. Easy settlement. So that was giving me an option. But I have to put extra effort. Obviously MPC is difficult than MEC. If you know, you know. So that was a choice which I made to put extra work. But because of that I had options. Post MPC, CA also is open for me. Engineering is also open for me. I have choice. People who went for MEC, they don't have a choice. Everybody wants to settle high. So for an MEC point of view, either you should crack a big B school MBA or CA. So you don't have much of choices. Now I have all the choices left. But for that I have to pay extra work. Choice, not free. Option holder, he has a choice. Free, premium. Like that. A holder wants a choice. He has to pay premium. Sir, where is premium? Accepting lower interest rate is the premium indirectly what he is paying. Okay, now focus on the last one, you will understand it better. Market expectation is how much? Now, did this company RIL show or display their equity share from a distance and reduce their interest burden? Did I reduce my interest burden by displaying my equity share from a distance? See, you will get this. Yes, sir. Did I play that game or not? That means our company used our own equity share and avoided a payment. That is how an equity element comes into picture. Option of the holder. The financial liability I will treat the principal amount. Interest anyway financial liability. But overall classification is CFI. Why CFI is whatever 10% you are paying interest compulsorily every year, that is lesser 10%. You should have paid actually how much? So you avoided how much? You ideally should have an obligation to pay 14, but you are actually paying only 10. You avoided 4%, displaying your equity share. That's all. That's how equity element comes into the picture. That's how this entire thing becomes a CFI. Later on when we do CFI questions, you observe every question invariably a market interest rate and coupon rate will be less, market interest rate will be high. Why like that? Means this is a logic for that. Clear? Okay guys, so that is the story of convertible or redeemable debentures. Okay guys, come here. Now last, after convertible or redeemable debentures, we have to see accounting of buyback. As such, accounting of buyback, only one line is there in the standard. What it says is, when a company buys back its own equity instruments, any gain or loss in the transaction will be adjusted directly in equity itself. I mean to say, so for example, your company has equity share capital, face value is 10. Market price is, let's say, 80. If you offer buyback at 80 rupees, nobody will surrender to you. So you put buyback price as 95. So ultimately it so happened that 10 rupees face value ka share, our company is buying from the existing shareholders at 95. How much extra are we paying? 85 rupees extra we are paying. That's a kind of loss to the company. So the entry what you will pass is equity share capital account debit 10, to bank 95. So this extra payment whatever you are making, normally losses and gains should go to P&L account or PRL section, to be honest. But this is an extra consideration paid to whom? To the equity shareholder. Who is equity shareholder? He is the owner of the company. If the owner takes his money, how can you call it as a loss or an expense? Therefore, this cannot go to PRL. this has to be adjusted only in other equity. Other equity means reserves and surplus. So you will debit this to your securities premium or retained earnings or general reserve. Stay in the balance sheet. Don't call it as a gain or loss. Now you tell me, sir, from your basic level understanding, when in a partnership firm, partner makes drawings. What is the treatment of drawings? You will adjust it from capital. You will reduce it from capital. Will you post it in P&L account? No. Why? He is taking his money. How is it an expense to the business? It's not an expense to the business. He introduced capital. He is withdrawing capital. Like that, equity share capital, reserves, all these are monies belonging to the equity shareholder. They invested money. If they want to take money, they are taking money. You cannot debit this as a loss to your PRL. So all equity related transactions, sir, any gain or loss cannot go to PRL. It has to be adjusted directly in the balance sheet only within the meaning of other equity. The securities premium or retained earnings or capital reserve or sum must to be true, that's your wish. Okay. Now, in our basic level, when we study buyback of shares chapter, we used to write accounting entries like share bought back account debit to bank. Later on a share bought back account we used to kill. We used to debit equity share capital and premium. A premium again we used to kill. First priority, second there's a rule. No? The entire substance, the summary of that entire accounting is this. You will debit your equity share capital, there will be a cash outflow, a difference is extra consideration paid. Since you are paying to the owner extra consideration if you pay, you should not call it as a loss, it is his money. So you will adjust it against his money only. His money is what? Equity. Equity will have two heads. Equity share capital, other equity. First one is equity share capital, second line is other equity. So don't bring anything to PRL. That's the whole part of it. So it's about buyback. D point is not important, sir. Leave it for now. Coming to treasury shares. Now, what is the meaning of treasury shares? Is though in India it is not permitted, outside India it is quite prevalent. What is this is? Suppose, sir, your company is having surplus money. Nobody would like to have idle money in their hand. So they want to invest somewhere. This fellow thought, after a lot of research, I found that my company is best company. So this fellow decided to buy his own company shares and hold it as an investment. Later on, when the price increases, they will sell and make a profit. In India, why it is not permitted? It's almost amounting to insider trading. Your company MD, sir, you know what the company is going to do and all. If I allow you to buy your own shares and trade it, it's like you're cheating public, no. With your insider confidential information, in India, it's not permitted. Some countries, it is permitted. So, when you buy your own shares, let's say you bought the shares for 1,000 rupees. Normally, if it is some other company, we'll write it as investment in TCS company. No, I am A Limited, I purchased A Limited share only. Equity share of another company is a financial asset. Our own company equity share, if you go and buy, that is not a financial asset. Because financial asset definition of what did they say? Equity instrument of another entity is a financial asset, not our own entity. So you can't call this as a financial asset. So then what should I do? The standard law much guidance is not directly given. What they say is adjusted only to equity. So equity account debit to bank. Later on, after 2-3 months, you sold off. Let's say you sold it off for 1,400. Bank account debit to equity 1,400. What is the difference? 400. Where is that 400 lying? Equity. So gain or loss on trading of your own equity instruments, that gain naturally got accounted in equity head itself. Sir, what is equity debit to bank, sir? See, this is what the standard told. But when you actually read the journal entries, it will be recorded like this. Equity share capital account debit. Let's say you are paying extra retained earnings account debit to bank. You are paying 1,000. Face value of equity share capital is 100. Extra consideration paid is 900. Later on, when you sell this, bank account debit 1,400. Now that equity shares are held with outsiders, again you can recreate your equity share capital. Extra amount, whatever is coming, adjusted to retained earnings. Now, if you observe, originally retained earnings was debited with 900. Now retained earnings is credited with 1,300. So retained earnings is effectively increased by an amount of 400. 400 is nothing but your profit. You purchased at 1,000, you sold at 1,400. 400 rupees profit. Sir, profit should go to P&L. No, sir, profit should go to P&L when it is a transaction with outsider. Shares from whom did you buy? Your own shareholders. To whom did you sell? Your own shareholders. A transaction with equity participants. Transaction with own equity people will never go into PRL. So again the same buyback wala rule only here. Okay. So that is one small concept here. Next. very important. Transaction cost. Transaction cost means they are incremental costs that are incurred in relation to acquisition, issue or disposal of financial asset, financial liability or equity instrument. See, financial instrument, three parts: financial asset, financial liability, equity. In relation to issue of this or in relation to redemption of this, if you incur any expenses which are directly related, they are called as transaction cost. An easy example: you are issuing equity shares. Safe side, you appointed an underwriter. Underwriter ka car will not work without petrol. No, he also wants money. No, so I pay underwriting commission. So from my point of view, accounting entry to bank, debit where? Underwriting commission. If you debit, where will you transfer underwriting commission again? You will write underwriting commission to bank. Next, underwriting commission will go where? Normally, every expenditure should go to P&L account, but this is an expenditure incurred in connection with raising of money through equity shares. Who is equity shares? Own equity instrument. Own equity instrument related cost also must be adjusted in equity itself. You can't take it to PRL. Meaning, like you said, you will use something like securities premium, general reserve, retained earnings, but you will ensure that this underwriting commission will not travel to PRL. So if somebody asks you what's the treatment of underwriting commission, you should ask back in context to what did you incur this cost. If it is an underwriting commission related to issue of equity shares, it cannot go to PRL. It has to be adjusted into your reserves only. As securities premium, general reserve or retained earnings, so that's a different thing. But it cannot go to PRL. So this is the first point, sir. Transaction cost in relation to issue of equity instruments. Cost incurred are directly adjusted into equity itself. The standard will not tell you account name. As securities premium, general reserve or retained earnings, so that is your choice. Okay, given a chance, everybody would like to wipe off securities premium first. That is restricted reserve. You can't issue dividends out of it. But remaining general reserve and all, you can declare dividends to the shareholders and take cash out of the balance sheet. So given a chance, we'll first try to exhaust what? Securities premium. So the choices are there with you, but you can't debit your PRL with that. Next. Sir, what about transaction costs that are incurred in relation to financial assets and financial liability? That will again cover in Ind AS 109. That's not addressed in Ind AS 32. So the standards have split certain accounting here and certain accounting there. 99% accounting will happen only in 109. 1-2% limited accounting is there in Ind AS 32. This is that. Next. Sir, our company issued equity shares. After issue of equity shares, these shares we have listed on a stock exchange. Now that I have listed my shares on stock exchange, I have to pay listing fees. Listing fees I have to pay. No? Our listing fees, what is the treatment of that? Related to own equity shares only. Is it related to issue of equity shares or creating a secondary market? Listing shares purpose is what, sir? Not to raise money. It is to create a second hand market. Existing first one investor purchase share from the company. He does not want it. He want to offload it. He want a second hand market. For that I created a secondary market by listing my shares on a recognized stock exchange. This is not a cost incurred in relation to issue of shares. Therefore, this has to go to PR. As related to own equity shares, but that cannot be called as a transaction cost. Transaction cost means incremental cost incurred in relation to raising money. This is not that. This is secondary market, the listing fees. This will go to PRL only. Careful. Next. In enter both the standards, 32109 put together, on own equity instruments, this is the only accounting you will find, nothing else. For financial assets, big accounting is there. For financial liabilities, lot of accounting is there. But for equity, only one line. Read that. Any contract or instrument, if classified as equity, it will be measured only at its initial value and there would be no subsequent remeasurement. Once you record your own equity at some number, subsequently lifelong you will never fair value it. No fair valuation is allowed for own equity items. Now visualize this, sir. In a balance sheet, asset side revaluations are possible. The financial assets anyway fair valuation is there. Later on we will study. But other than financial assets also, if you take PP, intangible assets and all, for that also fair valuations are permitted by respective standards. Similarly for liabilities also, if you want, you can do fair valuation according to the standard, which I will show you later on. So assets can be measured at fair value, liabilities can be measured at fair value. Other than these two, balance sheet one more hero is there, equity heading. Don't touch any of that with their own fair value. I mean to say, suppose today issued shares at par value, 100 rupees. After 1 year, my company ka share price is 140. Sir, last year I issued only for 100, no, equity share capital I recorded 100 only, now market price is 140, a 40 rupees I'll book a gain and increase the equity share capital to 140, not allowed. Why not allowed? You cannot fair value your own equity item. You can fair value assets and liabilities, but not your own equity. Other company equity, if you purchase it and hold it as an asset, that you fair value, don't have a problem. Sir, you are having Infosys shares as investment, fair value it. But Infosys company cannot fair value their own equity shares. If they are having investment in TCS, they can fair value. They cannot fair value their own equity. Why do you think it is like that? Who wants all that, sir? Rule is rule. Tell me, why do you think it is like that? Why can't you fair value your own equity? What could be the reason for that? Simple. Last year share price is 100, today's share price is 140. You tell me why share price increased from 100 to 140. Logical reason. Don't tell me Rahul Gandhi became PM. Normal. Correct reason. Company earned profit very well. That's the reason share price met have increased. If company has earned profit very well, a profit is there where? P&L account. From P&L account it flow to balance sheet. Where is it sitting? Under other equity it is already there. No. Why should I again update my equity share capital with that? Correct, no sir. If your company has made extraordinary profit, a profit is already accounted, no. A profit is sitting under equity head only, no. With the name of other equity, retained and inside is there. Why should you fair value again your equity? The reason for your increase in share price is already accounted with you. That's why you should not touch it. Suppose you give me another reason. No sir, my assets value has increased. That's why my share price has increased. Is it so? In that case, go and fair value your assets. Who is stopping you? Revaluation models are there in PPE standard, intangible assets standard, all financial assets. If you want, you can measure it FVTPL. Do that. But don't touch your own equity. Because the reason for change in your equity value is already accounted, or it can be accounted if you want to do so. And no sir, we won a project. Cash flows will come in future. So today's share price has increased. So when that cash flow comes in future, your company will make profit. The profits automatically will be accounted in your books. So whatever reason you tell me, that reason is either already accounted or will be accounted in future. That's the reason own equity should not be fair value. It's a very important principle. Next, coming to interest and dividends. Treatment. Sir, on financial assets, interest and dividend is an income that will be accounted in your PRL. Sir, this is the language of the standard. PRL, not P&L. PRL section, first part. Interest and dividend on financial liability, that's an expense in PRL. Interest and dividend on own equity instruments. Sir, tell me what is the entry for dividend declared on equity shares? You declared dividend on your own equity shares. Tell me entry. Bank account debit. Okay, fine. Retained earnings account debit to dividend payable account debit to bank. What is the effective entry? Retained earnings account debit to bank. So what is the entry you learnt unknowingly? Retained earnings we are debiting, cash outflow bank we are crediting. Because you are giving money to your own owners, how can you call it as an expenditure? They are taking their money, why? So you have to debit it to their reserves, not to P&L account or something. So the entry would be directly adjusted to equity. Retained earnings, general reserve, anything is fine. You directly adjust into equity. Last part. Correctly understand. I issued a debenture, mandatorily redeemable financial liability, but interest is discretionary. Mandatorily redeemable debenture, pakka have to repay the principal, but interest is discretionary. How is compound financial instrument? In a particular year, I paid this interest voluntarily, discretionarily. I declared, I paid. Since I paid to bank, I paid to whom? Debenture holders I paid. Am I having obligation to pay? No, but I still paid. Where should I debit it? Is it obligation to pay which is satisfied or discretionary payment? Discretionary payment. A similar discretionary payment is what? Dividend on equity shares. Dividend on equity shares, what did you do? You debited to retained earnings. This also debited to retained earnings. You might have paid it to debenture holder only, but it is not an obligated payment. It is a discretionary payment. It cannot go to PRL. It has to be adjusted to retained earnings reserves, so you will have to adjust this. Am I clear here? Now, there are a couple of star marks here if you see closely. The financial assets ka interest income, dividend income normally will go to PRL. Similarly, financial liabilities ka interest and dividend expense normally will go to PRL. But if any Ind AS requires otherwise, you will follow any other Ind AS. Example, you took a loan. On that loan you are paying interest, but that loan is used for construction of a qualifying asset. Borrowing cost capitalization. There is a standard, no? What does it say? interest on that loan should be capitalized to the cost of the asset. It should not be transferred to PRL. There is a specific standard that says the rate don't come to PRL, directly go and add it to the asset cost. In that case, you will ignore the standard and apply Ind AS 23. Similarly, you borrowed 100 lakhs at the rate of 10% for construction of a qualifying asset. It's not like entire 100 lakhs you will spread in the project on the first day, no. You use some 30 lakhs. Remaining 70 lakhs you parked in some temporary investment. A investment gave you income. So that's an income earned on investment. According to the standard, that should go where? PRL. But what Ind AS 23 says is, when you are having a specific borrowing, a specific borrowed funds are temporarily invested somewhere, and that investment is giving you certain income. What you have to do is compute the total borrowing cost. From that minus that income, net borrowing cost only should be capitalized to the cost of the asset. That means indirectly what is happening? The interest income also is getting reduced from the cost of the asset itself. That means I am not taking it to PRL. So that kind of any exception is there, that exception will prevail. Otherwise, general rule is all these things will come to only PRL. So that's what the standard says. Next. Offsetting a financial asset and a financial liability. This question came in before last attempt exam. Offsetting a financial asset and a financial liability. Now, to start with basic example, now watch this, sir. Our company name is A Limited. We have a debtor 3,000 or 300 rupees receivable from a company called B Limited. In some other transaction, I owe money to B Limited of 100. So I have to receive from them 300, I have to pay to them 100. Parties are same only, A and B ka transaction. Do you all agree? No, this is a financial asset. This is a financial liability. He is asking, can I show net debtor? Net debtor ka meaning is, this is presented as a reduction here, 100, and net I will show 200. Can I do like that? Parties are same. The standard says you can do offset presentation purposes, offsetting is permitted, but two conditions have to be satisfied. Two conditions. Number one, you should have a intention to do settlement on net basis. Intention to do settlement on net basis means what? In future, instead of I collecting 300 and instead of I paying 100 separately, I should be able to receive only net 200 rupees. Our intention we both should have, number one. Number two, it should be legally permissible also. That means your intention is there, but legally restriction also should not be there for that. If these 2 points are satisfied, net presentation is allowed. Otherwise, it is not allowed. Now, normally, sir, when you see this kind of example, since parties are same, if they both want to do net settlement, legally there won't be any restriction directly, usually. But just because parties are same, does not necessarily mean that they will do a net cash or net settlement. Why? Imagine, sir, I am A Limited, you are B Limited. My debtor amount is due tomorrow morning. You have to come and pay me 300. But I owe you 100 after 3 months. Tomorrow morning, if you come and give me 200, I will accept. Huh? No. I owe you 100, but 100 ka due date is different. 300 rupees ka due date is tomorrow morning. Tomorrow morning, if you come and offer me 200, I will not accept. Legally permitted, but I will do net settlement. No, I won't do. When anyway you are not going to do net settlement, why to present it on a net basis? Show them separate. That's the logic behind that. Intention is important. Second thing, even this. I took a loan from ICICI Bank. I owe them 300 crores. I had some surplus money. I invested in ICICI bonds only. What is loan? Payable to ICICI. What is bond investment? Receivable from ICICI. Now, can I show net loan of 298? Yes, sir. Can I do net settlement there? A loan separate, bond is separate. Correct? No. Moreover, legally also it is not permitted. So, just because parties are same, automatically it should not issue. So, two conditions are there. Legally enforceable right should be there, and parties should have intention to settle on a net basis. There is a small carve out on a concept called as foreign currency convertible bond. Subject to time, I will discuss later on. This question also is not there, so I just don't want to unnecessarily go into detail. It's a very interesting one, but we'll see subject to time. Even this one also questions are not there. Now coming here, exclusions from Ind AS 30 to 109. Very important, sir. In this couple of exclusions are really important. You tell me, sir, investment in equity shares, is it a financial asset? Investment in equity shares of another company, definitely financial asset. But you see this, investment in equity shares of subsidiary, joint venture, associate, they are scoped out of the standard. Even though they are financial assets, they are not covered under the standard. Why, sir? There is a separate standard for that called as Ind AS 27. Ind AS 27 ka title is separate financial statements. If you go to that standard, that fellow will tell you how to do accounting of investment in equity shares of subsidiary, associate and joint venture. This standard asks you to get out now. When you go to Ind AS 27, you know what he says? You have two choices. Number one, cost. Number two, follow Ind AS 109. That fellow will again kick you back to 109. If you really badly want to go to the next page, first go to Ind AS 27, then get kicked from there to here 109. Ultimately, if you want, you can apply also, to be honest. Next. Suppose you tell your customer that I'm selling a product, if the product does not function well, I'll refund you the money. It's a kind of a warranty obligation. Okay. So here you have contractual obligation to deliver cash. So ideally it satisfies the definition of financial liability. But you have a specific standard called as Ind AS 37 for provisions. Our standard covers. So E particular standard is not applicable for warranties. Next. You are issuing some shares and all. You are acquiring some assets and all in the course of a business combination. Amalgamation process, you have incurring some issue cost and all, you are incurring some issue cost on issue of shares and all, or you are taking over some assets, financial liabilities. At what values you should record? Ind AS 103 says. So again, this standard is not applicable. These three cases are important, sir. On remaining, you don't even see any application also. Investment in equity shares of subsidiary, associate, joint venture are not covered here. Warranty obligations are not covered here. Business combination related transactions are not covered here. Except these three, remaining you will not see anywhere, sir. No question will be there on that, so you not bother much about it. So that is the end of our Ind AS 32, sir. The first part of the standard. In this, what we learned is, we learned the definition of financial instrument. We have seen financial asset, financial liability, equity. Then we saw that there is a derivative instrument. Derivative can be classified as a financial asset also, financial liability also, equity also, scoped out also. Then we have seen contracts, which are contracts to buy or sell non-financial assets on a future date, a copper wala example. For that entire summary is, if the contract is only going to be settled by way of physical delivery of non-financial asset, you are scoped out. If it is going to be settled by way of net cash, then you are covered under the standard. Only that much. If option and all is there, check your past history and current intention and then decide. After that, we went into fix it to fix it test. What two things should be fixed? Number of shares to be issued should be fixed. Value of consideration to be received also should be fixed. If these two things are fixed, a contract is classified as a own equity instrument. Now you can link up. What is the advantage of becoming an own equity instrument? If it is an own equity instrument, accounting will happen only once at once. That too directly in the equity. You will never ever fair value it. You will never take anything related to that into your PRL. So that is the ultimate advantage of becoming an equity. Equity, there is no subsequent remeasurements. All gains and losses are recorded only in equity itself, if at all something is there. So that is F2F test. Then after F2F test, we covered, compound financial instruments. Compound financial instruments are contracts where you have the character of equity also, financial liability also. Accounting we will discuss later on. Then we have seen how to do accounting of a buyback. We learned how to do accounting of treasury shares. Then we went into the concept of transaction cost. Transaction cost related to own equity instruments cannot go to PRL. It will be adjusted in equity itself. Up to there we have covered. Then we went into the concept of offsetting. Financial asset and financial liability can be presented on a net basis if the parties intend to settle on net basis and it is legally permissible to settle on net basis. So that. And then we discuss the treatment of interest and dividends. Interest and dividend income on financial assets recorded in PRL. Interest and dividend expense on financial liability recorded in PRL. Interest and dividend on own equity instrument should be recorded in equity itself. Discretionary payments are also recorded in equity itself. Right? So up to here we have covered, and these are scope exclusions, sir. So now we are good to start the next standard, which is Ind AS 109. Ind AS 109 is the main standard of financial instruments. I made a small summary here. This will give you an overall view, sir. Observe this. Equity accounting we will not talk now. We have only two things to talk. Financial assets accounting, financial liabilities accounting. If it is a financial asset, in this entire standard, you have only three methods. One is amortized cost method, which we call it as ACM. Second one is called as fair value through profit or loss, FVTPL. Third one, fair value through other comprehensive income, also called as FVTOCI. So a financial asset can be accounted in any of these three methods. This is not your choice, sir. Which method when you have to apply, the standard has a detailed guidance on that. But as such, how many methods are possible? Three methods are possible. When it comes to financial liability, only two methods are possible: ACM and FVTPL. Which means what, sir? Overall, you have to learn only three methods: ACM, FVTPL, FVTOCI. But for asset, all three are applicable. For liability, only two are applicable: ACM and FVTPL. Okay. Now, what we will do is, we will learn the ground rules of each of these three methods. See, we will not first go and attack financial assets and all. See, there are two ways from here onwards, sir. First, you learn how to apply each method, and then learn which asset, which method you have to apply. That is one way of doing it. Or, first I will tell you for which asset, which method is applicable. Then we will see what is inside the method. That's how the second model is there. No? That's what StudyMat has followed. Okay, a method loan flaw is there. What is that flaw? Is when I teach you that for investment in equity shares, you have to apply FVTPL. You will ask me why. If I say for a particular set of conditions, you have to apply only ACM, you will ask me why. And I can't convince you because you don't know what is there inside ACM method. So we will do the reverse process. First we will see, as in ACM, what will happen. In FVTPL, what will happen. In FVTOCI, what will happen. And I will give you two or three examples where I myself will ask in the question, do ACM, do FVTPL, do FVTOCI. First to become pro in that. Understand how to apply these three methods. Once you understand these three methods, when to apply which method is very easy and logical to understand. Okay, so let's start with the ground rules. Follow here, sir. Amortized cost method. Look at the name. Cost and a word is there. Indirectly, that means that fair valuation is not permitted. Okay, the initial recognition of financial asset or financial liability will be done at fair value, including the transaction cost. What fair value is there? At initial recognition, it is recognized on the very first day at what value? Fair value, along with the transaction cost. I'll give you two examples, you tell me entry. I purchased investment in the market, 100 rupees fair value I bought. I paid brokerage of 2. Total how much did I pay? 102. Tell me entry now. Directly investment account debit to bank 102. Is that 102 fair value? No. 100 is fair value. 2 rupees is transaction cost. If 2 transaction cost is adjusted to the fair value and will record the entry. Financial asset ka initial recognition and transaction cost is already loaded into that. Okay. Next example. I took a loan of 100 crores. I paid 1 crore processing fees. So net I received how much? 99. Tell me initial recognition entry for this loan. Bank account debit 99. To loan 99. Sir, earlier transaction cost you added. Now you are deducting it. Why like that? Sir, it's not about adding, deducting. You see the cash flow come movement. Earlier, 100 rupees was outflow. 2 rupees also outflow. So I added both of them. Loan case, sir, 100 was inflow, 1 was outflow. So I netted them off. So, including transaction cost means not adding or not minusing. It depends on case to case basis. Are you getting it, sir? I gave a loan of 1 crore, or let's say I gave a loan of 100 rupees to you. I collected processing fees of 2 rupees from you. I gave 100, I received 2. Net I gave you 98. So loan receivable should be recorded only at 98 starting point. Okay, this first point. Second point. The interest income or the interest expense will be recognized using effective interest rate method. Effective interest rate method is nothing but indirectly IRR. Interest expense or interest income should be measured using IRR. Indirectly is asking you to follow compounded interest model, sir. IRR accounting will happen in this. Interest income, interest expense. Now, how it will happen, I will show you detail. Continue. And there will be no subsequent revaluation. What is the meaning of it? First day you recorded fair value along with transaction cost. Every year you recognize interest income, interest expense. And on the balance sheet date, there is no fair valuation. Method, name a what method? Cost. There is no subsequent fair valuation. That's all. ACM ka 3 rules are over for us. Let it be financial asset, let it be financial liability. Rules are only this, these are not going to change. Next. Fair value through profit or loss. See the name, fair value through PRL, profit or loss. Now, you can guess easily now. initial recognition should be done at, what is the name? Fair value. So initial recognition also is done only at fair value. Sir, what about transaction costs? They will die in PRL. We will not mix it along with the financial asset or financial liability, because this name, method of the name itself is what? Fair value through profit or loss. Now, I purchased investment for 100. I pay transaction cost of 2 rupees. Entry will be investment account debit to bank 100, expense account debit to bank 2. Expense will go to PRL. Either if you are applying ACM, entry would have been investment to bank 102. Under FVTPL, initial recognition should happen only at fair value. Transaction cost should go to where? PRL. Right. Next. In ACM, interest income, interest expense was measured on EIR, effective interest rate basis. Effective interest rate is nothing but IRR. You should not apply IRR concept while doing FVTPL. So whatever coupon interest income or coupon interest expense is there, directly will book it in your PRL. No concept of IRR drama there. Next. In ACM, on every balance sheet date, there is no subsequent remeasurement. But here we have subsequent fair valuation. Method A, fair value method. No, so obviously on every balance sheet date, your financial asset or financial liability must be measured at fair value. Whenever you fair value it, pakka gain or loss will come. A gain or loss will go to PRL. PRL means what? First part of your P&L account. It will go there. Clear? Next. Fair value through other comprehensive income, also called as FVTOCI. Now, the initial recognition of financial asset will be done at fair value including transaction cost. Wait there. E point is just similar to what? E point is just similar to ACM. ACM, whatever initial recognition principle is there, FVTOCI initial recognition principle also is same to same. Next. If the cash flows of financial asset are in the nature of interest and principal, that means you are having interest incomes, then for that interest income, again you will apply what? EIR. And it should be same as if you are following which method? ACM method. If you are following ACM method, whatever interest income you are recording, even under FVTOCI also, same interest income will come. What is the moral of this is, ACM ka first 2 points, FVTOCI ka first 2 points are same to same. ACM ka third point is what? No subsequent revaluation. Can I say that here? No, here name a fair valuation. So obviously on every balance sheet date you have to do a fair valuation. When you do fair valuation, you will definitely have a gain or loss. Where will it go? OCA. It cannot go to PRL. It will be parked as a separate reserve in the balance sheet. But before coming to balance sheet, it will once say hi in P&L account bottom section. And from there it will enter into balance sheet. OCI item means directly balance sheet separate reserve. But before coming to balance sheet, it will once go to P&L account ka second part, say hi there and then come to balance sheet. Clear, sir? Now read third point. On every reporting date, the financial asset is fair valued and resulting gain or loss is recognized in OCI reserve separately. The gain or loss so accumulated in OCI may or may not be reclassified to PRL subsequently. What's the meaning of this? Sir, if fair value gain what you are getting, are you understanding the unrealized gain or unrealized loss? One day in future it will be realized. When it will be realized in future, you can merge it into retained earnings in some cases. Sometimes you may have to transfer it back to PRL. So that is called as the reclassification concept. Clear, sir? So these are the ground rules of these three methods. Now when you apply these methods, I'm telling you the most easiest one is FVTPL. And among these three, difficult one is FVTOCI. Sir, what about ACM? Sir, that is your starting point, sir. You understand ACM very well, instruments will become your friend. It is like that. 2 examples, sir. Give me time. You will become pro. Watch this. A Limited has issued 9% debentures, face value 100 each, at 5% discount. So 100 rupees face value you issued at 95. Coupon rate is 9%. These debentures are redeemable after 3 years at par value. So issued at discount but redeemable at par. Show the accounting applying ACM. EIR is 11.048%. Question they gave of the EIR. Okay. Now, what is it trying to say is, a 3-year debenture, sir. Today you issued the bond at 95. You raised 95 rupees. Bond life is 3 years. Here you have to pay coupon. Here also you have to pay coupon. Here also you have to pay coupon. Here along with coupon you also have to pay maturity value also. Your coupon rate is given as 9%. 9% you have to apply on the face value. So it is 9 rupees outflow, 9 rupees outflow, here 9 rupees outflow, maturity value redeemable at par 100 rupees outflow. So total outflow at the end of third year is 109. Now, carefully watch. You received 95, but overall you are paying more than 95 now. 99927 plus 100, 127 you are paying overall. If I ignore time value of money, you raised 95, but repayment you are doing 127. You are definitely paying more than 95. That means some interest you are paying, no? Compounded basis, I want to know how much interest are you paying. Now you should not go and tell me, sir, our interest rate is 9%. It is stupid contracted rate, sir. Under the contract, I am liable to pay you 9% interest. But my actual cost is not 9%. It is much more than that. Why? Imagine, sir, I did not issue the bond at discount. I issued at par. Tell me now. I raised how much? 100. I am repaying how much? 100. Last. In between I am paying 999. Coupon rate 9. My actual cost also is 9. But in our example, I did not raise 100. I raised only 95. Because of that, my actual cost won't be coupon rate. It will be much higher than the coupon rate. Sir, how much is that I want to know? For that, you have to apply IRR technique. What is the discounting rate at which the present value of all the future cash flows will become equal to 95 rupees? A discounting rate, trial and error, you work. You know it's more than 9. Try at 10, fail there. Try at 11, fail there. Try at 11.5, fail again. Now sit and interpolate. And you will ultimately work out that it will be 11.048%. This is your effective interest rate. Sir, this is IRR, no sir. Why are you calling it as EIR? One more name unnecessarily. Call it as IRR only. IRR ka full form is what? Internal rate of return. Is investment, borrowing. Borrowing. On borrowing you will have return. So I want a neutral name. That's why IRR in a word I don't use. EIR is a neutral word. It's neither return nor cost. Whatever it is, whenever it is, we can use like that. That's why standard does not use the word IRR. They call it as EIR, neutral word. But concept is IRR only, sir. Okay, so EIR. Now, debentures, financial liability. If you have calculator, can help me. If you don't have, then I'll have to help myself. Yeah. Sir, on these debentures, if I am applying ACM method, tell me. You will tell me initial recognition principle now. Initial recognition principle. Recognized at fair value including transaction cost. I don't have any transaction cost. So I raised how much? 95. So directly first entry will be bank account debit to debentures 95. So I will write by bank. Okay, first day accounting is over. Next, what is the second point of ACM? Interest income or interest expense should be measured using EIR. Normally, sir, even if you don't know any instruments, what is the entry for interest paid according to our C enter? Interest account debit to bank. It is when you pay interest. If you don't pay, interest account debit to interest payable, accrual concept. You will record this entry, correct? Now what we will do under ACM method is, we will record the second kind of entry. We will book an expenditure and we will create a liability. And we will not create a separate liability. This also we will go and credit it to debentures only. And this we will credit with what amount? EIR amount. So at the end of year 1, the entry I will record is interest expense account debit to debentures. So in debentures account, how will it fall? By interest expense. Sir, amount, you raised 95. On that your cost is 11.048%. Please tell me the number, sir. 10.49 is 49 only. Or 5 1. 10.5 exactly. Okay, fine. Leave it. My bad. Leave it. So I borrowed 95 and I owe you 10.5. But by the end of first year, am I paying something to you? How much am I paying? 9 rupees. To that extent, my liability should come down. So my entry now should be financial liability, or in this case, debenture financial liability account debit to bank. 9 rupees. So in debentures account, I will go and write to bank 9 rupees. Now watch this carefully. According to legality point of view, this is interest. Legally, I owe you how much? 9 rupees. So this is what people call it as interest. Layman. You are not layman, you are pro. For you, this is interest. Interest means that number which is measured using EIR. Proper compound interest I want. Not your legal payment. This is contractual cash flow. This is EIR interest. This is interest, sir. This people call it as interest, but this is not interest for me. This is only a cash flow for me. Okay, now. Tell me the closing balance. 96.515. Okay, with this I am done with first year. When I come to second year, my opening balance is 96.5. End of second year, by interest expense. In 96.50 into 11.048%. Please do it, man. 10.6? 6666 like that, huh? Exactly 66, huh? Okay, fine. Then, to bank. Again, you are paying how much? 9. So, you still owe to your debenture holders how much money? 1.6. So, with this second year also I am sorted. Now, come to third year. I'll start this with 98.16. Third year ending, again I have to record what? Interest expense. Interest expense, how will I get? 98.16 into 11.048%. Now, just keep on with that number. We have a small issue with that number. Come here. Is it the last year? Once I make the payment here, do I owe anything to anybody in this world? No. So, we should have a clarity that your final closing balance is going to become 0. And this IRR and all, whatever rates are there, usually they are approximate rates. They won't exactly match dot to dot, pin to pin. Okay, some approximation may be there. So when you come to last year, no, don't work out interest first. That is simply, Juma, we wrote in the bracket like that. Don't post that number anywhere. What you do, it is certain. 9 I have to pay, 100 I have to pay, and after I pay 109, the account should die. So you will take this as a balancing figure. 10.84. Sir, I worked out, I also got same numbers. Pure coincidence. Means not coincidence, it's supposed to be same, but generally small approximation error will come, sir. Okay. Ideally it should match, sir. If your EIR is perfect, it will match. But it will be hardly perfect. Generally it won't be, small error will be there. So they take it as balancing figure and close it. Okay. Now, the entire account, sir, we will have learned some entries. Tell me, what is the first entry you wrote? First entry, bank account debit to financial liability. Some amount. Each year you tell me. Each year two entries you wrote. No, numbers I don't want now. Skeleton entry. Interest expense account debit to financial liability and financial liability account debit to bank. Sir, these two entries are recorded with same amount or different amount, sir? This is recorded with EIR. This is recorded with contractual cash flow. According to contract, how much I agreed to pay, that much. And on every closing date, did I fair value? On every balance sheet date, did I fair value or account simply balance it? Simply balance it. There is no fair valuation. That's all, sir. This much accounting only. You repeat, our account will collapse one day. It will become 0. That's all is there in ACM. Entries carefully remember, sir, only this much will be there. Easy only. Am I clear here? Now, I have some observations. Watch this. What is the contractual interest rate? 9%. This particular sum, sir, debenture is issued at par, discount. Because of that, my cost of borrowing has increased, no? I received 95, but I have to repay how much? 100. So, even though technically interest rate is 9%, in substance real interest rate is 11.048%. So, your EIR is 11.048%. Now, they both are not same. Why they both are not same? Simple, because the bonds are issued at discount. Imagine, sir, here it is 100. I raised at par value. Then, my coupon rate is 9. My EIR also would have been 9%. If my coupon rate and EIR both are same, you know what will happen? Come here. The account look carefully observe. The starting number would have been 100. 100 into 9%. This would have been 9. I would have paid 9. The closing balance would be 100. Next year opening balance would be 100. On that 9. Again I would pay 9. The closing balance again will be moral of the story. First day whatever number you record, our number will continue as closing balance every year. When your EIR and coupon rate both are same, opening balance and closing balance of each year also will be same. Our case it is not same because our EIR and our coupon rate are not same. If you go and ask, sir, why you people are not same? Why you people are not same? Because bonds are issued at discount, redeemable at par. That's the reason they both are not same. Sir, bonds are issued at par, redeemable at par, no transaction costs also. In that case, coupon rate and EIR both will match. Suppose same sum, sir, if I change like this. I issued bonds at par only. I raised 100. But I suffered transaction costs of 5. Bond issued, I received 100. But I paid net inflow. In that case also my answer will be exactly like how I did. Issuing at par is not sufficient. Transaction cost should be 0. Then only EIR and coupon rate both will match. Now why I am telling you all these mathematical observations is, sir, later on when we go deep into this chapter, there are certain questions like loan restructuring and all. That fellow will restructure the loan in the 8th year of loan. Now what is the balance of on that day? Our question you will observe that EIR and coupon rate both are same. So first day whatever balance is there, every year same balance will be there. So you will not prepare a ledger account for all the 8 years and all. Directly you will fatafat write the number. To save time, I am asking you to observe now. Okay. Next, last point, sir. With that, ACM for this liability will be over. Now, instead of preparing that entire ledger account, we can prepare a small, cute ACM table. ACM table is the account only in a tabular format. So 1, 2, 3. Opening balance of financial liability. We recorded at what value? 95. To that, interest expense based on 11.048%. To that, we paid some cash flows. If you pay cash outflows 9, 9 and 109. Lastly, it should become 0. First year interest you told me something 10.50. Closing balance of first year will be 96.50. That will become opening balance of next year. Then it will become 10.66. 10.66. Then it became 98.16. In 98.16 is opening balance here. On this 10.84 you paid, and naturally the closing balance towards the end is becoming 0. The ACM table is a shadow or a skeleton of this entire ledger account. If there are 10 questions in your study mat, 9 questions they'll ask you only ACM table. But there is one question where they'll ask you entire ledger account. Some stupid will ask a journal entry in the exam. Suddenly we should not be searching there. So we should know both. You should be good this way also. Okay. Now, I have a small query, answer this. Is this 95 representing the present value of these 3 cash flows? Is 95 the present value of 9, 9 and 109 discounted at 11.048%? If you say no, I don't know where I'll bang my head now. Okay. So in 9, 9 and 109 ka present value is 95. When you discount at what rate? 11.048%. That much clarity we should have, no? Okay. Now come here. If 95 is the present value of these 3 cash flows, then 96.5 is present value of these 2 cash flows. Yes or no? Yes. Then 98.16 is present value of 170. It will 100% match. If you want, you can try and see. 100% it will match. Rounding error may be there, but as such it will match. That means when you are following ACM on any given day, the closing balance will be equal to the present value of future remaining cash flows discounted at your EIR. The very, very, very powerful observation. Why? I'll tell you. Later on, sir, we'll be doing some deep questions where Loan life is 20 years. Modification of loan is happening in 12th year. Okay, so 12th year lo what carrying amount is there? How will you know? Coupon rate EIR, if both are same, then I will apply starting amount and ending amount will be same. They both are not same. No. You will prepare 12 years ka ledger account. 12 year ka ACM table you draw. Now be smart. 20 years la 12 years is over. Remaining life is 8 years. 8 year ka cash flow discount it. Apply annuity factor and all. One line you will get the closing balance. Single shot la answer will come. You need not prepare 12 columns ka ACM table. You need not prepare 12 years ka ledger account. One single mathematical number you can work it out. Under ACM on any given day, the closing balance will be, should be, has to be equal to the present value of future remaining cash flows discounted at your original EIR. So very, very important observation. This only ACM it will work, not in any other method. Clear? Right. E points only I wrote here. E entries ka skeletons we have given, ACM table we have drawn, and this. The closing balance of FI or FL under ACM will always represent the present value of future cash flows discounted at effective interest rate. It's a very, very important summary point. Next, we'll try this one also. A Limited has advanced 1 lakh rupees loan to B Limited on 1/4/2015. This fellow gave loan of 1 lakh. It collected processing fees of 10,000 rupees from B Limited. 1 lakh I gave, another hand to 10,000 rupees I collected immediately with the name of processing fees. The loan carries an interest rate of 10%. The loan is repayable at 3 years at a premium of 5%. How much loan did I give? 1 lakh plus 5%. Repayment time, that other fellow will give me 105. Show the accounting in A Limited for all the 3 years using amortized cost method. EIR is 15.87%. EIR is given in the question. They are asking you accounting for this. Now, this is a loan given, sir. So it's a loan receivable, financial asset, which is getting accounted at ACM. Sir, who told you that it's ACM? Question told. Really, when should you apply? That I will tell you later. Tell me, sir. ACM initial recognition principle. ACM initial recognition principle. Fair value adjusted with the transaction cost. Transaction cost in the sum is how much? 10,000. I gave how much? 1 lakh. 1 lakh is an outflow. Transaction cost paid or received? Received 10,000. So effectively 90,000 I gave, netting off. Correct? So my first entry will be loan receivable account debit to bank with an amount of 90,000. How did I get 90,000? 1 lakh I gave, 10,000 rupees I received. Effectively it is 90,000. Some people what they do is, they write 1 lakh here and they again write buy bank 10,000 here. That also will have the same impact, same effect. But I advise not to do that. Why? Next you have to compute interest, no? Interest you go and apply on 1 lakh. Gone some there only. Oh, yeah, next 3 years nobody will study. There only clarity came. So just for showing separately you are capable of making bigger mistakes. So directly write the net entry itself was always safe. Okay, now coming to the end of first year. End of year 1, tell me, sir, interest expense or interest income should be recognized using EIR. Tell me, what is the entry for interest received according to our olden days? Bank account debit to interest. Interest not received. Then interest receivable account debit to interest. Interest receivable is an asset only, no? Now instead of creating a separate interest receivable, directly debit it to loan receivable financial asset itself. So the entry will be loan receivable financial asset account debit to interest income. Sir, with what amount? 90,000 into 15.87%. Tell me the number, sir. 14,283. Good. Now, by the end of first year, that fellow will give you some cash. Now, how much cash will he give me? If you see, what's the coupon rate? 10%. He will apply 10% on what number? 1 lakh. Legal contractual interest is 10,000 rupees. So, even though 14,283 is your income, you are getting only a cash of 10,000. So, by bank you will record 10,000. Closing balance is 94,283. 1 year is completed, sir. Second year. Opening balance 94,283 to interest income. 94,283 into 15.87%. Please do this, ma. 963. Again, in second year ending, I will collect a cash flow from that boy to the extent of 10,000. E gap how much, ma? 108, no. 98,000, 99,246. So this is my closing balance. You understand, sir? E closing balance, whatever is coming, that is simply balancing figure. That is not a fair value and all. If you want fair value, no sir, you have to bring market interest rate and discount. I never went to market. I simply did a closing balancing figure. Finally, last year, to opening balance 99,246, to interest income 99,246 into 15.87%. Remember the last year, so don't write that number. By bank, whatever you are collecting, I am collecting how much now? My coupon of 10,000. My original amount given 1 lakh along with the premium 105. So total I will get 1,15,000. And once I get this, I don't have right to collect any more cash flows. My financial asset is gone. So 115,000. Here also 115,000. Balancing firma. 15,750 for a. This is your interest. This is ACM for a financial asset. Sir, ACM ka rules are common, sir. We don't differentiate between whether it is a financial asset or financial liability. Rules are same. When you should apply ACM to financial asset, that is a different discussion. But ACM accounting is same. Okay. Now, summarize the entries here. What's the first entry you wrote? Bank account debit to, financial asset account debit to bank. The initial recognition entry. Then every year you wrote two entries. What's the interest income entry? Financial asset account debit to interest income. And bank account debit to financial asset. And every year ending, no subsequent fair valuation. That's all. If you go on following this, our account neatly will become zero. That's all ACM is. ACM you have to understand one powerful observation that the closing balance on any given day will represent the present value of remaining future cash flows discounted at your original EIR. Now, I am highlighting only the cash flows. Watch on the screen. First year ka cash flow is how much? 10,000. Second year ka cash flow is 10,000. Third year ka cash flow is 1,15,000. Now, by the end of first year, what is my closing balance? 94,283. In 94,283 is representing the present value of 10,000 and 1,15,000. Discounted at what rate? 15.87%. 100% it will come, sir. If you want to match and see your patience, how much you want to do. Say 100% work out, sir. Unless your EIR is wrong, 100% will match. Okay. So this is how ACM goes on working. Now, come to one question, sir. Come to next example. Watch this. It's a very simple example. On 1/5/2016, A Limited purchased an investment in equity shares of X Limited, at 40,000. Transaction cost also paid 2,000. Share investment. The fair value of shares on different dates is as under. First month ending 48,000. Second month ending fair value is 45,000. Third month 38,000. So you purchased for 40. Transaction cost 2,000 you paid. First month ending fair value, second month ending fair value, third month ending fair values they have given. He is asking, show the accounting of this investment assuming FVTPL and FVTOCI. First and foremost thing you observe. Is it bond investment or share investment? Share investment. In this interest income accounting will be there or will not be there? Will not be there. Interest income accounting will be there when there is a loan transaction. Is it loan? It's not loan transaction. It is share investment. You will not have interest and all. So EIR drama and all will not be applicable here. That's the reason he is not even asking you to apply ACM method. He is directly asking you to apply which method? FVTPL and FVTOCI. Let's all first talk about FVTPL. Tell me, ma, FVTPL ka initial recognition principle. Fair value with the transaction cost? Only fair value. So what's the fair value here? 40,000. So entry will be investment account debit to bank with an amount of 40. Or 2,000 directly go to PRL. Don't bring it to financial asset account. Correct? So investment will be appearing at what value? 40,000. By the end of first month, what is the fair value? 48. So my closing balance should be how much? 48. But already how much is there? 40. So you have to further update by 8,000. So 8,000 is gain or loss? Gain. So entry will be investment account debit to PRL. PRL gain, so I'm directly transferring it to P&L account. So what accounting ledger point of view, how I did is, I recorded 40. I know that my closing balance, the desired number should be how much? 48 fair value. Gap whatever is there, I went on throwing it off to PRL. So next year opening balance will be how much now? Again 48. So sorry, next month. Next month closing fair value is how much? 45. So I write 45 here. This is my balancing. 3,000 rupees loss. Third month, my starting point is 45. Ending fair value is 38. Again gap 7,000. Where will it go? PRL. Every gain, every loss will go only to PRL. Clear? Now, you watch the same thing and tell me, how will it be different if it is FVTOCI? FVTOCI initial recognition principle says that transaction cost should be part of your initial recognition. You paid 40, you paid 2. Total you paid 42. Investment initial recognition will happen at 42. Investment initial recognition will happen at 42. Fair valuation is common only, no? At the end of first year you fair valued. To how much? 48,000. How much gain did you get? 6,000 rupees gain you get. This will not go to PRL. It will go to a separate reserve parked under OCI. So we'll call it as OCI reserve. Second month, third month accounting will be similar, sir. Instead of PRL, you will be transferring the losses to OCI reserve. FVTPL and FVTOCI both will be same, sir. Only thing is fair value gain, instead of going to PRL, it will go to a separate OCI reserve. And initial recognition principle also is not same. Initial recognition principle is, there it is fair value, here it is fair value with transaction cost. That's all. Sir, unnecessarily people make some stupid tables and all to teach you this method. This is the most easiest way. If you observe, ACM ka first two principles, FVTOCI ka first two principles are same. FVTPL ka last principle, FVTOCI ka last principle are same. Their fair valuation, here also fair valuation. They will go to PRL, here it will go to OCI reserve. The much more very simplified version. Okay, now, if you once go back to the rules what we discussed, please read B point again for FVTOCI. If the cash flows from financial asset are in the nature of interest and principal, the interest income shall be recognized on EIR basis. So when you have to apply EIR, when cash flows are in the nature of interest, the example what we just now solved, in that interest is there, interest will not be there. Why it will not be there? That is a share investment. Share investment is not a type of asset where you get interest income. That's why B point you could not apply here. Now later on, after some time, I'll show you a question where it's a bond investment which is measured at FVTOCI. There you will have more clarity on how FVTOCI works. Okay. So after some time, I'll show you that. Chalo sir. With that, we are kind of done with our all the basic three methods: ACM, FVTPL, FVTOCI. Three methods are done. Now formally we have to understand how to do accounting of financial assets, how to do accounting of financial liabilities, and compound financial instrument. With that, each chapter is over. But each one section is an ocean in itself. But I'll tell you, sir, the biggest part you already crossed. You just have to understand how to execute it. Newly you are not going to learn anything hereafter. Here onwards, whatever you learned till now, that only a different models you will be applying it. But the basic accounting part is set. You just have to be exposed to various kind of concepts and applications for formality's sake. Real learning is already completed. The last two examples, everything is there. The moment you get confused again, walk back and see answers are lying in front of you. Okay, come here, sir. Let's start with the first concept of Ind AS 109. That is accounting for investment in equity shares. Now, if you purchase investment in equity shares, which method to be applied for that? I'll tell you, is standard Ind AS 109 ka heart la what is there is follow FVTPL. I am Ind AS 109 heart. Follow FVTPL. What's the meaning of FVTPL? Initial recognition at fair value. Subsequent fair valuation also at fair value, and gain or loss will go to PRL. One enthusiastic fellow will stand up and say, or not you, will say, sir, if I fair value like this, a gain or loss will coming into PRL, that is impacting my EPS. God promise His share I will not sell in the near future. When anyway will not sell in the near future, what is the point of impacting my PRL section with a unrealized fair value gain and loss and consequently impacting EPS with that? I don't like FVTPL. I will want to follow FVTOCI. Argument is valid only. What argument is he doing? I will not hit my PRL because if I hit my PRL, my EPS will dance. I am not going to sell the share in the near future. So why should I transfer it to FVTPL? Point is valid. So what the standard says is, chalo, you have ultimately two choices. At the time of initial recognition, you have a choice either to follow FVTPL or to follow FVTOCI. But whatever choice you make, you are stuck with that choice for life. Again, changing back is not allowed. FVTPL or FVTOCI, decide once when initial recognition time you decide. But standard ka heart lo what is there? You should follow which method? FVTPL. But this fellow does overaction that I want to follow FVTOCI. Standard says okay, follow FVTOCI. But now that you are going against my wish, I will penalize you. You know how I will penalize you? Every year you fair value. When you fair value, gain or loss will come. A gain or loss is going where now? OCA reserve. One day, when you sell the investment, the OCA reserve will be now a realized gain. This fellow says, don't reclassify it to PRL. Why not reclassify to PRL? What did you say? I don't want to impact my EPS, and you told or not? You said no. Fine, follow with that. That means in case you select FVTOCA option, a accumulated gain or loss in OCA reserve cannot be recycled to PRL. It has to be directly merged into retained earnings. That's all. That much only, sir. So investment in equity shares, the answer is ideally you should follow FVTPL, sir. If it's a long-term investment, you don't want to impact your EPSs every year, then you have the choice of following FVTOCI. But mind you, in case you follow FVTOCI, a OCA reserve, whatever you are creating, that is not allowed to be reclassified to PRL. Subsequent date when it gets realized, it has to be merged directly into retained earnings. It's like that. That much only. See, why it is not reclassified? I want you to follow FVTPL, but you wanted to follow FVTOCA. I'll allow you that. That means, why do you want to follow FVTOCA? You don't want to impact your EPS, no. So don't impact your EPS now also, in future also. So why it is not reclassified? Everything has got a reason in the standard. Fine, this is one thing, sir. Next. Now the problem is, you must realize this. For financial assets, how many methods are there? FVTPL, FVTOCA, who is the other one? Nobody is even talking about this. It is investment in equity shares, as ACM ka choice is not there. Why standard believes that if you buy shares of another company, one or the other day you will sell it. One or the other day you will sell it. When anyway you will sell it means what? You are interested in fair value. Since you are interested in fair value, if you say that I will carry at cost, I am not stupid to allow you that. Your accounting standard 13, that fellow says long-term investment measured at cost. This fellow says I don't care, bro, whether it is long-term or short-term, it has to be measured at fair value. At the best I can give you a choice of FVTPL or FVTOCA. ACM is not permitted. Earlier, if you remember scope exclusions, what's the first exclusion? Investment in equity shares of subsidiary, associate, joint venture are not covered under the standard. You know why? They are, sir, subsidiary is my own company. I control that. I may not sell that subsidiary. I may not sell my shares in associate. I may not sell my shares in joint venture. I want to further my business through those companies. I want a cost option there. A cost option will not be given in Ind AS 109. So you scoped out from here, took it to Ind AS 27, their cost option is given for you. That's the reason there is a scope out for that. So move on. It's a very important, interesting one now. Concept number 2. Accounting for financial assets other than equity instruments. Other than equity instruments, any other financial asset accounting. Now, all the three things are possible. ACM is also possible. FVTPL is also possible. FVTOCA is also possible. Sir, other than equity investment, what other financial assets can be there? All debenture investment, preference share investment, loan given, staff loan given to subsidiary, security deposit, debtors, all this will fall under the second category. They are not equity investments, they are any other financial assets. Now here onwards the story is very, very interesting. Please pay attention. Now, which method is applicable for you? Which method is applicable for you depends on two tests. First test is called as business model test. Business model test checks the objective of your entity in holding a financial asset. If you have a financial asset, with that financial asset, what are you planning to do? That is called as your business model test. The second test is called as contractual cash flow test or SPPI test. Here we'll check the rights emanating from financial asset. Okay, you purchase a financial asset. What kind of right are you having? So I'll test two things. Number one, why did you hold this investment? What is your intention? I want to know your intention. Okay, I understood your intention. Next, with this financial asset, what kind of rights are you earning? These two things, if I know, I will decide whether I should apply ACM or FVTOCI or FVTPL. Now, this standard identified that for any entity, only three kind of objectives are possible. With a financial asset, only three objectives are possible for anybody. Number one, hold the financial asset till its maturity. Don't sell it, just simply hold it. For example, a company is issuing bond of 8 years. Today I purchased the bond. If somebody comes and asks me, "Arey sir, why did you buy that company's bond?" I will say, I purchased the bond, I will hold the bond till maturity. I will never sell it. That is one possible answer I can give you. This I am calling it as A, capital A, to hold the financial asset till its maturity. B. No, don't, B. B is, sir, I want to hold till maturity, but if I get a very good price in the market, I don't mind selling it off. What is the difference between A and B now? A is very clear. Sir, I will hold it till maturity. B, I will hold it till maturity, but if I find a better opportunity, I will definitely sell it. That means I am daily looking in the market also. What is the price? What is happening? Is there any better investment? The price has increased or decreased. I am watching that. First case, sir, I will not watch in the market what is happening. Why? My goal is not to sell in the first place. Second fellow has an objective to hold, but investment can be sold also. Third objective, purely to trade. I want to sell. I came here for the purpose of selling it later on. So beyond these three objectives, there is no fourth objective. First objective is to hold. Third objective is to be sold. Between these two dual objective, middle one, B1. Correct, sir? A, B, C. Now come to next test. Who is next test? Contractual cash flow test. What the standard says is, a test is passed when the financial asset provides a right to collect cash flows which represent solely principal payment and interest. So the financial asset should give you a right. A right should be what right? Just to collect cash flows. Which cash flows? Principal cash flow and interest cash flow. Beyond this, one extra right if you have, a test is deemed to be failed. So how many points did we cover till now? A, B, C are objectives. D is a right. A, B, C is your why. D is what right are you having. Why and what I will test. Based on this, I will decide a method for you. Now answer this. The standard says, you will apply ACM if A plus D is satisfied. What is A? My objective is to hold till maturity. What is D? You have a right to receive only cash flows representing the nature of principal and interest. If A and D are satisfied, you will go and apply which method? ACM. Sir, why should I apply ACM? Tell me, sir, are you having intention to sell? When anyway you don't have intention to sell, why should you fair value it? You need not fair value it. Out of the three methods, which method the subsequent fair valuation is not there? ACM. So ACM is given to you. Moreover, your cash flows are in the nature of principal and interest. That means cash flows are fixed cash flows only. Now that cash flows are fixed cash flows, I can find out EIR. Now that I can find out EIR, if I want I can apply ACM. No. So ACM ka all rules are literally fitting for you. A plus D if you are following, you have to go and apply ACM. Next, you will follow FVTOCI if B plus D is satisfied. What is B? Objective is to hold, but it can be sold. That means I am having intention to stay till maturity, but I may sell also. That means if I don't know whether I will hold it till maturity or I may sell. Imagine, sir, If I hold it till maturity, okay, will I get fair value gain? No, but I will get interest income. But if I sell in between, then I will get a fair value gain. So I want a method in which there is an accounting for ACM also, there is an accounting for fair value also. Who is that? FVTOCI. FVTOCI captures the EIR accounting of ACM. FVTOCI also captures the fair value accounting of FVTPL. I want both. These people who are having dual objective, that fellow will follow FVTOCI. Okay, sir. Then you will apply FVTPL in any other case. So C plus D also is any other case. Sir, then you can write C plus D only? No. No, sir. C plus D definitely FVTPL because I want to trade. Now that I want to trade, I am not going to stay till maturity. When I am not going to stay till maturity, all your contractual cash flows I am not going to receive. When anyway cash flow you are not going to receive, how will I compute EIR for you? It's not even possible to apply ACM or FVTOCI because ACM and FVTOCI come with EIR effect. EIR means effective interest rate. That means your cash flow should be constant. And I am not going to stay till maturity. How can I apply EIR, sir? I should have some same. No, sir, I can't stay with maturity till with you. I'll sell you definitely. How can I apply EIR? I can't. So I want a method where EIR is not there. Which method is that? FVTPL. Next, my intention is to sell. Daily morning I will watch the market. Price increased, price increased. So I'm interested in fair value. I'm not interested in interest income. So you should apply FVTPL. This is classic C plus D wala case. What if your D point failed? D point failed. D point failed ka meaning is the cash flows the financial asset gives me a right other than SPPI. If it is other than SPPI, I'll show you some example for that. D point fails. Once you fail your D point, no sir, you can't apply ACM. You can't apply FVTOCI. You don't have any choice other than to apply FVTPL. Sir, show me how D fails. Watch this. You tell me whether SPPI test is passed or not in this example what I am telling you. There is a bond, sir. A bond ka maturity is 3 years. Here I will get coupon of 100. Here also I will get coupon of 100. Here I will get coupon of 100 plus I will get maturity value of 1000. Tell me, what I am earning? I am earning fixed cash flows on specified dates. In that interest income is also there. My principal payment is also there. It's a classic case where SPPI test is passed. Okay, now I'll tell you another example. You tell me where SPPI test is passed or not. This is a story of zero coupon bond. Zero. Bond is issued for 750. I purchased this bond. First year, I won't get anything. Second year, I won't get nothing. Third year, I will directly get 1000 rupees. SPPI test passed or failed. SPPI test passed or failed. Passed. How passed? Bond is issued at discount but redeemable at par. Sir, my first year interest, second year interest, third year interest, I am not receiving every year, but ultimately I am receiving or not indirectly? Yes. If you want to take your calculator, write 750 plus 10% plus 10% plus 10% and see. 750 plus 10%. On that again plus 10%. On that again plus 10%. You will almost get 1000. I planned this instrument in such a way that the investor will get a compounded return of how much? 10% interest. He will not receive cash flow every year, but ultimately he will get the cash flow along with interest on interest also. This also is a case of SPPI passed. Now last example, with this you will understand D point more clearly. 1, 2, 3. I purchased a bond, sir. A bond will pay me 100 here, 100 here, 100 here. Face value is 1000. That fellow won't give me 1000. He will give me 10 shares. 10 equity shares of X Limited. SPPI test passed or failed. I invested today 1000, sir. First year 100, second year 100, third year 100. Third year reading the 1000 also should come, no? It won't come. 1000 place they are giving me what? 10 shares. You tell me, sir, after 3 years, our 10 shares ka value will be 1000. we don't know how much it will be, correct? It can be 2500 also, it can be 800 also, I do not know, but definitely it can't be 1000 unless by pure chance. Okay, now this, is it passing SPPI test or not? Why no? Interest I am getting, but will I get back my principal for sure? No. You invested how much principal? 1000. Is there any guarantee that you will get 1000? You may get more than 1000 also, you may get less than 1000 also. That means a bond is giving you a right to claim cash flows other than principal. You will get cash flow based on what? Equity shares ka worth. Equity shares, if you sell, equity shares ka market value cash flow you will get. That need not be matching with your principal. Your SPPI is gone for a toss. SPPI test failed. D point A failed. When D point A failed, no sir, I don't care with your intention. When D point fails, you can't apply ACM, you can't apply FVTOCI. You have to settle with FVTPL. Why sir, I want to apply ACM? No sir, I want to hold till maturity. Okay, apply ACM. What's the first principle? Initial recognition at fair value adjusted to transaction cost. That you will do it after that. On every year, what will you do? Interest income should be measured based on, work out EAR and show me. Even if you want to apply also, you can't apply. They are not rules. They are your inability. How will I work out EAR? Sir, if I have to work out EAR, my cash flow should be fixed. No sir. It 10 shares ka market value after 5 years or 3 years. How will I know today? If cash flows are not fixed, how can I work out IRR? I can't work out. It's not like the standard is prohibiting you. You can't do. You can't do. Same reason FVTOCI also you cannot do. Because FVTOCI also EAR is there. That's why ACM is not practicable for you. FVTOCI is not practicable for you. You don't have any choice other than to follow FVTPL. Are you getting it, sir? Why these rules are like that? So, once again, sir, to repeat it, A plus D, if you satisfy, you will apply ACM. B plus D, if you pass, you will apply FVTOCI. Any other case, you will follow FVTPL. If B plus D was a case where you are following FVTOCI, tell me, sir, FVTOCI principles, initial recognition should be fair value adjusted with the transaction cost. Interest income should be measured under EIR as if you are following ACM. On every balance sheet date, compulsorily you have to fair value. Gain or loss will go to OCI reserve. Correct? Up to here you remember? Now, when we learnt investment in equity shares, the previous concept, what did we say? I accumulated gain or loss in OCI reserve. Recycling permitted or not permitted? Not permitted. Here it is permitted. Here it is permitted. If you follow B plus D, okay, B plus D you satisfied, and FVTOCI is applicable on you, OCI reserve whatever is there, one day if it gets realized, the standard says happily it can be recycled to PRL on disposal. So just now only you told it cannot be recycled. Array sir, the investment for equity. This is which concept? Other than equity. Okay, if I'll tell you another blunt rule, remember this. Entire standard law, sir, recycling is not permitted only in one case, which we just now covered. Investment in equity shares measured at FVTOCI, OCI reclassification is not permitted. Rest all cases lo, each chapter lo, reclassification is allowed. That's all. One more will come. Okay, one more will come relating to financial assets. Financial assets point of view only two, sir. One is equity, one is other than equity. Equity not permitted, other than equity permitted. Sir, why is it permitted here, sir? There is a logic, sir. What is your objective? Dual objective. I want to hold, I want to sell. I am seeing both of them. I made a deal with her like, we'll travel, we'll see what will happen. So, if something happens, there is no surprise. I am having very clear thought from the very beginning. If it works, it works. It doesn't work, doesn't work. So, it is that. My sir, objective means it's not your stupid intention. It's a written, documented policy of the company. So everything can be verified in real life. Okay. So if I suddenly sell the investment, it's not like I came out of my objective. No, I always had the intention of selling it. Of course, I was also having the intention of holding it. So if you hold also, it's okay. If you sell also, it is okay. That's why even you ultimately you sell it, the standard will not prohibit you to recycle. They'll happily allow you to recycle. Here, this is very, very serious case, sir. You following FVTOCI for investment in equity shares, standard takes it very, very seriously. I'm giving you a choice. exercise that, there is a consequence for that. What is the consequence? A OCI result will not allow you to take it to PRL in no case. And you select FVTOCI, again you can't come back to FVTPL. That is irrevocable option, only one time choice. So these are the stories in that. Okay, concept number 3, or not yet, sir. Listen. Now we'll come, this concept number 3 will come back while doing case number 4. Come here. Now for financial assets we have certain special cases. Now broadly if I'll show you, special cases, first one staff loan, very important, extremely important. Second one is security deposit, important, once came for 8 marks. Demand deposit, cheap. This came for 8 marks. Loans within the group, the parent giving loan to subsidiary, subsidiary giving loan to parent. These 3 are important cases, sir. Remaining are normal. Okay, now let us start with a proper level question, sir. Okay guys, come here. Sir, is staff loan concept, before I discuss that with you. In this book, sir, I've included one small question, question number 4. Just go through the question once. It's a very, very interesting question. Your concept base will be slightly at a next level if you understand this question. Easy only, go through it. Page number 27.6 in this book. Otherwise watch on the screen, nothing much. On 1st January 20X1, T Limited bought a rupees 1 lakh 5% bond for 95,000. So 1 lakh face value, 5% coupon rate, you purchased it for 95,000, incurring issue cost of 2,000. So transaction costs are also there. Interest is received in arrears, means end of the year. The bond will be redeemed at a premium of 5960 over the nominal value of 31st December 20X3. That means a bond life is 3 years. At the end of 3rd year, it will be redeemed at premium. The question itself is nicely telling you that your effective interest rate of return is 8%. So summary, sir, face value 1 lakh, coupon rate is 5%, you purchased it for 95,000, transaction cost you incurred 2,000, redemption premium is there 5960, EIR is 8%, life is 3 years. First year ending fair value is 1,10,000, second year ending fair value is 1,04,000. Now, explain with calculations how the bond would be accounted for all the years if, first case, T Limited's business model is to hold bonds until the redemption date. What is the meaning of this? Holding till maturity means point number A, objective A is satisfied. Since that is a debenture investment, D is automatically satisfied. A plus D is satisfied. Which method you have to apply? ACM. Now you tell me, ACM ka initial rule please. Fair value adjusted with transaction cost. At what rate did you buy? 95,000. How much transaction cost did you pay? 2,000. 95 plus 2. 97,000. So your initial recognition is done at 97,000. What is the EIR given in the question? 8%. So apply 8% on 97,000. You will get 7760. First year coupon, sir. What's your face value? 1 lakh into 5%, 5,000. So 5,000 you collected. This is balancing figure. Since I am following ACM, I should not be rating fair value and all. Whatever balancing figure comes, just shut up and write that. Come to second year. Second year starting point again, opening balance. Again apply 8%, I got 7981. Again receive 5,000, 5,000. Again balancing figure. Third year. Again opening balance, again interest income, again cash amount, whatever you are going to receive, account tallies off. Sir, why account tallied? Surprise, Adi? Account becoming 0 is surprise. Under ACM, no. I identified all the future cash flows, then only I will work out EIR. No, sir, my EIR 8% factors all my future cash inflows. So suddenly account becoming 0 is no surprise for us. Natural. Okay? Now, point number B. Think here. B point important, sir. Please read. T Limited business model is to hold bonds until redemption, but also to sell them if investment with higher returns become available. He is directly telling, I'll stay with you till I find somebody better. Holding till maturity, but can be sold also. Dual objective. B plus D satisfied. Which method? FVTOCI. Now FVTOCI initial recognition. Fair value with the transaction cost. I'll still apply EIR. I apply EIR. But closing balance should be at fair value. Now come here. First year 97,000. You apply EIR 7760. Sir, how did you get 7760? 97,000 into 8%. Once do that on your calculator. Simply do, sir. You got really very nice. You received how much? 5,000. Closing balance you have to record fair value. The account will not tally. Gap will come. This I will transfer it to OCI reserve. If I don't fair value, sir, the account ka balance would have been 99,760. But because I fair valued, I wrote closing balance as 1,10,000. So 10,240 rupees is a fair value gain. Do you all understand? Since you are following FVTOCI, the gain will go where OCI reserve kit will go. Clear ma? Come to second year ka opening balance. What is second year ka opening balance now? 1,10,000. Come to second year ending. You have to record interest income. You have to record interest income. For recording interest income, you take this 1,10,000. On that, if you apply 8%, you should get 8,800. There only you will burn your finger. The wrong answer. Sir, ACM calculation EIR whatever is there, 8%. Here also same 8% only you have to use, no? 8% calculation which all numbers did you factor? Initial outflow, future inflows. Fair values are factored in that. How can you apply 8% on opening balance fair value? The wrong number. Sir, then what should I do? ACM lo whatever number you have, copy from here. E number first year, E number second year. First year when you did FVTOCI, you never had a problem because ACM ki FVTOCI ki starting point same. But when you come to second year, ACM ka opening balance will be different, FVTOCI ka opening balance will be different. So you cannot apply 1,10,000 into 8%. So what you should do? First go to previous ledger account. ACM lo what number is there, identify that. Number you copy paste here. It's not capital, sir, copied. My stupid typist wrote it wrong. Okay, it's all copied from ACM. So, sir, if they ask us FVTOCI accounting, should I first do ACM accounting? You can prepare an ACM table. Prepare ACM table, interest strip whatever is there, that you copy paste every year. Are you understanding, sir? Only the interest part of ACM is relevant here. This is a specific case, sir. Earlier we did one question, investment in equity shares measured at FVTOCI, correct? At that time, principal was not applied because that is not an asset where you earn interest income. Here you are earning interest income. So you have to apply EIR, and you have to apply EIR not on the fair value. Had you followed ACM, what interest income would have come to you, that number you have to record here. So you should be very, very careful with this. So anyway, 7981 I copied. Closing balance again fair value. E gap came to loss, again transfer to OCI reserve. Now come to third year. Third year also repeat. Again loss came. This also went to OCI reserve. Okay. Now, is investment in equity share or investment in bond? This one. Investment in bond. OCI reserve is allowed to be recycled or not? Yes. Take your calculator now. First year how much gain did you get? 10,240. Right? 10,240. That much gain is there. But second year you got a loss of 8981. Remove that loss. 10,240 OCI reserve lo you parked. Again there is a loss of 8981. Remove 8981. Third year again loss came. 1259. Remove that also. How much are you having? 0. How did it become 0? You told we can recycle it. But actually OCI reserve lo balance is how much? 0. Sir, why is it 0? Why won't it be 0? What is your objective? Hold till maturity, or it can be sold. But ultimately what did you do? You held it till maturity. That means whatever cash flows are going to come, you collected everything. Did you sell? When you never sold, how will you get fair value gain in your face? Whatever fair value reserves you created, everything automatically gets cancelled. OCI reserve will not be there for you. It naturally dies. Why it naturally died is, you held the investment till maturity. Imagine, sir, third year beginning you sold off the investment. Third year beginning you sold off the investment for its fair value of 1,04,000. Now, by the beginning of third year, your OCL some balance is there. You can check. 10,240 first year. Second year 8981. How much balance is there? 1259 balance is there. That will be recycled to your PRL. So, fair value gain if you want to enjoy, compulsorily you have to sell it. If you hold it till maturity, how will you get fair value gain? you'll get only contracted cash flows. Contracted cash flows, then income is only EIR. That anyway you recorded. Fair value gain naturally will die, sir. OCI reserve will get cancelled naturally. But if you sell the investment, then our OCI reserve, some balance will be left over. That you will recycle it to PRR. That you can't observe in this question because I held the investment till the maturity date. Okay, this will give you like one overall view of how to apply ACM, FVTPL and FVTOCI. Accounting, if it is you are having clarity, sir, is standard and nothing is there. It just you have to see more examples. That's all. Let's go to one's first special case on staff loan. Question number 6 is there. Question number 7 is there. Okay, 6 we will do. 7 also will do. 2 questions will solve. One will see, one we will do. Okay, chalo. Come to question number 6. On 1st April 20X1, Star Limited has advanced a housing loan of rupees 15 lakhs to one of its employees at an interest rate of 6% per annum, which is repayable in 5 equal annual installments along with interest at the each year ending. So 15 lakh loan you have given, 5 installments so that fellow has to repay. You gave loan at the rate of 6%. And he says, employee is not required to give any specific performance against this benefit. The market rate for similar loan for housing finance by the banks is 10% per annum. What is he trying to say is, market law, people charge 10% for this kind of loan, but you gave it only for 6%. Why? Because he is our employee. You love your employee, so you gave loan to him at a lower interest rate. Okay, sir, continue. The accountant of the company, he will do some silly thing. Has recognized the staff loan in the balance sheet equivalent to amount of housing loan disbursed, 15 lakhs. The interest income for the year is recognized at the contracted rate in the statement of P&L by the company, which is 90,000 rupees. Analyze whether the above accounting treatment made by the accountant is in compliance with the relevant Ind AS. Sir, in all this kind of questions, accountant will definitely mess it up. Okay, you chartered accountant will go and correct it. If not, advise the correct treatment of housing loan, interest and other expenses, blah, 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 blah. Okay, fine. Now, watch this, sir. What is the loan amount given? 15 lakhs you have advanced. Contractually 15 lakh rupees you have advanced. Number of installments is 5 equal annual installments. That means in your annual installment, each installment will be equal to rupees 3 lakhs per annum. Apart from 3 lakhs, which is the principal portion, you also have to pay interest at the rate of 6%. How much is that rate given? 6% per annum. 6% on which? On outstanding balance. Now, sir, if I plot all these cash flows, year 1, 2, 3, 4, 5. My principal cash flow, first year will be 3 lakhs, second year also will be 3 lakhs, third year will be 3 lakhs, fourth year 3 lakhs, fifth year 3 lakhs. This is the principal. Apart from this, I have to also charge interest at the rate of 6%. Tell me, sir, throughout first year, how much loan was outstanding? 15 lakhs. 15 lakhs into 6%, 90,000. First year ending, that fellow paid off 3 lakhs to us. So how much is outstanding now? 12 lakhs. 12 lakhs into 6%, 72,000. So, since 3 lakhs is paid, 3 lakhs into 6%, 18,000 rupees interest reduction is happening. You understand the pattern? 90 became 72. Now 72 will become how much? 54. 54 will become 38. How much is that? 36. 36. 36 will now become 18. Every year 18,000, 18,000, 18,000. It's coming down. Why is it coming down? As you pay 3 lakhs, 3 lakhs, 3 lakhs. 3 lakhs into 6% also we need not pay in the next year. So interest. So total contractual cash inflows. Add these two. 3 lakh 90,000, 3 lakh 72,000, 3 lakh 54,000, then 3 lakh 36,000, then 3 lakhs 18,000. Guys, these are all the cash inflows that you are going to receive in future from your employee. In this cash inflows, how much interest rate is there? You only computed now what are looking at my face. How much interest rate is there? 6% interest is there, correct? Now, sir, if this employee fellow goes to the bank and tell the bank that bank, I will pay you all this money. How much loan will you give me? Will you give me 15 lakhs? So will the bank give 15 lakhs to him? Why? Why bank will not give 15 lakhs? Bank will say, Arey, who told you that interest rate is 6%? The interest rate which I will charge is how much? 9%. If this is what you are going to pay me in future, then I won't give you 15 lakhs. I'll give you something less than that. How much is that? How will I know? Simple. What you do is take PV factors at the rate of 9% and discount all these cash flows to today. Market rate is how much? 10. Even better. Okay. 0.9091, 0.8264, 7513, 683.621, 6209. Correct. 6209 is fine. PV factors first 5 years. Marry them. Present one. Fatavat, do it. Don't see and tell. Correct answer. No. Total. 13,54,000. 602. Okay, sir. Others stop doing. It's enough. Why do you do unnecessarily, sir? Watch this. Focus on this. This is called as fair value of the loan. That means, understand, the moral of the story is, for the cash inflows what the employee is going to pay to us, considering the market interest rate, that boy actually deserves loan of only 13,54,602. If I exactly give 13,54,602, then it is like I am earning a return of 10%. But my kind heart made me give how much amount of loan? 15 lakhs. So actual amount given is how much, sir? 15 lakhs. So how much money did you give over and above the fair value? Excess amount 1,45,398. This is towards my, correct, no, sir? So because he is my employee, I did a transaction other than fair value. If he is not my employee, will I give 15 lakhs for this? I'll give only 13,54,602. Because you are my employee, I gave loan to you at a lower interest rate. Correct? I did some favor for you. What is the favor amount here? 1,45,398. Now you tell me, sir, from a company point of view, whatever loan we have given to the employee, what is the objective of that loan? To collect or to sell? Will I sell my employee loan to somebody else, sir? No, sir, I will only collect it. So purely the objective is to hold till maturity. So which method is appropriate? ACM. Tell me ACM initial rule. Fair value adjusted with the transaction cost. I don't have transaction cost. So answer will be at fair value. If I write my first entry at beginning of year 1, my entry will be this. Staff loan, which is a financial asset, okay? It should be debited only with 13,54,602. To bank, I paid an amount of 15 lakhs. 1,45,398 rupees I have extra given to the employee. Now, you have to check. Normally, sir, in staff loan, one inherent condition will be there. Suppose I give a loan to you, interest-free loan or a concession interest rate loan. Can the employee say, thank you very much, sir. Okay, this is my paper. I'm joining some other company. I will keep on paying the loan for the next 5 years. Thank you for bearing. He goes away. Will you accept it? So primary condition is what? Employee has to stay in service till the loan period. The basic implied condition. He need not come and dance in front of me every day. But he should not leave the company also for the next 3 years, correct? Or 5 years in this case. So, by giving a concession interest rate loan, you are indirectly blocking the employee in your office only for the next 4-5 years. First, making him stay for the next 5 years, you gave him today an extra amount of 1,45,398. There is no love and all. It's all business. So, since it is for future benefits from service, you will debit it to prepaid staff cost. Normal prepaid expense, sir. You don't like that name, change the name. Sir, hereafter what will happen? Hereafter what will happen? This financial assets, sir. On this you will go and apply ACM. Money I don't know where he will spend. He will spend off an employee fellow. Prepaid staff cost will be amortized to P&L account. So expense to PRL on straight line method basis. Divide, sir, 145,398 divided by 5. 29,080. 080. Okay, 080. Every year this much amount, keep on transferring. Khatam, game over, only this much. 080 is wrong answer. 0? Okay, fine, correct answer. Okay. Okay, now, the accounting will keep on happening, sir. Now, you tell me, now that it's a 5-year loan, nobody asked you 5 years accounting in this sum, but still, 1, 2, 3, 4, 5. Don't worry, I'm not so innocent to read so many entries. Tell me, sir, ACM ka every year entry, financial asset account debit to interest income. Next, that fellow will pay you money every year. So as you receive the money, you credit your financial asset. A prepaid staff cost account, every year, amortize it to P&L account. D point, identify the closing balance of the loan each year. If 4 things you keep on doing, sir, do it like this for a period of 5 years, a staff loan account will become 0. A prepaid staff cost will become 0. Whatever money you gave to that stupid, that fellow will pay you back also. Everything will be neatly closed. Okay. On the first day, you recorded this at what number? 1354,602 into, what is your interest rate? 10%, market interest rate. Apply 10%. So you will have 1,35,460. Leave chiller. 135,460. How much money will he pay you in the first year? 3,90,000. Collect that. 3,90,000. Prepaid staff cost ka amortization 29,080. First year ka closing balance. Take your calculator, all of you. Initially you recorded at what value? 1354,602. You added 10% to that. 1,35,460. Total receivable. Out of that we collected already how much now? 3,90,000. Money came off already. So still receivable is how much? 11 lakhs 62. This one, really? Okay, nice. So like that, if you keep on doing, sir, towards the end it will become 0. In this, nothing you can miss. As it is only you have to do. Here most important one is this one. If you don't work out closing balance correctly, next year ka interest is gone. Thereafter, subsequently everything is gone. Okay, one number can change your life. So a closing balance correctly you post. And this kind of presentations don't do in the exam. Nobody likes a smart ass. Okay. So if you try to show off, no sir, they will. Sir, then they give you 12 marks or 14 marks. You try to pull off something like this kind of trick. You lose marks, sir. They expect you to write year on year entries. They don't want to show an Excel sheet of the entries. Labor work. Do. 14 marks it's coming, no. So do. But just, E-class this is okay. But normally I also wouldn't have done that. Are you understanding, sir? See, my objective is to make you teach that these entries are common every year. Numbers will change obviously. Okay. Now, do me one small favor. Tell me numbers again. If I want to prepare a ACM table. How many years? 1, 2, 3, 4, 5. Okay. Opening balance 13,54,602. First year ka interest income 1,35,460. This is done at the rate of 10%. My cash inflow received 3,90,000. Closing balance 11,62. Second year also you do 11,62. 1,10,001. 6. Okay. Second year cash inflow, please. 3,72,000. 838,068. Like that it goes on, sir. If you come to the end of 5th year, 100% it will become 0. If 1 rupee, 2 rupee chiller and all is left, adjust in last year ka interest and make it 0 there. It will 100% become 0, sir. There is no doubt in that. Okay, now my point is, I am standing at the end of the first year and I am preparing balance sheet. In the balance sheet, I have a staff loan receivable. This is very clearly asset, that too financial asset. How much amount am I having? 11,62,000. I want you to tell me in this how much is current, how much is non-current. Because we studied Schedule 3 for a reason, no sir. So tell me, how much is current, how much is non-current? 3,72,000 is current. I am already standing at the end of first year. My total receivable is how much? 11,62,000 rupees. In this, how much is current? The meaning is what? Current as a definition is what you tell me? Any one out of the 4 criteria. Correct? I can't apply operating cycle. This is not held for trading. This is not cash and cash equivalent. That leaves me only with one choice. That amount which is collectible within the next 12 months. Next, out of this 11,62,000, how much is collectible within the next 1 year? That is current. Remainder is non-current. Tell me, how much is collectible within the next 1 year? Sir, are you blind or what? It's visible there now. How many times will you ask? Arey, this 3,72,000 next year ka interest will be included. Next year ka interest will not be part of this. But in next year ka interest will be part of this. Be careful. So, next year 372,000 I am collecting. But at 372,000 next year ka interest also will be there. Next year ka interest is how much? 1,10,006. So, 3,72,000 I am getting. In this next year interest also will be there in that. Remove that. 1,10,006. In net figure is how much now? 261,994. What is this 261,994? Out of this 11 lakhs, some principal amount is collected in this. Our number is current asset. Remainder is non-current asset. General mistake is the entire number people call it as current asset. That is wrong. Why wrong? Next year ka cash inflow, next year ka interest will be there. The interest became due at the end of second year. So then how can it be there in this first year ka closing balance? It can't be there. So 11 lakhs 110 is not there, but 372 110 is there. I want to know out of this 11 lakhs how much is collected here. So how should I do it? From 372 remove 1,10,006. That is the principal amount which is going to be collected within the next 1 year. Now, can you guess this one now? Total 11,62,000, sir. In the 261,994 is current. Remainder is non-current. How much is remainder number? 8,38,000. Can't you find some shortcut now? Yeah. So instead of working out this, be smart. Next year ka closing balance is non-current asset. This you take it as balancing figure as current asset. Are you getting it, sir? First logic you understood. Understood. But you feel convenient with the second one. First one is better for you. Both are equally good. Second one is good. Don't follow second one, stupid people. Adi, sir, second one is convenient, but it will not work always. Watch this. In second year, watch carefully. What is your interest income? 1,10,000. What is your cash flow? In some it is okay, it will work. Imagine, sir, in some other cash flows, the number is only 72,000. What does it mean, you know? Next year ka cash flow does not even recover next year ka interest only, which means nothing out of this is getting collected in the next 1 year. It is entirely non-current asset. So a shortcut if you follow means it will work everywhere. This shortcut what you are seeing will not work everywhere. In particular some it's working because next year you are recovering more than your next year ka interest. So some portion of current year outstanding is getting recovered. So next year ka closing balance you can take it as non-current, this you can call it as current. But imagine a scenario where next year ka interest is 110, your cash flow is only 72,000. In that case, your next year ka cash inflow is not even recovering next year ka interest. Principal definitely is not getting recovered. It is totally non-current. Be watchful. Shortcuts don't follow. Some stupid wrote that in his book. Wrong answer. It will not work always. I have that kind of question also where it will not work. So shortcuts sometimes are dangerous. Don't follow. So original technique you keep, they always safe. Sir, any doubt in this? So you just have to remember one small entry. Staff loan, prepaid staff cost to bank. Staff loan you will go and apply ACM. Prepaid staff cost you will go and amortize it using straight line method. Clear? Easy? Okay. Okay, sir. This is one question number 6 on staff loan. Okay, come to question number 7. This is the biggest question that has ever come on staff loan model. When it came for 12 marks. You see what is different in this. Wheel Company Limited has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. Mr. X, who is executive assistant to the CEO of Wheel Company Limited, took a loan from the company on following terms. So our company gave him a loan of 10 lakh rupees principal amount. Interest rate is 4% for the first 4 lakhs and 7% for the next 6 lakhs. The starting date is 1st of January 20X1. Tenure is 5 years. Prepayment is also possible at the option of the employee. So, the principal amount of the loan shall be recovered in 5 equal annual installments. That means 10 lakh rupees divided by 5. So, your each installment would contain 2 lakh rupees principal payment. And he says, and it will be first applied to 7% interest bearing principal. Normally, sir, on your loan you will have one interest rate. This fellow is having dual interest rate. For 4 lakh rupees interest is 4%. For the 6 lakh rupees amount the interest rate is 7%. And now he is telling that as and when the employee pays the installment, the first installment will be used for killing this 7% principal. Once that 7% principal is exhausted, last 2 installments are towards 4% principal. That's what he's trying to communicate there. The interest shall be paid on annual basis. Okay, along with the principal, you also have to pay interest. Mr. X must remain in service till the term of the loan ends. That's a condition. The market rate of a comparable loan available to Mr. X is 12% per annum. So the market interest rate. But actually we are giving loan at what rate? Some at 4, some at 7. But definitely not at market interest rate. It is below market rate loan. Now that it is a below market rate loan, is the company giving some benefit to the employee or not? Yes. And for that the employee is supposed to stay in the service for a period of next 5 years. So definitely a gap will go to prepaid staff cost account, just like in the case of previous example. Then the following table shows the contractually expected cash flows from the loan given to Mr. X. If you remember, sir, in the previous sum when we were solving, contracted cash flows we worked out. These numbers question did not give. Question give the data. With that, principals we calculated, interest we calculated, we identified the contractual cash flow, then we discounted and we got the present value, which is the fair value of the loan. But in this sum, loan ka cash flows that fellow only gave 10 lakh rupees outflow. First year, second year, third year, fourth year, fifth year. Coupon, principal installment 2 lakhs. Interest income on how much amount? 6 lakhs. 6 lakhs. On 6 lakhs it is 7%, 42,000. On this 4 lakhs it is 4%, 16,000. So first year ka cash flows are given to you. But by the end of first year, you repaid how much principal? 2 lakhs. So for second year, how much is outstanding? 8 lakhs. In that, 4% is 4 lakhs, 7% principal is another 4 lakhs. So like that, 7% 4 lakhs 28,000, 4% 4 lakhs 16,000. Like that for all the 5 years he computed the total cash flows. And ultimately principal will become 0 by the end of 5th year. That means basically planned contractual cash flows you should not or you need not work out. Question already gave. If you want to work out, you work out, you will get the same numbers. Then, this is Mr. X, sir. Mr. X prepays rupees 2 lakhs on 31st December 20X2, reducing the outstanding principal as on that date to 4 lakh rupees. This is the only twist. Now, loan ka starting date is 1st January 20x1. First year ending 31st December x1. Second year ending 31st December 20x2. So by the end of second year, he should have paid how many installments? 2 installments. First year one 2 lakhs, second year one 2 lakhs. But stupid what he did, second year ending, he prepaid. Means third year, fourth year, fifth year, another 3 installments are there. In that one installment, he paid off on second year only. It so happened now that by the end of second year only, he already paid 3 installments. So remaining how many installments are there? 2 are there. So originally it is planned as 5 installments over 5 years. But by the end of second year, he already paid 1 installment extra. So 3 installments he paid. The following table shows the actual cash flows from the loan given to Mr. X considering the prepayment event on 31st December 20x2. This is originally planned cash inflows. These are actual cash inflows. Actual cash inflows, how are they different is, first year nothing different, sir. But in second year you observe, you are receiving how much amount? 4 lakhs. So third year you will receive another 2 lakhs, fourth year you will receive another 2 lakhs. But fifth year you will not have any cash inflows to receive. Why? All the installments will be completed by the end of fourth year itself, and fifth year there is nothing more to receive. So effectively he is trying to prove that by the end of fourth year only loan ka drama will get over. Your financial asset must be cancelled by the end of fourth year itself. Though originally it is planned for how many years? 5 years. He is asking, record journal entries in the books of Wheel Limited considering the requirements of Ind AS 109. Now, it's quite an important question only. So let's see how to handle this. So first and foremost, you have to always work out the fair value of staff loan. And remember this. The term fair value means market based measurement is called as fair value. Official definition and all is there, that's no use for you. Fair value means market based measurement. If it is a listed equity share, market price is the fair value. Listed bond, market price is the fair value. Sir, are they unlisted? How will I know? If bond is unlisted, go and work out fair value using your bond valuation chapter. In AFM there is a chapter called as bond valuation. How will you work out the value of the bond? Present value of your future cash inflows discounted at YTM rate. That only is your fair value of the bond. You apply that technique. So, loan is nothing but it's a kind of bond only. No, sir. Bond is a security form of loan. Without security, if you issue money, that is called as loan given. With security, we call it as bond or debenture. Okay, so any kind of loan transaction ka fair value is nothing but present value of future cash flows discounted at market rate, market interest rate. Not only in this sum, any sum, loan ka fair value is nothing but present value of future cash flows at market interest rate. Now, in this particular sum, your cash flows originally are planned across how many years? 5 years. And your cash inflows are, see the question and answer, sir. First year ka cash inflow is this one only, 2,42,000 plus 16,000, 2,58,000. Second year, how much is second year? 2,28,000 plus 16, 2,44,000, 2,44,000. Next, how much? 2,30,000, 30,000. Next 2,16,000 and 2,08,000. So these are your contractual cash inflows. Market interest rate is given as how much, ma'am? Here they give you market interest rate is 12%. If you want to know the fair value of anything, discount all the loan cash flows using what rate? Market interest rate. Market interest rate is given as 12%. See, if every year cash flows are same, I could have applied annuity factor. That is not same, no. So I am doing individual PV factors. So this will be 0.8929, 0.7972, 0.7118, 0.6355, 0.5674. Multiply all this. Final answer we want. Individually don't fill up and waste your time even in the exam. So fair value of staff loan 843,000, 886. Okay. Some rounding of error, doesn't matter. Okay. So for the amount of cash flows you are going to receive, if you want to earn an interest rate of 12%, you should ideally invest on him only an amount of 843, 886, not a rupee more. But since he is your employee, you want to exploit him. What you did, you actually gave him amount given as loan. Official loan amount is how much, sir? 10 lakhs. So what is the excess amount you have given now? 1,56,114. Is the excess amount you have given. For this excess amount, what you have paid to the employee, that fellow will work in your office for a period of 5 years. It's a kind of a prepaid salary for using which you will make him stay. Now, the accounting he is asking for entire 5 years anyway. So watch this here. So staff loan account debit to bank. Staff loan, you must understand the logic like this. Staff loan is a financial asset on which accounting is applicable? ACM. Since ACM is applicable, initial recognition should be done at fair value adjusted with transaction cost. I do not have any transaction cost. So fair value. Fair value number is how much? 1,56,000. Sorry. 8,43,886. But I am giving an amount of 10 lakhs. The extra amount, whatever I am giving, this we will debit it to prepaid staff cost account. And this prepaid staff cost account, on this you have to apply SLM. Divide by 5 and tell me the number. 31,223. Okay, some number like that. 223 per annum over a period of how many years? 5 years. This is first day accounting, sir. Now, at the end of each year, like that, for how many years I have to do accounting? For 5 years I have to do. But as I go into the years, I understood that that fellow made a prepayment, and as a result, 5-year loan eventually came down to only 4-year loan. So overall I have to do accounting for how many years now? Only for 4 years. Okay, now how to do this is year 1, year 2, year 3, year 4. Sir, examiner, don't do columnar accounting and all, you'll pakka lose marks. This is wrong. Okay, you have to do one by one only. Let me start. So first and foremost, financial asset ACM. So staff loan account debit to interest income in the first entry. Second entry, contractual cash flow received. Bank account debit to financial asset, bank to staff loan. Third, a staff cost account, prepaid staff cost, whatever is there, that you kill it to your P&L account, prepaid staff cost. D, I want the closing balance. So on the very first day, 843, 886 we got into, what is the interest rate you have taken? 12%. Please apply the 12% on this. 101, 266, 101, 266. First year ka cash inflow. First year everything went as planned. He pays exactly 2,58,000. The amortization number 156,114 divided by 5 came to how much? 31,223. So 31,223, 31,223. Closing balance of first year. You start with this opening balance, you debited this, you credited this. So closing balance 687,152. Sir, if you are not writing, at least do on your calculator. No, sir, it will just speed in your thought process, nothing else. So you will have 687,152 closing balance of first year. On that you have to compute interest for the second year. Into 12% you do. 687,152 into 12%. 80, 458. 82,458. Second year ending, he is actually making a prepayment. How much prepayment did he make? 2 lakh rupees extra he paid. If you want, you can write 4 lakhs as it is, plus the interest whatever it is there, or you can handle prepayment separately. Anyway, when adjustment will come, I will do prepayment separately. Now what I will do is, originally planned cash flow is how much? 244. You take that first. There is no problem if you add 2 lakhs and write. Nothing will happen, sir. I am writing like this, see how it works. If you don't take, I'll change it. 31,223. This will not, same number is same. Tell me, closing balance. 525, 610. Okay, 610. Okay, fine. 525, 610. This is at the end of second year. Don't immediately jump off to third year and start. Why? Second year a lot of drama happened now. What did he do? He made a prepayment. Now, sir, look at this. At end of year 2, this fellow made a prepayment. Now that he paid you money, you don't have a choice now, sir. You have to debit bank account. How much prepayment happened? 2 lakhs. 2, you will credit to your staff loan account because you collected money. Because of this, the carrying amount of staff loan from 525 610 minus 2 lakhs just now you removed, another you will have 325 610. Now sir, you tell me, this is a planned cash flow or surprise or no? Surprise. Now surprises are not planned, no sir, obviously. So did your cash flow stream disturbed or not? The moment your cash flow stream disturbed, ACM will fail. ACM will fail. ACM ka technique is compounding technique, sir. It only believes ACM will work as long as your closing balance represents the present value of future cash flows discounted at your EIR rate. If you disturb your future cash flows ka date or the timing of them, gone sir. ACM will fail now. Now, in this case, this fellow did one payment extra 1 year before. Earlier he paid off. Because of this, future cash flows also got disturbed. Now, because of the prepayment, ACM is disturbed. ACM will not work, sir. Third year, fourth year, innocently you write entries, account will not be closed. You will still have some balance. That's not balancing figure also. Pakka, it's wrong answer. Now you have to set it right and then do the reverse accounting. Now, sorry, 0, 1, 2, 3, 4, 5. Mind you, sir, you are already standing here. Second year ending. Timeline point of view, it is 0 for you. Okay. What are your revised cash flows? That also question they give. See and tell. Already you have completed 2 years now. What are your remaining cash flows? 2,16,000 and 2,08,000. One will come in third year ending, one will come in the fourth year ending. You are already standing where second year ending you are standing. So you will receive 2,16,000 here, 2,08,000 here and nil here. Correct? And desired carrying amount of staff loan. If you have to apply ACM, then the carrying amount here should be what? Should be the present value of these two cash flows. Correct? Now you tell me, sir, 2,16,000 is how far from where I am standing? 1 year. So 2,16,000 into 0.8929. 0.8929 is 1 year ka PV factor. Don't apply third year ka PV factor. Don't be so naive. You are already standing at the end of second year. Cash flow is coming at the end of third year. How far is it? 1 year. If you multiply with third year PV factor, you are saying that it's 3 years far. That's wrong, no sir. You are already standing at the end of second year. Similarly, 2,08,000 is standing how many far? 2 years far. So 0.7972 second year PV factor. So you multiply. So tell me the final answer. 358,554. I want 3,58,554 in my staff loan account. What do I have? I have 325,610. Your ACM will work if and only if you have this number. But I have this number. What you have to do? Update. Staff loan account, increase it. So, what is the entry I should write now is staff loan account debit. Tell me the gap, sir. 358,554 I have. Sir, I want minus 325,610 I have. Tell me the gap. 33,074 64. Oh, 6 only here. Check once correctly. Which one 684? Oh, this number wrong. Why so wrong? Sad. Anyway, 358, 680, 680, 684. Okay. If you say so, 358, 684. 358, 684 minus 325, 610. How much now? 33,074. You update the staff loan. Now you tell me, sir, staff loan is a financial asset or financial liability? Financial. When asset value is increasing, that's good or bad for you? I mean, gain or loss, that's a gain. So ideally this gain should go to P&L account. But what your study material suggests is, you already have a open account called as prepaid staff cost account, correct? Now, a prepaid staff cost account, originally it was having a balance of 156,114. Out of this, first year you removed 31,223. The second year also you removed 31,223. You will still have some balance. Some balance is there, no? He says that a staff loan account, you increase it, instead of booking it as a gain, reduce your prepaid staff cost account. Logic I will tell you, but first do it. So prepaid staff cost account you nullify to the extent of 33,000. Now after you writing this entry, what is the revised prepaid staff cost now? 60,590, 594. This will be amortized over remaining how many years? 2 years. At the rate of divided by 2, 30,297 per annum. Now coming to the logic of why you have to credit to your prepaid staff cost account, understand this. Suppose, sir, I have two employees, this sir and this madam. To both of them, I gave 10 lakh rupees loan at 2% interest rate. Market interest rate is 10%. Market interest rate is 10%. I gave loan to her at 2%. I gave loan to sir also at 2%. Correct? Now, how much benefit am I passing on to each one of them? 10% market rate, but I am charging interest of only 2%, 2%. How much benefit? 8% benefit. Now I am telling you fact. The loan given to her is for 3 years. The loan given to sir for 10 years. Both the loan amount same, interest same, market interest rate same, but the tenor of the loan is different. She enjoys a concessional interest rate loan only for 3 years. He enjoys it for 10 years. Who is getting more benefit? Sir is getting more benefit because he is enjoying concessional interest rate loan for a period of 10 years, whereas she is getting benefit only for 3 years. Correct? Like that. Sir, originally when we planned the loan, a loan is supposed to give concessional interest rate benefit to the employee for a period of 5 years. But because of a prepayment, a 5-year loan became 4-year loan. I originally thought that our company expenditure is 1,56,114 because of this concessional interest rate loan of 5 years. But because that fellow made a prepayment, actually this much benefit will not be there to him. So you have to nullify this benefit because a 5-year loan is now becoming 4-year loan. 4-year loan benefit is there, but it will be lesser than a 5-year loan. So to this extent, staff loan balance will increase. Prepaid staff cost account has to be nullified. That's the reason, that's correct treatment. You understanding though? Now, after you write this entry, what is the revised balance of staff loan? It will come down to your desired amount of 358,684. 358,684, is it representing present value of future cash flows or not? It is. And shamelessly ACM will again work. What is there? Happily write the entries and close the account. No surprise. Come here. 358,684 into 12%. Tell me the numbers. Fast. Well, calculator should break. Do it fast. 40, 042. That only is that. Okay. Staff loan, how much will he pay me? 2,16,000 he will pay. Next year he will pay 2,08,000. This amount came to 30,297 now. Correct. 30,297. 30,297. Okay. Now year ka balance, sir. Third year opening balance you started with 358,684. To that you have minus 2,16,000 and you added 43,042. Tell me closing balance. 185,726. Now come to the last year. Fourth year is your last year, sir. Now actually 185,726 into 12% should give you correct answer, but approximation chance will be there. We will not take risk. My point is simple, sir. 185,726 plus some interest should be exactly matching with 2,08,000 and the account should become 0. So what you do, directly take the difference. 208,000 minus 185,726. How much is that? 14,000 plus 8,000. How much? 20? 22? 274. If you directly apply 12% also, you will almost get the same number. Because calculation all we did. We took 4 decimal PV factor and did. So our answer almost will match off also. If you directly do 185,726 into 12%, tell me how much are you getting? 22,282 into 8 is 7. So here just a 10 rupees difference is there. That's because I used only 4 decimals there. If you take 1 or 2 more decimals, the gap even further narrows down. But still, it will not 100% match. That's the reason you take this as a balancing. That's all it becomes. Sir, this is a 12 mark stuff, sir. In this, you tell me what is there to not understand. ACM ground rules if you are strong. If you know that ACM will work only if the closing balance represents present value of future cash flows, and whenever cash flow is disturbed, you have to remeasure the staff loan account or financial asset account. Again, that's all. There's nothing great in this. Okay, sir, how much ever they try, beyond this they cannot go, sir. They'll play only around in or around this area. ACM, if you are very confident, these sums are very simple for you. Okay, so we have finished up the concept of staff loan. Next case, look at this. Sir, I am taking a plant and machinery on lease. So this is a lease transaction. Leases accounting is covered in a separate standard called as Ind AS 116. That anyway we will discuss later on. Now, in this lease transaction, I have to pay him some lease rent here, some lease rent here, some lease rent here. Apart from that, the lessor insists that today I pay him some security deposit of 1 lakh rupees. Because his asset is there with me, so safe side, he wants me to deposit an amount of 1 lakh rupees. When will he give me back this 1 lakh rupees? After 3 years, when I surrender the asset back to him, then he 1 lakh rupees, he will release it back to me. So, I invest here, he 1 lakh will come back here. Security deposit recovered. Tell me one thing, will the lessor pay you 1 lakh and also interest also? No. A 1 lakh a doubt. The interest also and all, where will he pay, sir? So in the place where I come from, usually this kind of deposits they won't pay. If I give advance of 6 months, take a building on rent, I stay there for 3-4 years. At the time of vacation, if I ask that fellow that deposit, he won't pay me. Under the established norm. Okay, so means, so how we do is, we identify new tenant. We'll first lure him. You want this property or not? He says yes. First pay me 6 months advance. We'll take from him, and then we will introduce this fellow to the owner and we'll get out. So that's the norm there. Nobody pays that. Interest and all, don't even imagine it. Okay. Now my question is simple, sir. You stand here, today you pay deposit, the money will as it is come back to you after 3 years. Ask yourself, do you have a contractual right to receive cash flow? Do you have a contractual right to receive cash or not? Yes. So a security deposit is definitely a financial asset. And this kind of security deposits, I can't sell it. Since I can't sell it, FVTOCI, FVTPL, they are ruled out for me. I have only one method to apply. Which one? ACM. And ACM initial recognition should be done at fair value. That's all. Along with the transaction cost. Here what no transaction cost is there, so fair value only. So my entry will be security deposit account data to bank. I am paying an amount of 1 lakh. This 1 lakh, even though I pay today, when will I get it back? After 3 years. After 3 years, if somebody is promising to give you 1 lakh, the worth of that 1 lakh today is 1 lakh, or less than that? Less than that. So how much is that depends on the market interest rate. Now, imagining 10% per annum as interest rate, so fair value will be 1 lakh into third year ka PV factor, which is 0.75131. 75,131 is present value. That means a gap whatever is there, 75,131 and 1 lakh gap. How much is it? 24,880, 869. Like how you wrote prepaid staff cost there, this is also one extra cost you are incurring in the course of a lease transaction. Now, towards this lease transaction, already you are paying how much lease? This one, and this one. And that fellow won't give this asset on lease to you unless you make this deposit also. But by making this deposit, am I not indirectly losing an amount of 24,869? So overall picture, if I should summarize, your lease cost you 3 lease rents, and first day only you have to pay an amount of 24,869. So originally, sir, when the standard rolled out, they called this as prepaid lease rent or simply prepaid rent. Now you tell me, what did you do with your prepaid staff cost? every year you amortize it to P&L account on straight line basis. Like that only, prepaid rent also will be amortized to P&L account on a straight line basis. This is the original principle. Later on what happened, leases standard got revised. You have now have which standard? Ind AS 116. According to Ind AS 116, there is nothing called as concept of operating lease or finance lease from a lessee's point of view. Lessee will always record only one entry called as ROU asset account debit to lease liability. So gone are the days where rent will come to your P&L account as an expenditure. Correct? So what this fellow did is he modified the answer, and instead of prepaid rent, they will ask you to deposit this to debit this to ROU asset. When you debit this to ROU asset, what will happen? Already ROU asset some number will come because of this entry, and now you are again debiting ROU asset. So ROU asset ka balance will increase. What will happen to ROU asset? ROU asset will be depreciated to P&L account over a period of lease. Lease period is 3 years. So every year I will record depreciation account debit to ROU asset. Of course, depreciation is a charge to your PRL. So instead of calling it as prepaid lease rent and debiting it to PRL over a period of 3 years, we are calling it as ROU asset, right of use asset, and we are depreciating it to PRL over a period of 3 years. Accounting impact is same, name changed. Prepaid lease rent, adi asset, ROU asset also asset. But prepaid rent account place, so now you have to use ROU asset. That's the difference. So this one and the previous one was your staff loan. Whenever sir fair value actual amount given transaction value gap comes, a gap accounting you observe. Previously we accounted it as prepaid staff cost. Now we are accounting it as what? ROU asset. There is one more case that also I will tell you. Then overall I will give you a summary of this. Sir, this question is quite important, sir. This as it is came for 8 marks. They changed the number. 8 marks question, sir. They asked you journal entries in 0 today and journal entries on the last day. Now you tell me, after how will you account this? I am not asking about ROU asset. ROU asset I already told you. You tell me security deposit accounting. Hereafter what will happen? ACM will apply. ACM accounting you tell me. Every year, sir, what accounting will you do tell? You will record, see, what is a every year accounting in ACM? Financial asset account debit to interest income. That's the first entry. So that means you will record security deposit account debit to interest income. How many years? 3 years. First year, second year, third year. Let's start. 75,131 into 10%. That's 7513. Okay. First year is over. First year ka first entry is over. Tell me, ma, will I receive any cash flow? Is it loan transaction where every year I'll get some cash flow and all? No. That means you will not have this entry each year. So first year you will not have this. So closing balance. 75,131 plus 7513. How much is that? 82,644. The closing balance, sir. Second year 82,644 into 10%. So that is 8264. Again you will not receive any cash flow. Closing balance 90,908. This year 90908. Let's make it as 9092. And finally you will receive an amount of 1 lakh. Once you receive this, the amount should become 0. Normal ACM accounting, you see whatever entries we learned earlier are the maximum entries. Sometimes cash flow not there, I will not write entry. But it is common, sir. Entry will be there. Financial asset account debit to interest income. That is common. Pakka it will be there. Cash flow if it comes, right. No, it doesn't come, don't write. But ultimately it will become 0. Because one day cash flow will come. Like that life goes on. The ACM story. This literally came for 8 marks. Okay, next. Tell me, sir. X Limited gave loan to Y Limited of 1 lakh rupees. And this loan is repayable. That's not subsidiary and all. Repayable on demand. Whenever X Limited asks, Y has to pay. Now, this kind of loans ki how much interest will you expect? Good. You will not expect any interest. Simple example. If you open a current account, you put 10 lakh rupees in it. Will the bank give you interest? No. Why they won't pay you interest? whenever you want, you spotly you can withdraw that money. That kind of demand deposits, ideally you should not get any interest. Since you don't have any interest rate, that means e kind of transactions lesser, the fair interest rate that you should expect is 0%. As an interest rate is 0%, which means what? Fair value will be equal to your transaction value. So then what is the entry you will record? What entry will you write? You will simply go and write loan receivable account debit to bank. How much did you give? 1 lakh. What is the fair value of this transaction? 1 lakh. Sir, you told fair value is present value. No sir. Array sir, present value only. Do with what rate? 0%. How many years you want? Assume so many years. Discount with what rate? 0%. If you discount with 0%, you will get 0. P factor will be 1. Discounting rate is 0% means it's like this, sir. 1 lakh divided by 1 plus 0 whole power n. N is number of years, no sir. So 1 or 2 or 3, whatever you want you place. That is 0. 1 plus PR whole power future value present value formula. Okay, so answer will be same. Now my question is, on this loan receivable you will still apply which method? ACM method. Now suppose first year ending I did not collect the money. Second year ending also I did not collect the money. What all accounting will you do? Tell me the model entries. Model entry is what? Loan receivable account debit to interest income. This is one entry. What is the second entry? Bank account debit to loan receivable. Okay. What is the ideal interest rate you should expect? 0%. 0. If he pays, write this. Doesn't pay, don't write this. This is pakka 0. Second year you collected, he paid, right? ACM does not mean that somehow you should write that entry. No. Those entries what you learned are the maximum. If interest rate is there, your contract rate may be there, may not be there. But in market rate is there, I have to do interest accounting. So market interest rate is 0. Then I will not do any accounting for that. Because my fair value and my transaction value both are same. Whatever I taught you initially I teach because I want you to remember them. But that does not mean that forcibly you write that it's somehow in all cases. In case of interest rate, you don't deserve any interest. How can you record income? Can't record. You getting it, sir? So things will be like that. Okay. Now come to one important case in financial asset basic accounting. Now, A Limited gave loan to B Limited. Loan given is 10 lakh rupees. Interest rate is 10%. Market interest rate. Okay, fine. This is market interest rate at 0% interest. So A gave loan to B at 0% interest. Market interest rate is 10% per annum. Loan period, for convenience, assume 3 years. Now, A and B are belonging to same group. They are parent and subsidiary. Who is parent, who is subsidiary? That's irrelevant for you. But, hurry sir, fine. Imagine whatever you want. So, between parent subsidiary, they gave loan, sir. That is 0% loan. Market interest rate is there. This is not a demand loan. Because the loan period is given. How can it be demand loan? After 3 years, whenever. No, sir. Next 3 years, you can't ask me. It's a time loan only, time based loan, not a demand loan. Now, first and foremost, tell me, what is the fair value of this loan? Fair value of the loan is what? Present value, which is equal to 10 lakhs into third year ka PV factor, 0.75131, 7,51,003, the present value. But actual amount given is what? 10 lakhs. So you definitely gave over and above the fair value. Okay. Now, how to do this accounting in the books of parent? How to do this in the books of subsidiary? Case 1, sir. Parent gave loan to subsidiary. In that case, what accounting you will do in parent books? What accounting you will do in subsidiary books? In parent books, the accounting what you have to do is, for parent it is a loan given, so it's a financial asset. So wait a moment. Loan receivable account debit 7,51,310, which is at fair value. Why you have to apply fair value? Because on this which accounting is applicable? ACM is applicable, so fair value. Leave one line. To bank, you are giving an amount of 10 lakhs. Now leave it here. Come to subsidiary books. For you it is an asset. For subsidiary it is a liability. They raised loan. So bank account debit 10 lakhs. Now you must understand, even financial liabilities like loans and all, they are also accounted at ACM only. Financial liabilities, how many methods are possible? Two. Either ACM or FVTPL, which we will discuss later on. FVTPL should not be applied whenever you want. Only for 5 cases you will apply FVTPL. Rest all cases of financial liability you have to compulsorily apply only ACM. And ACM initial rule will not change, no. So here also this fellow will record it 7,51,310. So here one gap is there. Here also one gap is there. How much gap is that? 2,48,690. Tell me, sir, who gave loan to who here? Parent gave loan to subsidiary. In process of giving loan, their feelings also they give. As a result, for the amount what subsidiary pays me, today that fellow deserve only 7,51,000. But because of our relation, I gave 2,48,690 rupees extra over and above what you deserve. This is a kind of free money what I am giving, which I will not indirectly ask you back in future. So this is an investment made by the parent in the equity shares of subsidiary. See, sir, the relation between parent and subsidiary is because of parent's holding of equity in the subsidiary. Tell me, is that amount recoverable? Can you demand that? You cannot demand. Equity share is not a contractual right to receive cash. So 2,48,690 also go and debit it to your investment cost. So the entry will be investment in equity shares of subsidiary. This is not new account. The account is already there with you. The amount also go and add there. That's it. Now, when parent is telling that I invested in your capital, subsidiary should also say the same thing, that you invested in my capital. So this is recorded as a capital contribution from the parent. Only thing is, don't credit it to equity share capital, because you are not issuing any new shares and all. So capital contribution from parent, indirectly nothing but other equity throw off this. Because no new shares are issued, now how can you credit share capital? You can't credit share capital, but equity lo you post. A equity ka owner is who? Parent only. That fellow will debit investment in his books. Okay, sir. Now watch the story correctly. When we did staff loan, extra amount given was debited to prepaid staff cost. When we did security deposit and lease transaction, extra amount given was debited to ROU asset. And now you are debiting it to investment in equity shares of subsidiary. Are you understanding, sir? Fair value, transaction value, gaps are coming. A gap accounting is what they will test. Now, sir, this is a very primitive point, that what will happen to this account? What will happen? ACM will happen. Every year cash flow is there, not there, because interest rate is 0%. Every year what entry will you record? Loan receivable to interest, loan receivable to interest, loan receivable to interest. Like that for 3 times you write imposition. A loan receivable account will become 10 lakhs. Collect the money, accounts closed. Are you getting it, sir? Basic ACM ka funda, sir. Nothing great in this. Now, in this case too, subsidiary gave loan to parent. When subsidiary give loans to parent, now parent books how to do accounting, subsidiary books how to do accounting. Now you first frame the skeleton entry, sir. Parent is receiving loan, so for him loan is a financial liability, loan payable. Subsidiary is giving loan, for them it is a financial asset, loan receivable account debit to bank. Both will apply ACM, so both will record initial recognition at fair value only, which is 7,51,310. This fellow gave 10 lakhs, our boy also received an amount of 10 lakhs. Now first come to subsidiaries books. Our parent deserves only 7,51,000, but you paid over and above that. That means who gave freely money to whom? subsidiary freely gave money to parent. You should not say subsidiary invested in equity shares of parent. That's not correct. No, so subsidiary cannot buy equity in parent after the relationship has been established. So how will I explain this is, in 2,48,690, subsidiary declared a dividend to their parent. When subsidiary declared dividend, they will debit where? Retained earnings directly to other equity. So this will be accounted as a dividend distribution by the subsidiary to parent. So subsidiary will account it by debiting their other equity, and parent dividend is an income. We studied in India 32, no, dividend income should be credited to your PRL. So this fellow will go and credit this to PRL. 248. So when parent gives loan to subsidiary, it is understood as parent invested in the equity of subsidiary. When subsidiary gives benefit to the parent, it is understood as subsidiary declared dividend towards parent. Do you understand? Yeah. So these are the three important cases, sir. Now, suppose what if I tell you everything is same. A loan period is not 3 years, but repayable on demand. Repayable on demand. Of course, now that it is repayable on demand, this is 0%. Now that this is 0%, transaction value 10 lakhs, fair value is also 10 lakhs. A gap A does not arise. When gap A does not arise, the accounting is not possible. We will write which entry? Loan to bank. The number will write. The receivable will write bank to loan. Amounts will tally off. Gap will not. Gap accounting does not arise. Am I clear here? Now, last case in this. A gave loan to B, and they agreed that B will repay the money to A whenever B is having money. Whenever they have money, at that time they will repay. Is it a demand loan? No. So definitely fair interest rate is not 0%. Okay, sir. So fair value is different, transaction value is different. How will you do accounting? Simple. You have only one choice. When will he have cash flows? When will he pay me? Make a estimate. Once you estimate the numbers, based on the estimate, discount everything to today. Fair value will come. You gave an amount of 10 lakhs. Fair value ki 10 lakhs ki gap is there. Gap ka accounting you have to do. That means accounting will be exactly similar. Only thing is, E particular sum, I told you the money will come back at the end of third year. In that case, you will not know when it will come back. So you have to estimate and still do the same accounting. Sir, what if that estimate fails? Haha, that you already know. If the estimate fails, what will happen? Your ACM will get disturbed. Once ACM gets disturbed, you have to remeasure the loan account again. The story continues. Are you understand, sir? That question is not there till now. Where ACM gets disturbed, only model is there. Why is this fellow making a lot of noise here? Okay. Now, I'll show you one small concept, sir. Watch this. Question concept number 3. It's called as a day one difference. Day one difference ka meaning is, sir, whenever you write initial recognition of financial asset, if there is a gap between fair value and transaction value, like our staff loan example, like our loan to subsidiary example, like our security deposit example, gap is there or not? A gap ka accounting how to do. That is officially given in the standard. What that fellow tells is, you wrote financial asset, you wrote bank. E amount, some number is there. E amount, some other number is there. They both are not matching. Gap came. He will ask you only one thing. If fair value, how did you get it? Is it obtained using level 1 input as per Ind AS 113? He'll ask one simple question. Whatever fair value you have, a fair value, how did you bring that fair value? Is it using level 1 input of Ind AS 113? Sir, Ind AS 113 ka level 1 input means what? Ind AS 113 ka level 1 input means quoted market price. Quoted market price unadjusted. Market la somewhere price should be there. As it is, if you bring, that is called as Ind AS 113 ka level 1 input. Other than that, if you compute fair value in any other method, that is not a level 1 input. Okay. Now what he tries to tell you is, if your fair value is obtained using level 1 input, then a fair value is a very strong fair value. That's the best fair value possible. Now, for example, the number is 1000. You paid 1100. And E 1000 is worked out using level 1 input. He says that There is no compromise with that 1000. 1000 is the best possible number. You only paid extra. How much extra did you pay? 100. This is loss. Go and debit it to your PRL. No sir, I paid 900 only. Gain. Take it to PRL. It will directly go either as a gain or loss to your PRL when it is level 1 input. But if it is not level 1 input, the standard says a gap you can recognize it as an asset if it is appropriate. Now in our example, is staff loan ka fair value is there, no? Who gave you this? Market lo quoted, a stock exchange that will be quoted as, sir, for you. You only worked out, no? For working note also you did, no? Who calculated? We calculated. That is not a level 1 input. A number we computed that number. Since that is not a level 1 input, a gap I can recognize it as a asset. Security deposit ka fair value, who computed? We computed. Are they quoted somewhere? No. That's the reason a gap we are accounting at as a asset. ROU asset. Similarly, parent subsidiary transaction, a gap, a fair value 7,51,000 we computed. That is not a level 1 input. Therefore, a gap I can account as a asset. So it's all about a fair value. How did you get it? A fair value, if it is level 1 input, you can't recognize it as an asset. If it is level 2 or level 3, you may recognize it as a asset if appropriate. This is officially one concept, sir. But nobody asked that concept till now. Don't bother, sir. These 3 cases are important. Just handle questions on this. That should be sufficient. Now, whatever concept we have studied, staff loan we have seen. Okay. Now, immediately, this is also staff loan only. Next, if you see question number 9, sir. Just run through the question quickly. A Limited has made a security deposit whose details are described below. Make journal entries for the accounting of deposit in the first year and also in the last year. Assume market interest rate for a deposit similar to the, for a similar period is 12% per annum. Date of deposit is this one. Date of finishing date is this one. Gap is 5 years. It's a lease transaction. Market interest rate is 12%. Deposit amount given is 10 lakhs. PV factor also he only gave off. He is asking, do accounting over a period of 5 years. I mean, first year and the last year he wants. What is there, sir? How much amount did you give today? 10 lakhs. How much amount will you get back after 5 years? 10 lakhs only. What is the present value of the 10 lakhs? Multiply with that PV factor. You are giving 10 lakhs, but the worth of the asset is only 5,67,000 some chiller. A gap whatever is there, you will go and call it as ROU asset. The old exam questions, sir. At the time Ind AS 116 was not in vogue. They called it as prepaid lease rent. But this is nothing but as on today you have to debit it to ROU asset. See, he also see what he did. Year ending, he called it as depreciation to prepaid. That's not actually prepaid lease expense. That is depreciation account debit to our study material. Still this answer only is there, sir. But ideally that is ROU asset, not prepaid lease rent. Prepaid lease rent is old, before 116. That's why I wrote this. This prepaid lease rent would be shown as a ROU asset. Like that last year accounting, sir. Very simple one. The next question, the parent and subsidiary wala case. Same number, sir. XYZ is a company incorporated in India. It provides a 10 lakh rupees interest-free loan to its wholly owned subsidiary. There are no transaction costs. How the loan should be accounted in the financial statements of XYZ, parent, ABC, and consolidated financial statements of the group. Case 1. Loan is repayable on demand. If loan is repayable on demand, transaction value, fair value both are same. There is no gap. So the giver will write loan to bank. Receiver will write bank to loan. That's all. There is no subsequent accounting for that until on the repayment date. Next. The loan is repayable after 3 years and current market interest rate is 10%. Exactly at 10 lakhs, discount by 10% for 3 years, you will have 7,51,310. At 2,48,690 is your gap. Since parent is giving loan to subsidiary, it should be accounted as if parent is investing in the equity shares of subsidiary, and subsidiary will account as if they are receiving a capital contribution from their parent. Loan is repayable whenever ABC has funds to repay the loan. Here you can't do any accounting. You can simply write a statement saying that estimate on what date cash flows are likely to come. Once you identify the cash flow dates, go and apply B point. However you did B, same model you have to do C case also. Okay. What is the accounting you will do in consolidated financial statements? Consolidated financial statements, so no accounting will be there for this. Why? Sir, I am parent, you are subsidiary. Consolidation prepared from group point of view by treating parent and subsidiary as a single entity. How can I give loan to myself? How can I receive loan from myself? A loan will not come at all. So there won't be any accounting when you talk about consolidated financial statements. Clear, sir? So this is our next case. E question, how they changed it in the exam is, Okay, the change question I did not keep in this book because your only selected questions are there. How they decided this question in the exam once it came is, A Limited invested in preference shares of B Limited, redeemable preference shares, but interest rate is 0. Redeemable preference share means what, sir? Money will come back. I gave 10 lakhs, but you will give me 10 lakhs when after 5 years. Interest rate 0%. That is as good as I am giving a loan to you at 0% rate. Instead of calling it as loan, they called it as investment in redeemable preference share. Name change, matter is same only. Instead of calling it as loan receivable, investment in equity account debit to bank, we will call it as investment in preference shares account debit to bank. Gap again have to debit to investment in equity shares of subsidiary. Loan place where you will use the word investment in preference shares. So that's how the question came in the exam. Okay, moving on. Chalo. Next concept is impairment or loss allowance on financial asset. So it's a little fresh concept, listen carefully. Now guys, impairment loss relating to financial asset in a very basic level, you know what it means? It is nothing but provision for bad debts. Provision for bad debts only, this standard calls it as impairment loss on financial assets. Now, financial assets, the definition of financial asset is what? Cash. Who's the next one? Investment in equity shares of another entity. What is the third one? Contractual right to receive cash or contractual right to receive any other equity share. First one you take. Cash, bad and doubtful debts possible. Cash is already there with you. What bad debts? Leave it. Next one, investment in equity share. First of all, investment in equity share, is it a receivable for you? That is not a receivable in the first place. So bad debts ka chance is not there. So if at all I have to suffer bad debts, that is possible only in the case of receivables. That means debtors, investment in bonds, investment in redeemable preference shares, debentures, loans given, e kind of things, bad debt is possible. Okay, ma? Now look at this. Financial assets can be accounted depending on their business model, either under FVTPL or under ACM or under FVTOCI. 3 methods are possible depending on your business model test and contractual cash flow test. Now, if any financial asset is accounted under FVTPL, impairment provisions, whatever we are going to discuss, they are not applicable. Sir, why are they not applicable? I'll tell you an example, carefully watch. Reliance Ambani issued bonds. Ambani issued bonds, I also will buy and I bought. After I bought, I understood that that fellow is younger Ambani. Not the fat fellow, the other one. That fellow's company duped. Okay, he cheated quite a number of people. So a company failed, sir. A company failed means existing loans they are defaulting. My debenture ka due date is after 4 years. My case don't even ask. Today's loans only, that fellow is unable to pay. My debenture ka maturity date is after 4 years. Yesterday only I bought. Now today it came to news that that fellow can't repay. Okay. Now what will all the debenture holders do? They'll try to sell. Who will buy? Who will buy? People will not be there to buy. What will happen? Start becoming desperate. I yesterday purchased for 1000. First I asked 900, no takers. 800, nobody. Ultimately 300, 350 it is trading in the market. Bond price has significantly come down. Why did it come down? Risk of that company has increased. When risk has increased, repayment capability will decrease. Automatically market price fair value will fall down. Imagine for this investment, I am following FVTPL. If I am following FVTPL, on the balance sheet date, what will I do? I will measure it fair value. But fair value has already come down. A gap fair value loss by default includes the impairment loss also. Provision for bad debt is already factored in that. And a loss went where? PRL. That means you booked the impairment loss with the name of fair value loss. And not only that, you also recognize it that where? PRL. Bad debts loss, where will it go? PRL only. So why should I apply this principle? When you do FVTPL, automatically bad debt loss is captured, and it is captured where? PRL. ఈ concept is not applicable. Don't do this. Adi naturally FVTPL inbuilt impairment provision is there in that. When you are following ACM, did you ever fair value it? I trusted this Ambani. I told objective A, hold till maturity. That much period he himself will not be there in that company. You are saying hold till maturity another 4 years. You started applying ACM. Did you ever look into the market? Did you ever fair value it? No. Today you came to know that fellow will not pay you full amount. Now there is a loss now which you have to book. Therefore, impairment provisions, whatever we are discussing, is applicable on this. Now you will tell me whether on this applicable or not applicable. Financial asset is measured at FVTOCI. Like how FVTPL I applied, here also I will do a fair valuation. Now when I do fair valuation, fair value loss will come. In that fair value loss, bad debt ka loss is also included. That means, did I account for bad debts indirectly or not? Yes. And investment is already appearing at correct value only in the balance sheet. So impairment provision should be applied or should not be applied? Should not be applied. Why? Investment is already appearing at fair value. When something is already appearing at fair value, what problem do you have now? You should not apply any impairment provisions. But wait. Did you book impairment loss? Yes. Where did you book? OC. Impairment loss should be booked only in PRL, not in OCA. So what the standard says is apply all the impairment principles. Identify the impairment loss. A loss from OCA you remove, put it in PRL. Don't touch the asset. So impairment provisions are applicable here also. Not that I will disturb the asset. I will not touch the financial asset. I will work out the impairment loss. A loss already naturally booked in OCA reserve. I will remove it there, post it in PRL. I will not touch the asset. Asset is already appearing at what value? Fair value. అసలు FVTPL కేసులో asset is not only appearing at fair value, loss also went to, don't touch it. Don't apply this concept at all. ACM, you never fair valued it. Now there is a loss, book it. You understand, sir? Impairment provisions are applicable only for these two cases. First case not applicable. Clear? Now, sir, how will I measure impairment loss? How you will measure impairment loss? There are multiple methods, right from provisions matrix. Provision matrix means, if an amount is outstanding for 30 days, I'll keep 1% provision. Outstanding for more than 30 days, up to 60 days, I'll keep 5% provision. Some fellow is very smart. Last 100 days he did not pay, 10% provision. Depending on aging analysis, I'll create a provision matrix. Based on that, I keep on creating provision. I can do like that, based on my past experience. Or I can do my past experience analysis, saying that out of my total data, 20% money will not come. 80% money will come with 70% accuracy, remaining doubtful. Based on past experience, you can make an estimate. But our standard suggests one exclusive method called as expected credit loss method. This is also called as ECL approach. Very unfortunately, on this your study material has spoken at length. Questions are not there. But in RTP one question came, sir. Later on in another example, distant touch the one more question. There 2 questions are there. IFRS 4 questions are there on this, which are highly relevant for your examination. So if at all it comes, unless you know this concept already, you can't hit it. And it is not difficult. Just watch, go on watching, you'll understand. Now, sir, I gave a loan to somebody. That fellow owes me these cash flows. 1, 2, 3, 4 cash flows. Here I am going to receive 100, 100, 100, 100 and 1000. In my balance sheet, loan receivable is appearing at 1000. Imagine coupon rate is equal to EIR is equal to 10%. Now, how to do expected credit loss method on this is 3-step approach. Step number 1, how you should think is, if at all this fellow makes a default, which cash flows will not come to you? If some bad happens in that company, which cash flows are not likely to be received? So your step number 1 is cash flows not expected to be received. First you go and identify that. Sir, somebody will expect cash flow expected to be received. I am reverse. We are expecting cash flows which will not come if a default occurs. Estimate that. Let us say E100 will not come, E100 will not come, E1000 40% also will not come if some bad happens. Step number 2. Compute present value of the loss. Discounted discounted at your original EAR. Now, tell me, sir, your loss will start in which year? Third year cash flow, 100 will not come. Fourth year cash flow, 100 will not come. Fourth year cash flow, 400 also will not come. These are your cash flows not expected to be received. Discount it to today. What is your EAR given to you? 10%. 10% third year PV factor, 0.75131. 0.75131. This is 0.683. 0.683. Work out PV of loss. Tell me, sir, multiply this and tell me the answer fast. 100 into 70, 75, sorry, 500 into 68, 35, 35, 75. How much? 420, yeah? 425, 420? 417 I am making. 417 is PV of loss. This is also called as loss given default. What is the meaning of this is, if at all a default occurs, you are facing a loss of 417 rupees in present value terms. That's the meaning of this. Finally, last step, over. You have to calculate the ultimate loss, sir. Ultimate loss means that is called as expected credit loss. This is a provision what you have to create, is equal to PV of loss, that is your loss given default, into multiply with probability of default. How much loss are we looking at? In this example, 417. Probability of default means, sir, loss, when will it happen? If that fellow makes a default, then it will happen. If he doesn't make a default, a loss I need not suffer. Now, what is the chance of him making a default? That you have to estimate. Let us say the chance of him making a default is 10%. So, multiply with 10%. So, 417 into 10%. Sir, what about 90%? There is a 90% chance he will not make a default. What is there? So, expected value, sir. Portfolio management, you did know multiple possibilities, married with respective probabilities. As anyway 0, so nobody writes that. I will also not write. So, answer is how much? 41.70. This is the amount of provision what you have to create. This is broadly the picture of it. One step ahead is there. Carefully watch. Expected credit loss, two type of ECLs are there. One is called as a 12-month ECL. One is called as a lifetime ECL. 12-month ECL means 12 months expected credit loss. Lifetime ECL means lifetime expected credit loss. Sir, what is the difference? Simple, sir. You are saying that the chance of default is how much? 10%. 10%, when will it happen? Means you are already standing here. If you consider a chance of default happening in the next 12 months and multiply that probability, the loss is called as a 12-month ECL. If you watch over the life of the financial asset and identify the probability of default and multiply with that, then a resulting answer is called as a lifetime ECL. Once again, sir, steps no change will not be there. Step number 1 is what? Identify the cash flows which are not going to get. Step number 2, discount all that cash flows to today using your original EIR. Step 2 is over. Step 3, PV of loss whatever you are having, that you multiply with probability of default. There are two kinds of probability. One is a chance of default happening in the immediate 12 months, or there is a chance of default happening over the life of the financial asset. Depending on which probability you marry, we call it either as a 12-month ECL or we call it as a lifetime ECL. Now, each stage, one common sense question, correctly think and answer. Between these two probabilities, which one will be higher? 12-month probability will be higher, lifetime will be higher. Obviously, because lifetime we consider the chance of a default happening in the next 1 year also and subsequently also. Moreover, farther the period, higher the risk. Farther the period, higher the risk, because I can't foresee much longer. No, sir. I can foresee what is there in the next 1 year, But in the next 5 years, what is there? How can I foresee? I can't see. The longer period I take, risk is more. Now, ultimately, it boils down to a simple concept of this less provision. This is a higher provision. This is a lower provision. This is a higher provision. That's all. So, ultimately, 3 steps are there, sir. Third step, you have to multiply with probability of default. A probability of default, 2 types. 12-month probability of default, lifetime probability of default. If you multiply with 12-month probability of default, it's called as a 12-month ECL, lesser provision. If you multiply with the lifetime probability of default, it's a higher provision called as a lifetime ECL. Clarity is there? Now, last question. Sir, which one I should apply? Which one I should apply? You tell me, sir. When risk is high, chance of loss is high, you will go with which one? High provision. That means lifetime ECL. When risk is low, then you will go with 12-month ECL. That's all, sir. If you know that, come here. Look at this table. Start with this one, sir. Financial assets whose credit risk has increased significantly on the reporting date compared to the date of acquisition. First day I purchased bond. A bond ka rating was AA bond. 1 year is over. Bond ka credit rating fallen down. It is C category. Why ratings will fall down? Credit rating of a bond has come down. What does it mean? A risk of the company has increased. When risk of the company has increased, you will go with lower provision, higher provision. Obviously higher provision. That's why you have to go and apply lifetime ECL. This is one case. Second case. Any financial asset where the amount is outstanding beyond 30 days from the due date. Your banking companies like NPA ke 90 days they gave. The stupid gives only 30 days. Once you cross 30 days, still amount did not come, go create a lifetime ECL. Next. Financial assets that are credit impaired at acquisition. What is the meaning of credit impaired at acquisition? I invested in a financial asset, but it's already bad financial asset. Sir, are you mad or what? Why did you buy a bad financial asset? Now tell me, sir, in real life, do you know people who buy only litigant properties? Sir, your hard-earned money, sir. Will you go and buy a property which is under litigation? It will come at a cheaper price. Will you go and buy? Majority of the people don't buy. Why? They don't want to face the legal hassle. But there are some people who are expert in this. They are quite expert at this. They have legal contacts. They know few gundas. Political support is there. This fellow studied law. Now, there is one fellow who married multiple women. Don't tag your friends now, listen here. So, okay, his grandchildren, sir, example, sir, okay, come here. His grandson is selling a property now. Okay, that great man, grandson. You are the prospective buyer. You like the house. You are already talking. Meanwhile, another fellow comes who is looking like him only. He says, sir, I am also the owner of this. Without my permission, you can't buy. Tell, who are you? Fine, don't worry, I'll pay you. You also. Tomorrow one girl came. She is also looking like these two fellows only. Says, I am also a part owner. Pay me money here also. And I understood. Okay, after I buy, 10 more people will come. So, I don't want to buy. I walked off. But there are some people in the market who search this kind of properties and buy. They will clean all the litigation, sell at a high price and go away. Like that, financial assets law also, litigant financial asset will be there. Suppose a bank is there, ICICI Bank. That fellow gave loan to some fellow. ICICI Bank gave loan to somebody, 100 crores. That fellow is not paying. Now ICICI Bank wants to sell off this loan. I am an educated gunda. I am rowdy sir, with lot of background and all. I wear formal shirt. But inside I have six-pack and all, some weapons and all I carry. Now, this banker comes to me, sir, see, he is not paying loan. You collect whatever you want, sir, you pay me 20 crores. I first inquire about that fellow. He is within my range or not. Understood, he has 2 kids. Enough. So first I paid 20 crores, buy the financial asset from the bank. Asset ka worth is 100 crores. Then I first go and normally ask him. He won't pay. Next day, his kid won't go to home after school. Then what will happen, sir? Tell me, do I need to search him now? No. He will only come. Sample, one finger, little bit, little violent. So automatically 100, 200 crores will come now. So, did I buy a financial asset which is already credit impaired? Yes. Now that I am educated and all, I follow Ind AS. I may be rowdy, but I follow Ind AS. So, I will have to create a lifetime ECL. Sir, this is a joke, but factoring companies do exist. Factoring name sounds posh. That fellow is rowdy, sir. Okay. So, these people do all this stuff. So, lifetime ECL. Sir, everywhere lifetime ECL, when will I apply 12-month ECL? Any other case? Any other case. So if you don't find any of these kind of risks and all, then you go and apply a 12-month ECL. Rest all cases you go and apply lifetime ECL. That's how it works. Okay. Now, last part, sir. How to do accounting for this? You tell me, sir. What is the entry for provision for bad debts? Don't give me a heart attack this side and this side now. Tell. Entry for bad. I'm not asking bad debts to debtor. That's bad debt entry. I asked provision for bad debts. Good. Tell me, sir. Profit and loss account debit to provision for doubtful debts or provision for bad debts. Correct? No? In the balance sheet, you will have debtors. Some number it is appearing. A provision is a credit balance account. Ideally, it should come on the liability side, but it's not a liability. So what you will do, you will reduce it as a reduction from your debtors. Correct? No, sir? And you will present the net amount. Remember the entry. PRL to provision for bad debts. Look at the entry here. PRL to loss allowance. A loss allowance is a name change. A loss allowance is nothing but overaction done for provision for bad debts. PRL Q debit, a loss allowance is a credit item that you show it as a reduction from your receivable. Net presentation lo, you will have net amount of debtors or net amount of loan receivable. That's how it works. This when financial asset is measured at ACM. Ultimately, asset is getting disturbed or not? By writing this entry, asset ka balance is coming down. But when financial asset is measured under OCI, you are not supposed to touch the asset. Why you are not supposed to touch the asset? Since you are following FVTOCI, asset is already appearing at fair value. I don't have a problem with fair value. I have a problem with the place of loss booking. So after doing so much of effort, you will get a loss. A loss you will debit it to PRL and credit it to OCI reserve. Don't touch the asset account. Don't create loss allowance here. Am I clear here, sir? Right. Now watch this. In this, suppose, sir, this is your loan receivable, 1 lakh rupees or 1000 rupees. On this provision for bad debts, you kept 30. It came to 970. Next year, on this loan receivable, while applying ACM, I have to write this entry. Loan receivable account debit to interest income. Question is very simple, sir. Will you apply 1000 into 10% or 970 into 10%? So I have to do EIR accounting now from next year onwards. EIR rate I should apply on the gross amount or on the net amount. Pinky. Yes, sir. Gross and net. Why so? Simple guess. Okay. Answer is you have to apply on gross amount. Not on the net amount. You will apply it on net amount only when default is certain. Asset is crossed the stage of provision. A pakka bad debt. Our stage you have to apply it on net. Over, sir. With this concept is over. Now, recognition of interest income. Even if an allowance is created, EIR shall continue to be applied on the gross amount of financial asset without reducing the loss allowance. EIR is also applied on the net amount after allowance only when the financial asset is credit impaired. Credit impaired means a pakka bad debt. You have a certainty that money will not come. Then only you have to touch on the net amount, sir. E model questions are not there officially from your CA resources. concept is there in the study material. Question is due, sir. It will definitely come. No surprise. Next month also you will be seeing this. So these things are not taught everywhere. You will not even find in most of the books. People keep some concept only when questions are there. No question, concept also they are removing. It's wrong way, sir. You have to learn this. Anyway, let's recap. What is step number 1? Identify the cash flows that will not be received. Step number 2, discount all that cash flows to today using original EIR. Step 3, a PV of loss, whatever is there, multiply that with probability of default. A probability of default are two types. Chance of default in the next 12 months, chance of default in the life of the financial asset. If you multiply with 12-month probability, it's called as 12-month ECL. If you multiply with lifetime probability, we call it as lifetime ECL. Till here, okay? Now, when to create 12 months, when to create lifetime? Sir, when credit risk is absolutely low, then only you will go with 12-month ECL. Rest all cases go with lifetime ECL. It's easy way to remember. Okay, next. Accounting treatment of loss allowance. It depends on financial asset accounting, how is it happening. If financial asset is measured at ACM, you have to touch the asset value. So that's why the entry will be PRL account debit to loss allowance. A loss allowance is provision for bad debts basically. That will be presented as a reduction from your financial asset. But if an financial asset is maintained at FVTOCI, then asset is already appearing at what? Fair value. If you're going to create a loss allowance, that will be presented as a reduction from the asset. So don't create loss allowance. What should I do? Debit PRL, credit to OCI reserve. Clear? Sir, what if financial asset is measured at FVTPL? Impairment provision say will not be applicable there. Asset is appearing at fair value, gains and losses already went to PRL. You don't have any job to apply this concept for FVTPL assets. Clear? Next. Interest income should be applied only on gross value unless there is a default is certain. Asset is properly impaired, credit impaired in fact. Except in that cases, you should not apply on net basis. Clear, sir? Now, 2-3 examples, sir, quickly and then you can leave. Watch here. Where is impairment? Where is the reclassification? Reclassification time is there. Okay, come to question number 13, sir. This our ICA history. Our A Limited has a portfolio of short-term trade receivables of 300 lakhs from a large number of small clients, but debtors basically. The entity expects percentage of default based on time frame. Determine the amount of allowance for expected loss based on given table. Sir, they only gave aging analysis, default rate, amount of debtor. He is asking, tell me the amount of expected loss. What should I do? Sir, total amount is there. Loss percentage also he only gave. Marry them, sir, marry them. The final answer, total it. Came for 4 marks in the exam. It came. 100% it came. People make format for this also and by heart. What can I say, sir? Okay. Sir, applying mind is easy sometimes. Come here, put in question. Carefully read the important stuff. On 1st January 20X1, N Limited purchased a bond for 1 million, which is measured at amortized cost. Interest of 10% is payable in arrears. Repayment is due on 31st December 20X3 to complete X1, X2, X3, 3 years life. The effective rate of interest is 10%. Wait there. Coupon rate 10%. EIR also 10%. The bond is purchased at par, redeemable at par, transaction costs are also not there. Then only EIR and coupon rate will match. Otherwise, they will not match. On 31st December 20X1, first year ending, N Limited received the interest of 1 lakh. It was estimated that the probability of default on the bond within the next 12 months is 0.5%. They gave you a 12-month probability of default. He says, if the default occurs within the first 12 months, then N Limited estimated that no further interest will be received and only 50% of the capital will be repaid on 31st December 20X3. And the assets credit risk as on 31st December X1 is low. Credit risk is low. So you have to go with 12-month ECL or lifetime ECL. 12-month ECL. In fact, you don't have a choice, no sir. That fellow gave you only one probability of default. You have to multiply only with that, no. So anyway, you will go with 12-month ECL only. Only thing is you should know how to compute this. Tell me, what is the step number 1? Identifying the cash flows which are not going to receive. Step 2, discount all that cash flows to today using your original EIR. Step 3, multiplying that number with the probability of default. That's all you got to do, nothing else. Now come here. Cash flow not expected. What is he saying? You are already standing here, sir. You are standing here. You are saying that if a default occurs, this will not come, this also will not come, and 10 lakh rupees principal whatever is there, in that also 50% money will not come. So 1 lakh will not come, another 1 lakh also will not come, 5 lakhs also will not come. So 1 lakh, 5 lakhs. Discount it to today using your original EIR of 10%. Ultimately number came to 5,86,750. This is the present value of the loss. By mistake, don't create provision with this. This loss, when will you suffer? If a default occurs, you will suffer. If default does not occur, you will not suffer a loss. What is the chance of default now? 0.5%. That means there is a 0.5% chance that you will suffer a loss of 5,86,750. There is a 99.5% chance that your loss is 0. What is your expected loss? Multiply. You will have 2934. So you ultimately have to create a loss only for 2934 rupees only. Now go to the first line of the question. The asset is maintained at amortized cost. Amortized cost method key. What is the accounting entry? PRL account debit to loss allowance. Now that you created a loss allowance in the balance sheet, it has to be shown as a reduction from the financial asset, and loan will be appearing at 9,97,066. Tell me, sir, here default is certain, in case default is certain, 100% default will happen, no. So next year interest income should be measured on gross value only, not on the net amount. So that also saves it. See, sir, I wrote all these points because if you read this question, no, sir, the entire concept of revision is there in that. Every point is applied in that, for that sake. Okay, last question for today. Promise on you. On 1st February, okay sir, not promise on you, on somebody. Okay, on 1st February 20x6, E Limited makes a 4-year loan of 10,000 rupees to Fern. So E gave loan to F. The coupon rate is 6%, which is same as effective interest rate. Interest is received at the end of the year. Fantastic. On 1st Feb 2000X9, wait there, it is originally 4-year loan. On 1st Feb 20X9 means already 3 years is over now. Fern tells E Limited that it is in significant financial difficulties. At this time, the current market interest rate is 8%. E Limited estimates that it will receive no more interest from the Fern. It also estimates that only 6,000 of the capital will be repaid on the redemption date. Meaning, sir, 4-year loan, 3 years over. That fellow, the borrower, he comes and tells me, I won't pay, do whatever you want. Sir, where is that line given? Sir, F told that he is in financial difficulties. You estimate that interest will not come. You estimate that out of 10,000 principal, 6,000 only will be recovered. Indirectly, how much will not come? 4,000 will not come. Question of probability of default is not there. Probability of default is not there means, what's the meaning of that? 100% default will happen. So probability of default is 100%. Okay, the asset is properly credit impaired here. Now, E particular sum, sir, obviously risk has increased, you have to go with lifetime ECL. But as such, remaining life is also only 1 year. Here 12-month ECL, lifetime ECL, everything will be same here. Sir, probability of default not given, I don't know what to do, my hands are shivering. Sir, if probability of default is not given, it means it is certain. 100% is the probability of default. That's why it did not say. How should this be accounted for? As usual steps. What is step number 1? Identify the cash flows which you won't get. After 1 year, 10,000 into 6%, 600 rupees ideally I should receive. It will not come. Out of 10,000, I will get only 6,000. How much will not come? 4,000. That means 600 will not come. 4,000 also will not come. Overall, 4,600 rupees after 1 year will not come to me. Step number 1. Step number 2, 4,600 discount it to today. With what rate? Original EIR. What is original EIR given? Is it trap? They will put like that only. Don't touch that. Market interested. Who wants, sir? We are not doing fair valuations. No, I want loss. Original EIR. Is it trap? Don't touch this one. 6% to discount it. So, take your calculator, sir. 4,600 divided by 1.06. 4,600 divided by 1.06. 4340. Multiply with 1, which is probability of default. So how much loss you have to create? 4340. That's all his answer. Now, balance sheet asset appears at what value? 10,000 original amount. Minus you created provision of 4340. Now asset will appear at 5660. This is as on today. How many more years life is there? 1 year. After 1 year you have to recognize interest income. Now the default is certain. You have to apply your EIR rate on gross amount or net amount. Net amount. What is net amount? Take your calculator. 5660 into 6%. Do how much did you get? 340. Tell me entry for interest income for financial asset under ACM. Financial asset account debit to interest income. Already your financial asset is appearing at what value? 5660 plus 340. 6,000. Exactly he will pay you how much? Account gets closed over. Are you understanding, sir? A step number 2 a loss ka discounting factor. Why you have to maintain EIR is for this reason. If you bring 8%, 9% some outside number and all, I can't play this. ACM, how can you bring market rate, sir? Market rate, if you bring, that is fair valuation. Don't do fair valuations. I just want to catch the loss. If you correctly use the correct rate, accounts perfectly will be closed towards the end of it. That's the background for this. Clear? Sum is over. Everything is over. Okay. Since I did not find anything else. Okay, fine. We'll continue tomorrow, sir. See you at 8 a.m. 8 sharp. Hey guys, guys, we have done introduction to financial instruments. We have covered Ind AS 32 completely. We have come to Ind AS 109. Ind AS 109 we have understood how to apply the methods of ACM, FVTPL and FVTOCI. And then we started with accounting of financial assets. Financial assets are investment in equity shares. The standard as such wants you to follow FVTPL, but it also gives you a choice of FVTOCI. Should you select that choice, you must remember the consequence that the accumulated gain or loss in OCI reserve subsequently is not allowed to be reclassified to PRL. It has to be merged directly into retained earnings. So that is about investment in equity. If you talk about financial asset, any financial asset other than investment in equity, which method of accounting is applicable depends on either on your business model test and contractual cash flow test. Now in business model test we will see the objective of you holding the financial asset. In contractual cash flow test we will check what rights are you getting from the financial asset. Now there are 3 kind of objectives possible. Holding the financial asset till maturity. The other one is holding the financial asset till maturity, but also it can be sold. Finally the third one is held only for the purpose of selling it. Trading is the objective. So A, B, C points. And D point, that is the contractual cash flow test, will get satisfied only if and only if the financial asset gives you right to receive cash flows which solely represent principal payment and interest. So solely principal payment and interest, we also call it as SPPI test. Now if you get any extra right other than SPPI, then a test is failed. Okay, now you will apply ACM when A plus D are satisfied. A is holding till maturity, D is SPPI test getting passed, then you will apply ACM. B plus D is passed. This fellow now also has the intention of selling it apart from holding it till maturity. That means we need a method which combines the fair value story of FVTPL and EIR story of ACM. A mixed method only is called as what? FVTOCI. So you'll apply FVTOCI. But if you fall under this category, accumulated gains and losses in OCA section, they are allowed to be reclassified to PRL. Investment in equity measured at FVTOCI, not allowed. But any other financial asset which is measured at FVTOCI, reclassification to PRL is permitted at a later date. In any other case, you will go and apply FVTPL technique. Any other case means maybe your objective is C or your objective is A or B, but you have failed with D point. Now, in this context,
There are some special cases, but they are not much examination worthy, so I did not go deep into that. And next we went into special cases of financial assets. One is staff loan. Is staff loan, on this you have to apply ACM. If you have to apply ACM, initial recognition should be done at fair value adjusted with the transaction cost. In case of loan kind of agreements, fair value is nothing but present value of future cash flows discounted at market interest rate, but the amount given is something else. So transaction value is this, fair value is this. There is a gap we are adjusting against prepaid staff cost, and the prepaid staff cost we are amortizing it to P&L account on straight line basis. Then security deposit also same thing, sir. If it is a lease transaction, a security deposit whatever gap is there, that gap will be adjusted to ROU asset and will depreciate it. It's as good as you are calling it as a prepaid lease rent and booking it off to P&L account. Demand deposits, fair value of interest rate you should expect is 0. So there will not be any gap between fair value and the transaction value. When gap does not exist, why will I account anything separately? Directly will write demand loan or demand deposit account debit to bank. Loans within the group. Parent gave loan to subsidiary or subsidiary gave loan to the parent. In this kind of thing, in consolidation financial statements, there will not be any impact on that. But in the standalone financial statements, if one company gives loan to another company at 0% interest or concessional rate of interest, then obviously there will be a gap between fair value and the transaction value. Now how will you account it? When parent gave benefit to the subsidiary, it will be accounted as parent has invested in the equity shares of subsidiary. If subsidiary gives benefit to the parent, it will be accounted as if subsidiary declared dividend to the parent, and accordingly you will close the accounts. Okay, so that is that. Then we went into impairment or loss allowance on financial assets. Now, financial assets which are already appearing at FVTPL, the concept is not applicable. But when financial assets are appearing at ACM or FVTOCI, you have to apply the concept of impairment or expected credit loss method. Now, how to impairment loss in case of financial assets context, it means that it is nothing but provision for bad debts. Now, provision for bad debts, how to measure, how can the standard tell you? That is your wish. You can apply any method to identify how much amount you are not going to receive and accordingly create a loss provision. Having said that, the standard recommends something called as expected credit loss method, also called as ECL approach. In this ECL approach, we have total 3 steps. Identify the cash flows which you are not going to receive, discount all that cash flows to today using your original EIR, so that present value of loss whatever is there, that we call it as a loss given default, but that is your loss only when default occurs. Now, that is not your real loss yet. So what you have to do, you have to multiply that with probability of default. A probability of default can be either a 12-month probability of default or it could be a lifetime probability of default. Accordingly, either the ECL will be called as a 12-month ECL or a lifetime ECL. Right? Now, 12-month ECL means small provision, lifetime ECL means a bigger provision. Now, when will you go with 12-month ECL is when credit risk is low, you will go with 12-month ECL. Rest all cases you apply lifetime ECL. The accounting part of this is if your financial asset is getting measured at ACM, entry will be PRL account debit to loss allowance. Our loss allowance is provision for bad debts basically. But when your financial asset is getting maintained under FVTOCI, you should not touch the asset account. So don't create any provision. So what you will do, you will debit PRL and credit your OCA reserve which is already there, because since the asset is maintained at FVTOCI, that asset must have been fair valued. When the asset is fair valued, impairment loss already would have been indirectly accounted under OCA section. You have to make good that and take that loss to your PRL. So that's what you have to do. And regarding interest income you still will apply EIR, and that EIR should be applied only on the gross amount without deducting the provision. And you will apply this EIR percentage on net amount if and only if default is certain. Otherwise, you have to continue applying on gross amount only. So up to here we have discussed. Now coming to today's discussion, a small concept, sir. It's derecognition of financial asset. Now, simple rule, sir. This fellow says, in your balance sheet, you are having a financial asset. On this financial asset, already some method will be getting applied. No, either FVTPL or ACM or FVTOCI. Some accounting is happening for this financial asset. Now, excuse me. Now one day, our company decided to sell the financial asset and they sold. Now, once the financial asset is sold, you already received money for that. Asset also is given to somebody. You can't have this asset in your balance sheet anymore. You removing this from your books of accounts only. We call it as what? Derecognition of financial asset. But the standard says, you should sell the financial asset in such a way that the substantial risks and rewards associated with the financial asset must be transferred to the other party. To the other party, if substantial risk and rewards are transferred, then only you can derecognize the financial asset. Without transferring risk and rewards, simple sale agreement or simple transfers, these kind of things will not be eligible for derecognizing the financial asset. Now, this plain case, sir. I selling something along with the risk and rewards, and therefore I will remove the financial asset from the books of accounts. A very, very straightforward case. Now look at a little different case. Let's say I have a loan receivable. A loan receivable ka coupon rate is 10%, which coincidentally also equal to EIR, and amount is, let's say, 10 lakhs. And this asset is capable of giving me cash flows for another 4 years. So I'll get 1 lakh, 1 lakh, 1 lakh, 1 lakh, and lastly I'll get 10 lakhs. So let's say I'm A Limited. Now, I gave loan to some fellow. That fellow owes me money over a period of next 4 years. But I want my money right now. I went to that fellow. I asked him, sir, you owe me money. Please pay me now. What will he say? I will pay you over a period of 4 years, and at the end of 4th year I will pay you full amount. But now I cannot pay you. Fine. I can't fight with him because that was the original agreement. Now, there is another party in the market who is having lot of money. I went to him. I told him that, see, this is my receivable. Till now there was never any default. He is a very good debtor. He will pay everything on time. So I will transfer right to collect all these cash flows to you. Today you pay me amount. That means let's call him as C Limited. So A is making a deal with C that A will sell all his future receivable rights to C Limited in exchange of a lump sum consideration today. Are you understand? So that means A is transferring right to 4 coupons and also right to receive the principal amount. That means entire cash flows, whatever belongs to A, they are getting now transferred to whom? C Limited. In consideration of that, C Limited will pay some money. Correct, sir? Now, in this case, since all my future cash flow rights I have transferred, I am eligible to derecognize the financial asset completely. But it is also possible that you can transfer either all your cash inflows, this is one possibility, or you can transfer only the interest strip. Interest strip means a 1, that alone you transfer. 10 lakhs you keep it with yourself. So from C Limited point of view, if you observe, C Limited has to pay you money today in exchange of 1 lakhs, which is going to get over a period of next 4 years. So here, since you are not transferring entire cash flows, you will not be eligible to do a complete derecognition, but what is allowed is to do a partial derecognition. That is also possible. Next, you can of course also transfer only the principal amount. So interest you keep after 4th year, whatever 10 lakhs is going to come, that belongs to C Limited, he will pay you some amount now. That's also possible. Or it can be possible like you can transfer 30% of interest and 50% of principal. What am I trying to prove here is, you can transfer full cash flows, you can transfer only specified cash flows like only interest strip, only principal strip, you can transfer a proportion of specified cash flows, that also is okay. So ultimately you should have clarity about which part of the cash flow you are transferring to the other party. If you are having clarity at this level, standard also permits you to do a partial derecognition. Am I clear here? Next. Now, sir, you all must be knowing the story of securitization because of your AFM theory chapter. Securitization you have heard? Of course, you should have definitely heard. So, this fellow is HDFC Bank. With all the deposit money and all whatever he is having, he has given lot of housing loans. Now tell me, sir, housing loans are short-term loans or long-term loans? In fact, very long-term loans, correct? No. Now, they have given loans to so many people here. All these people purchase some apartment or independent house or something they bought, and they are stuck with life for that. Next 15 years, 20 years, that fellow will keep on paying EMIs. So, bank point of view, the problem is bank's money is blocked with this fellow, and that money won't be recovered any soon. It will take a lot of time. So if this fellow wants to give new loan, he does not have cash. So what this fellow will do is he will float another company, which we call it as a special purpose vehicle. Generally, it will be formed like a trust or a company. Most probably it is company only. And this SPV, okay, this fellow will transfer the housing loan. And this SPV will give HDFC Bank money. So here cash is coming. Sir, it's a newly formed company. How is it getting cash? It is getting cash because this SPV will now issue some debt instrument to investors. Sir, who will buy? Sir, there are so many people who are cash rich investors. That means their business model is like every day lot of cash gets pumped into their business. Okay, example, insurance companies. Daily some or the other fellow will keep on paying premium. Mutual funds, daily lot of cash in will come. So there are so many businesses who are having lot of cash in their hand. So they don't want to invest at a very safe investments getting a mediocre return. So they would like to take a decent risk, because in this the risk is there, but all the loans given to these people, they are secure, like they are properly having collateral. No, sir, the house is the collateral security there. So trusting that these investors will give money here, and these debt instruments will give. Hereafter housing loan belongs to whom? SPV. SPV will keep on collecting the money, and from that money they will be paying the interest to the investors. But from HDFC Bank point of view, if you observe what happened for them, they have transferred their housing loans, which is an illiquid asset, and converted that into the most liquid asset called as cash. Now that they are having money, with that money again they start giving loans. This is the entire story of securitization. Now my question is this: can HDFC Bank derecognize the financial asset? Because loan receivables is the financial asset. Can HDFC Bank derecognize the financial asset? Yes, because they are transferring it, they can derecognize. But what the standard says is, you can derecognize only when substantial risk and rewards are transferred. Tomorrow, if some fellow makes a default, a loss who has to bear? SPV has to bear. Again, SPV cannot come to HDFC Bank, "Arey, you attached a bad debt fellow to me, now pay me back my money." That kind of right SPV should not have. So you must be remembering something from your CNT days: recourse factoring, non-recourse factoring. Non-recourse factoring means risk of bad debt is transferred. Recourse factoring means risk of bad debts is retained. I sell my financial asset to you. If you are able to collect, you collect. If you can't collect, come back to me, I'll repay the money. This is called as recourse factoring. In a recourse factoring, risk is not transferred. When risk is not transferred, financial asset cannot be derecognized. Are you getting this, sir? Now, why this specific example I gave you is, this particular example has got a little connect with our accounting yesterday. Now tell me guys, HDFC Bank keeps on originating housing loans, but they won't sit and collect that money. What will they do? They will sell the housing loan to a specially formed vehicle. Okay. Now, from HDFC Bank point of view, what is the business model? A, B, C, which one? Good. Their business model is a C. They create a financial asset only to sell it at a later point. Correct? Now, as long as the financial asset stays in HDFC Bank books, they will apply which accounting? FVTPL accounting. They will apply which accounting? FVTPL accounting. Because they did not sell it yet, but definitely they are going to sell it. So they will apply FVTPL accounting. Now, once the financial asset is transferred to SPV, what is the objective of SPV? Their business model is what? A. They will hold till maturity and collect all the cash flows from all these people. Correct? No, sir. That means this fellow will be applying which method? He will be applying ACM. Now, a SPV who created? The tree, naturally formed. No, sir. HDFC Bank created. So, HDFC Bank most likely controls SPV. So, this SPV most likely will be subsidiary of HDFC Bank. Now that fellow is a subsidiary, this HDFC Bank also prepares a consolidated balance sheet. In the consolidated balance sheet, a financial asset again shamelessly will come. Now, from group point of view, what is our group's objective? Will our group sell it to outside the group, or we will only hold? we will hold it. That means our business model is A, and therefore you will go and apply ACM. That means HDFC standalone books, FVTPL. After transfer is over, it goes to SPV's books. SPV books la ACM. Before or after transfer, consolidated books always you have to follow ACM. Are you understanding, sir? Because their objectives are different at different levels. That is one thing. Next. Excuse me. Yeah. Now, X Limited sold financial asset. Let's say in this fellow's balance sheet, there is debtor, 1 lakh rupees, book value. A Limited, this fellow sold the debtor. A Limited today paid an amount of 80,000. Now I am telling you, the transfer made by X Limited to A Limited is a recourse transfer. What is the meaning of recourse? Risk is transferred or not transferred? Not transferred. When risk is not transferred, can I derecognize? No, I cannot derecognize. But I received money today. Bank account debit to what? I can't credit debtors. What should I do? Whatever money I received, I may have to pay it back. Why I have to pay it back? If that fellow can't collect the money, then I have to repay the money back. Therefore, you have a contractual obligation to deliver cash in a potentially unfavorable situation. That's a classic definition of financial liability. So, go and create a financial liability for this. You should not derecognize your financial asset, but rather you should create a financial liability. Now, from where you stand, what is the best thing that can happen to you? Tell me. After all this deal, what is the best thing that can happen? Your A Limited went to all your debtors. They all paid him money. Then what will happen? Do we have to pay back the 80,000 to him? No. That's the best possible thing. Correct? Now, but observe closely. 1 lakh book value ka debtors, you indirectly sold for 80,000 only. Even if that fellow is able to beat the debtors and collect entire 1 lakh also, you will never get that 20,000 extra. Now that the 20,000 will never come. That much clarity we have. Now, even though financial asset you are not derecognizing, you are very sure that the 20,000 rupees will not come back to you. Go and create a loss allowance on this. Financial asset I am not derecognizing, but I for sure a 20,000 will not come. So you have to create a provision for bad debts. Provision for bad debts ka new name under the standard is loss allowance. That's all we create. Are you understanding, sir, what I am trying to say? Now tell me, what is the entry for credit sales? Debtor account debit to sales. Okay. That debtor give you bills receivable. Bills receivable account debit to debtor. Our bills receivable you discounted with the bank. Bank account debit, discount account debit to bills receivable. Stop there. When you give bills receivable to the bank, who will go to the debtor on the due date? Bank will go. If debtor does not pay, then bank will say, okay, tough luck. Next time, but like that they'll think, or they'll come and ask money from you. They'll come and ask money from us. That means, is bank assuming the risk of bad debts or no? No. That means the recourse transfer or non-recourse transfer? Recourse transfer. Recourse transfer. When it's a recourse transfer, risk is not transferred. Then why did you derecognize your bills receivable? You wrote the entry bank discount to bills receivable. Why did we derecognize our bills receivable? Risk is transferred or not transferred? Not transferred. How dare you to write, sir, entire single entry chapter, NPO chapter, all these are based on big accounts of bills receivable, bills endorsed, entire childhood was a lie. Childhood is lie, sir, youth is overrated, old age is painful. Okay, anyway, so, wrong entry, sir, you can't write like that. So, when you sell the bills receivable to the bank, okay, the accounting you have to do is bank account debit to financial liability. Bills receivable stays with you only. Bills receivable should not be derecognized. Internal, that's okay. That was AS based. In AS, we do not have any standard for financial assets and financial liabilities and all. But now do we have? But the thing is, we don't have that questions now. On bills receivable, debtor account and all. But bills receivable should not be discounted, should not be derecognized. Right. Okay, fine. Next one. Any gain or loss on derecognition of financial asset will be transferred to PRL. Let it be gain, let it be loss, it will go only to PRL. Now, sir, in this nothing appears like a special point. When I say something will gain or loss will go to PRL. But when you see deeply, sir, mind different kind of ideas will come. Because your stupid financial asset may be maintained at ACM, may be maintained at FVTOCI, or may be maintained at FVTPL. You would have done 4 years ki OCA accounting. Last when you sell the financial asset, again or loss should not go to OCA, that will go to PRL. OCA will not take anything which is in realized form. Remember that. And moreover, even if you transfer to OCA also, now financial asset derecognized, OCA reserve also has to be cancelled now. It has to be sent either to PRL or to retained earnings. No, sir. So don't even get the idea of putting any realized gains into OCA section. Any realized gain or loss will go only to PRL. Similarly, interest income, interest expense will always go only to PRL, even though the accounting is happening under ACM or FVTOCI. This we discussed in Ind AS 32, the previous session. Anyway, next. Broadly, this is all outdated concepts. Sir, come here. There is one small question. Wait a moment, I'll just check it once and discuss it. Okay. Modification, derecognition. Okay. This is easy. Come to question number 17, please. Sir, in this one case is a good concept. The third case, first two are easy only, but just go through it. A Limited has a trade receivables worth 10 lakh rupees. It has sold the right to receive cash flows to a factor X Limited for a lump sum consideration of 9 lakhs. 10 lakhs book value debtor, we sold it to one rowdy for 9 lakh rupees. Show the accounting in the books of A Limited in the following cases. Number 1, the transfer to X Limited is on non-recourse basis. Risk of bad debts is transferred. Is it eligible for derecognition? Yes. So, bank account debtor 9 lakhs, to financial asset 10 lakhs, gap 1 lakh rupees loss. It will go to PRL. Clear clarity is there? This is very straightforward. Next one. The transfer to X Limited is on recourse basis. Risk of bad debt is not transferred to X Limited. When risk of bad debt is not transferred to X Limited, the transaction does not qualify for derecognition. Whatever money you have received, that you have to treat it as a financial liability. So, bank account debit 9 lakhs to financial liability 9 lakhs. But your 10 lakhs book value maximum you will get only now 9 lakhs only, not more than that. So, 1 lakh rupees is a loss which anyway you will not recover. For that you have to create a loss allowance. Clear, sir? Next. Last scenario, important one, sir. Pay attention for this. Never came in the exam, but still there are hardly 2 or 3 questions of your study mat which did not make it to the exam. This is one of it. Go through it. A Limited has transferred the right to collect all the trade receivables and also has given a guarantee to the factor to the extent of 2 lakh rupees. The fair value of the guarantee given is 30,000 rupees. What's the meaning of this is, I sold the debtor, that fellow gave me money. I told the factor that if you suffer loss of bad debts, I will compensate you. Not fully, only to the extent of 2 lakhs. One limited guarantee we have given. Are you understanding? Then he says, the fair value of the guarantee given is 30,000 rupees. Now let's see what is the meaning of this and what is the accounting you have to do for this. Now, listen here, sir. Now that you sold the financial asset and you are receiving money, bank account debit 9 lakhs, kill the debtor, it's not physically, 10 lakhs, there is a loss of 1 lakh. As usual, loss will go to PRL. Up to here, it's fine. Now, did you promise the factor that in case debtor does not pay him, we will go and compensate? Did we promise it? Yes. Now, question last line, if you see, that fellow is giving something called as fair value of guarantee given. Now, how to interpret this fair value of guarantee given? Based on this interpretation, your accounting is linked. Understand that correctly, sir. So, for example, you are my subsidiary. You are taking loan from the bank. Bank told, this fellow's credentials are not so good. I'll not give loan. But I know that you are good. I'm parent, no sir. Feeling is. So, I went to the bank and told, please give loan. I'm standing as a guarantor. The loan which you are taking is 10 lakh rupees. I gave guarantee to the bank for entire 10 lakh rupees. But in my mind, I know that you will not make a default of 10 lakhs for sure. But you might make a default of some 30,000, 40,000, 1 lakh, range. So small default you are likely to make, entire 10 lakhs you will not make. If you check the amount of guarantee which I promised you to the bank is 10 lakhs, but the expected loss which I am going to suffer is some 40,000 rupees. So 40,000 rupees is the loss which I am prepared for. But the promise what I made to the bank is for 10 lakhs. Now because I gave guarantee on your behalf to the bank, I took risk on your behalf. Now if I ask, since I took risk on your behalf, compensate me, pay me some money. Now how much money will I collect? In my mind that I am already prepared that you will make a loss of 40,000. You will default an amount of 40,000. So I end up paying an amount of 40,000. So today I also collect an amount of 40,000. So basically fair value of guarantee is something like expected future bad debt which we are going to suffer. That only is called as fair value of guarantee. In another word if I should tell you, a call option if you take, how many parties are there? Holder, writer. Now you tell me, sir, how much premium writer should charge? How much premium a writer will charge from the holder? How writer will think is, in future, if the option gets exercised, I have to pay money to him. He will identify how much amount I am likely to pay to him. Then he will take into consideration probability. Then he will take into consideration the time gap, expected value of payoff which I am going to pay to him at present value terms. That means how much amount I am going to suffer as a loss on a future date that I will work out. I'll discount it to today and I'll collect that money from you. Isn't it, sir? That's not premium calculation is nothing but my future loss amount I'm trying to collect from you right now only. Likewise, a guarantee which I gave to the factor, a guarantee ka worth is how much? 30,000. That is good news or bad news for me? That's bad news for you. Why there's a bad news? You made a promise. Because of that promise, we are going to suffer a loss of 30,000 in future. Correct? Now, watch this. Pure loss to financial liability guarantee with an amount of 30,000. Fine. Number 3. Sir, worst thing that can happen to you is what? What is the worst thing? That fellow actually suffers a bad debt of 2 lakhs or more. In that case, we have to pay an amount of 2 lakhs. What is the best possible thing that can happen to you? 2 lakhs is totally collected. There is no bad debt at all. Correct? Now, is risk completely transferred or some risk is retained by us? Some risk is retained by us. When some risk is retained by us, ideally I should not derecognize the financial asset at least to the extent of 2 lakh rupees. But shamelessly, what did we do here? Entire debtor we removed. But we still are interested in the debtor to the extent of 2 lakh rupees. Daily I pray to God that 2 lakh rupees bad debt should not happen. Correct? That means am I interested or not? Yes. Now that you are interested, risk is not transferred. Ideally you should not derecognize the financial asset. But we derecognized. Mistake no? Create again. But with a different name. This is called as continuing involvement financial asset. Here breakups are still interested. First we called it breakup. Things are over. How are you? Did you eat? What is your plan? What's up? This kind of things are happening. So continuing involvement financial asset. So you created an asset back. Now that you created an asset back, now all positive feelings are there. Now tell me, sir, if all the debtors completely paid money, 2 lakhs is yours, sir. No, 2 lakhs belongs to whom? Factor. You recognized an asset. You are still interested in that. But even if that money comes, you can't keep it. That money belongs to whom? Factor. So create a dummy liability also. 2. Associated. A last entry, whatever you are seeing now, sir, this is a dummy entry, sir. One artificial asset to show my interest. Even if that money gets collected, I can't keep it. I have to pay it back to the factor. So that money is not mine, but I'm still interested to display my continued involvement in the financial asset. One artificial dummy entry we are recording. Are you understanding till here? So total how many entries? 3 entries we wrote. Now, if financial liability guarantee whatever is there, no, on this you have to apply FVTPL accounting. Sir, when did we discuss this? We did not. We are going to discuss because we did not even start financial liabilities accounting. Financial liability accounting, we will discuss this. Okay. Now, FVTPL accounting principles you know. Tell me. Initial recognition should be done at fair value. The fair value only 30,000. Next. On the balance sheet date again you have to do fair valuation. In that again you may get a gain or loss. A gain or loss also will go to PR. The story continues. Correct? Now, just for discussion purposes, next year, the actual bad debt which the factor suffered is an amount of 50,000. But we originally estimated bad debt as how much? How much provision did you create, sir? How much loss provision did you make? 30,000. But actual bad debt is how much? 50,000. That means I am prepared for a liability of 30, but my actual liability became 50. Good news, bad news? Bad news. How much more loss? 20,000. FVTPL accounting only we are doing. So what should I do? PRL account debit 20,000 and increase your financial liability guarantee 20,000. Now pay up. Guarantee is not simple promise, no sir. You have to execute. 50,000 you pay. Feel bad. Tell me sir, are you still interested in the debtors? All debtors paid money sir except 50,000 are the loss that we compensated. Am I still interested in debtors? No. Now that you are not interested in debtors anymore, dummy entry whatever you wrote, reverse it off. So my entry should be associated liability account debit to continuing involvement financial asset with an amount of 2 lakhs and 2 lakhs. Clear sir? Now watch the other case. Actual bad debt is equal to 0. Everybody gave money to the factor. I don't owe a single rupee also. So how much amount I have to pay? 0. But already in my books I created a financial liability guarantee of how much? 30,000. That earlier we created 30,000 here. 30,000 also we need not pay. So what should we do? The fair value of the liability today is how much? 0. But in my books liability is appearing at 30,000. Reverse it. So what is the entry I should write now? I should write financial liability guarantee to PRL an amount of 30,000. Do I need to pay anything? No. Again, you have to kill the dummy entry. Associated liability account debit to continuing involvement financial asset with an amount of 2 lakhs, 2 lakhs. This is how things gets closed eventually. Till here clarity you are having? Now sir, your study mat, what they did is, if first of all in the study material, next year accounting is not covered. They have only one question. 3 entries, they clubbed and wrote a single compound entry. And according to study mat, the entry looks like this. Bank account debit 9 lakhs. PRL account debit 1 lakh 30,000. Continuing involvement financial asset an amount of 2 lakhs. 2. Financial asset, that is your debtor here. Debtor will be 10 lakhs. Then they recorded this one, sir. I have a problem not with the compounded entry, but this number. They wrote to associated liability 2 lakhs plus 30,000. 2 lakh 30,000 they wrote the entry. Observe, what's the mistake there? 30,000 rupees, sir, this is dummy asset. This 2 lakh 30,000 dummy liability is only to the extent of 2 lakhs. 30,000 is not a dummy liability, that's a real liability. For that you have to do FVTPL accounting. That fellow, what he did without any explanation, he wrote this entry. He mixed up this, and there is no subsequent discussion. Next year what happened? Nothing, nobody talks about that. 100% wrong end. 100%. Moreover, here some printing error also was there. Now they rectified that, but this portion they are still continuing like that because they do not have what will happen to these accounting next year. So the study matter whatever answer is printed, pakka wrong answer, sir. And Who will by heart all these entries, sir? Keep this is easy, no? First derecognize, then create a liability for your guarantee value, then create a dummy asset, dummy liability. Mix all the three if you want. Okay, in this, for this accounting is there subsequently. How can you go and mix this 30,000 along with this dummy liability? Here and stupid entry will tally. My goal is not to tally the entry, no sir. Subsequent accounting should be valid because of the accounting what you write today. So obviously this is not right, sir. You can't club this 30,000 into this. You have to show it separately. Separately you should write compound entry. I don't have an issue. Okay, so this is the original story of this. Come to the first scenario once. We'll close it up now. Tell me, sir. First day, how much did you receive from the factor? Ultimately, how much did you pay to the factor? 50,000. That means overall we received how much? 8,50,000. Book value of debtor is how much? 10 lakhs. So for 10 lakhs debtors, we received an amount of 8,50,000. How much loss? 1,50,000. Look at here. Last year, how much loss did you book? 1 lakh. Second entry, 30. 1,30,000. Current year, fresh loss 20. Overall loss 1,50,000. Sorted. Second scenario. I collected 9 lakhs originally. Now I did not pay anything at all. So 10 lakhs book value debtor, I collected an amount of 9 lakhs. Loss is how much? Check out here. You debited 1 lakh PRL. Next you debited 30,000 PRL. Total debit 1,30,000. Here you are crediting PRL with 30. Effectively your debit is only 1 lakh. Sir, what is reality that cannot escape? If you do perfect accounting, things will match. So this analysis I have to do because the answer printed in study material is illogical answer, sir, the wrong answer. Maybe that's the reason it never came in the exam till now. Anyway. So this is about the concept of derecognition, sir. Okay, next. Small question with that derecognition concept will finish. Answer this, sir. Sir, I am A limited. This fellow is B limited. In my balance sheet, presently, financial asset exists. Today the deal is, I sold the financial asset to him. And he paid an amount of 10,000 rupees to me. That means I sold the financial asset for 10,000. But concurrently, I also entered into another arrangement where after 1 year, my financial asset, I will buy it back. My financial asset will come back to me and I would pay him an amount of 12,000. That means this is a sale and repurchase of financial asset agreement. Clear, sir? Now, how will I account this? If you are A limited, how would you do accounting for this? First transaction is what? Sell. What is there, sir? Bank account debit to financial asset, gain or loss to PRL. Asset derecognized. After 1 year, you are again buying financial asset account debit to bank. If this is the answer, why will we discuss this? If sale and repurchase is taken at face as it is, why to even discuss it, sir? Sale and repurchase always are dummy agreements. Sir, I sold something today. You gave me money. Again, I bought it back. I paid you money. In this, ultimately asset is with me only. No, sir. I sold, but again, ultimately I received. So, sale is a fake transaction. So, ignore the sale part and see what is happening there. First, you received an amount of 10,000. After 1 year, you are paying an amount of 12,000. That means what, sir? The loan transaction. I collected a loan from you to the extent of 10,000 rupees. I am repaying the loan along with interest. Financial asset is a joker there. It's a security there. You should not go and derecognize a financial asset. Somebody says I sold financial asset means okay and you should not believe. Okay, so careful. So here this is a financing transaction substance. So from A limited point of view, the entry they will write is bank account debit 10,000 to loan financial liability 10,000. After 1 year, on this financial liability, they have to record interest expense. Interest expense account debit to financial liability, an amount of 2,000. And once you repurchase your financial asset, if the amount will pay off, no. At that time, financial liability to bank, an amount of 12,000. Over. Financial asset should not be derecognized. Should not be derecognized. Sir, why it should not be derecognized? Again, come here. Imagine you are B limited for a moment now. First day, you paid how much? For this financial asset, you paid how much? 10,000. At 1 year time, fair value of financial asset is 17,000. You purchased it for how much? 10,000. But today market value is 17,000. Price has increased. Tell me, sir, can you sell it outside for 17,000? Can you sell it outside for 17,000? You can't. Why? You entered into a repurchase agreement. You are still forced to sell the financial asset to the original seller only for an amount of 12,000 rupees. That means price increased, but I can't take advantage. That means the reward is not transferred. Okay. Financial asset ka fair value became 3,000. You purchased it for 10,000. Will you sit and cry for 7,000? No. What is the moral of this? Risk and reward is not transferred to the other party. When risk and reward is not transferred to the other party, with what face will I derecognize financial asset today? You should not. Sale and repurchase agreements are fake arrangements, sir. They are something, but they look like something. Be watchful for this. Next. Sir, what if I tell you that repurchase of financial asset is not at 12,000, but at fair value on date of repurchase? Meaning what, sir? I sold the financial asset, you paid me 10,000. After 1 year, I will again buy the financial asset from you and I'll pay you an amount which is equal to the fair value on that date. That means if it is 17,000, I'll pay you 17,000. If it is 3,000, I'll pay you only 3,000. In this case, what is happening? Risk and rewards are transferred. Now that risk and rewards are transferred, the transaction qualifies for derecognition of financial asset. It should remove the financial asset. Every time it is not fake again. Repurchase price, is it fixed or not fixed? You have to see. If repurchase price is fixed, pakka fake agreement. Repurchase is going to happen at fair value on the date of repurchase. Then risk and rewards are transferred to the other party. The transaction qualifies for derecognition. IFRS question. Okay. You tell me, sir, based on options, call options, put options. What is the meaning of in the money? In the money. The option is likely to be exercised out of the money. Option likely to be lapsed. ATM we are not interested. Anyway. Sir, it is sale and repurchase. Pakka I will repurchase. Okay. I'll take a different case now. A limited, B limited. Sale happened today. This fellow also paid me some money also, 10,000. Up to here, story same like above. But A limited retains a call option at 1 year to buy back the asset at an exercise price of 12,000. What is the difference between above and this one is? In above case, sale is okay. After that, repurchase pakka it will happen. It's like a forward contract. I will buy from you at 12,000 rupees. This time, it is not forward contract. It is an option contract. I sold to you. I have a right to buy. If I want, I will buy. I will pay you an amount of 12,000. So here, repurchase is not certain. Whereas here, repurchase was certain. Now what should I do? Should I derecognize or should not derecognize? Earlier case, pakka you will buy. So we confidently told that it is a fake transaction. So do not derecognize. Here, I do not know whether I will buy or I will not buy. So my accounting is based on what now? You have to check whether call option is deeply in the money. If call option is deeply in the money, what is the meaning of this? High chance of option getting exercised. Whatever you sold, you will exercise and buy it back again. When anyway it is going to come back to you, why to derecognize? Do not derecognize. Any other case, derecognize. This is the story of this. Now, the same story, we can spin it off in another way also. What is another way is, A limited sold financial asset to B limited and A limited also gave B limited a put option at 1 year, X is equal to 12,000. Put option will give somebody what? Right to sell. B limited who bought the financial asset from us today is having a right to sell the financial asset to us only after 1 year. Now, if he exercises that option, we have an obligation to buy back. If I buy back, my financial asset will come back to me. Sir, what is the answer here? Same answer. If put option is deeply in the money, then do not derecognize. Any other case, you will have to derecognize. So one is sale and repurchase agreement like a forward contract. This is repurchase using a call option, that is repurchase using put option. Forward contract things are fixed, whereas here uncertainty is there. Because uncertainty is there, they are asking you to not derecognize when option is deeply in the money. Remaining cases we have to derecognize. So that's all, sir. That's all is relevant for us. So last one is reclassification of financial assets. Sir, for investment in equity shares, how many methods are permissible total? 2. Either FVTPL or FVTOCI. Tell me, sir, if you select FVTOCI, later on can you jump to FVTPL? No. If you select now FVTPL, later on you can jump to FVTOCI? No. Why? Whatever choice you make on first day, that is an irrevocable option. So if it is an investment in equity shares, jumping from one method to another method is not permitted. But in relation to other financial assets, which method you are applying depends on your business model test, correct? And of course on your contractual cash flow test. Business model test is my objective. If my objective changes, then a method is no more suitable for me. When business model changes, existing method is not suitable for me. So I have to apply a new method. That results into you jumping from one method to another method. Total how many methods are there? 3 methods are there. So you have total 6 possibilities now. From one method you can jump to other 2 methods. For example, you are already following ACM. Business model changed. Now you want to follow FVTOCI. So you are jumping from ACM to FVTOCI. Or you are jumping from ACM to FVTPL. 2 possibilities. From FVTPL to ACM, FVTPL to FVTOCI. 2 more. Total 4. Finally, FVTOCI to ACM, FVTOCI to FVTPL. Total 6 possibilities are there. So this kind of accounting, jumping from one method to another method, that is called as reclassification of financial assets. This is not permitted for investment in equity. Other than investment in equity, reclassification is permitted provided there is a change in the business model. Here a very, very important point is reclassification accounting, it will happen only from the beginning of next year, not today. Understand this carefully, sir. Your study material only one question is there, 5-6 cases are there, almost all are wrong answers. 1 or 2 are okay, rest all blatantly wrong answers. Anyway, the standard tells one thing, somebody smoked something and wrote. Now, reclassification the story is, sir, business model change if it is happening in the current year, the revised new method of accounting is applicable from the beginning of next year. Otherwise, people what they will do is to achieve some desired impact in their financial statements, they will show up something like a change in business model and manipulate current year financial statements only. The standard does not permit that. You change your business model now, new accounting is given to you from the beginning of next year, like that. Now, total 6 cases are there, sir. If you try to read all the 6 cases at once and try to remember, you will get confused. You will create 7th case. So, with numbers, with peaceful thinking, you can easily hit it. But you can't by heart this. Let's see how it works. Reclassification here. Come to question number 11. One question peacefully if you solve, sir, or 6 cases, naturally you will remember. Read. A Limited purchased 10% debentures of face value rupees 10,000 which are issued at 20% discount. Wait there. Our company purchased debentures whose face value is 10,000 but they are issued at 20% discount. That means you purchased them only at 8,000 and this is R, sir, and are redeemable after 4 years at par value. Nice. Original EIR in the financial asset is 17.3%. Actually coupon rate is how much? But the income I am going to earn is 17.3. Why like that? Because I purchased at discount, it is going to be redeemed at par. So I am getting more than what I have invested. Definitely my return on investment will be higher. During second year, there is a change in the business model of the entity. Tell me, sir, business model changed when? Second year. So new method will be applicable from the beginning of third year. The fair value of financial asset is as follows. First year ending ka fair value, second year ending of fair value 8,500 and 9,500. Show the accounting for reclassification in all the 6 possible cases. Now, what is your existing business model? I did not tell you because I want to keep the question open for all the 6 cases. Okay. Now, a change in the business model occurred in second year. So, new method accounting will be applicable from the beginning of third year. So, in the second year, you will still continue to do the old method of accounting only. Third year beginning, you will change the accounting. Clear? Now, I need one working note for this. Sir, it is possible that you are jumping from ACM to any of the 2 methods. So, I should know what is your existing carrying amount. So, I prepared an ACM table for the first 2 years. Actually, for 4 years I should prepare, but reclassification accounting is happening at the beginning of third year. So, up to second year if I prepare, that is sufficient for me. So, I started with 8,000. I booked DIR interest income minus the cash flows received, closing balance 8384. This fair value also simply for identification I wrote. Second year 8384 I start. I apply EIR. I correct one more 1,000 rupees. My closing balance is now 8834 under ACM. Sir, if you are jumping from FVTPL to any of the 2 methods, if you are jumping from FVTOCI to any of the 2 methods, your asset is already appearing at what value? Fair value. I need not work out that question directly given. But if you are jumping from ACM to the other 2 methods, I should know what is appearing in your book value. That's the reason I have to work out an ACM table to identify how much is your current carrying amount. Am I clear till here? Now, what's the question number, sir? This one? 11. Okay. In this, if I take case 1, I am jumping from ACM to FVTPL. Sir, if you are jumping from ACM to FVTPL, you tell me now, business model of what change happened? If you were following ACM, that means what? Your goal was to hold till maturity. You are never interested in fair value earlier, but now your goal is to sell. That's the reason this thing is happening. Are you understanding, ma? Now, carrying amount of financial asset is 8834. But if your new method is FVTPL, investment should appear at what value? Fair value. So, fair value is 9,500. What are you waiting? Update it. Update. So, what's the entry I should write? How much value will be increased now? Rupees 666. Now, investment in bonds, account debit, 666 to PRL. Sir, any doubt why we are crediting PRL? Is there any doubt there? No. Why no doubt? A new method is FVTPL. Obviously, gain or loss will go only to PRL. There is no big deal there. Instead of writing this entry, you can write this kind of entry also. Investment in bonds, FVTPL, to investment in bonds, ACM. Your original accounting completely cancel the existing account, open a fresh account. Sir, entry does not tally. If entry does not tally, that gap is how much, sir? 666. That automatically will go to PR. Instead of updating the ledger account, you can cancel the existing ledger and open a new fresh account also. Any which way, impact will be same only, sir. Whatever is convenient, you do. Okay, this is case 1. Case 2. Case 2 easily you can guess. You are jumping from where to where? ACM to FVTOCI. Tell me, sir, business model of what change happened? Your goal was to hold till maturity. Now, hold till maturity goal is there. I am also looking at the options of selling the financial asset. So, suddenly I became interested in fair value also. Now that I am following FVTOCI hereafter, my asset should appear at what value? Fair value. So, like how you have fair valued earlier, here also you have to do a fair valuation. So, when you do a fair valuation, the entry will look like investment in bonds. How much fair value, sir? 666. Only thing is, instead of PRL, you will park it in a separate reserve via OCA. Do you understand till here? Now, I'll tell you one small case, see whether you are able to understand or not. Case 1, sir, first 2 years I applied EIR concept. But hereafter I will not apply. Hereafter I will not apply. Why will I not apply? My new method is FVTPL. FVTPL ka meaning is what? You are not going to stay till maturity. When you are not going to stay till maturity, a timeline la entire cash flows you are not going to enjoy. When you are not going to get those cash flows, how can you record EIR? You cannot. Hereafter EIR will be discontinued. But here EIR will be continued. Why EIR will be continued? FVTOCI also interest income should be measured using EIR. Only difference is last 2 years you did not do fair value. Hereafter you will do fair value. The gains and losses will be transferred to OCI reserve. That's the only extra point. EIR will be continued. Next, case 3. FVTPL to ACM. Tell me, what is the change in business model? Once upon a time, only to trade. Now, only to hold. I was looking only at fair value earlier. Now I want to look at maturity value, EIR. This is and all my revised income. Okay, ma? Now tell me, sir, what is your carrying amount of financial asset? 9,500. Because you are already following FVTPL and you are standing at the beginning of third year. So second year ending, you would have already fair valued it. Investment will be appearing at fair value of 9,500. Now, listen here. Standard does not ask you to do any kind of retrospective effects and all. It's not like, had I followed ACM from the very beginning, by now I would have had 8834. No, sir. Don't do that. Don't do that. There is no need for you to do any kind of retrospective impacts here. That is wrong. Sir, what should I do? Hereafter, gatam. Hereafter, continue. Meaning, it is as good as you purchased a fresh financial asset today for 9,500 rupees and you want to apply ACM hereafter. Prospective accounting you should do. Prospective accounting ka meaning is, sir, total how many years bond this is? 4 years. Already how many years are over? 2. Remaining is how much? Another 2 years. So if I am standing today, 1 and 2, this is the maturity date. Asset already in our books is appearing at 9,500. Hereafter you will get a cash flow of 1,000 here, 1,000 here, and here maturity value also 10,000 you will get. Now what you are supposed to do is, if future cash flows map with your existing carrying amount of 9,500 and identify a new EIR. Some percentage will come. With that you will apply ACM prospectively. Whatever fair value gains you already recorded in the last 2 years, there is no need for you to eliminate that and all. You should not give a retrospective effect. Retrospective effects you will give when there is a error. Is error? Are a feeling changed, sir? How is it error? So last 2 years I felt ACM is right for me. I did ACM, sorry, FVTPL was right for me. I did FVTPL. Hereafter I want to do ACM. So there is nothing called as error in this. Only for errors you have to do a retrospective restatement effect, not here. That's why whatever happened. Hereafter we will apply prospectively ACM. Here as on today fair valuation case will not apply because your asset is already appearing at fair value. Under ACM also initial recognition should be happening at fair value only. I don't have any problem. Are you getting it, sir? Continue. Case number 4. Your old method is FVTPL. New method is FVTOCI. Tell me, sir, what is the change in business model? I want to sell the asset once upon a time. Now, I still want to sell the asset, but I may also hold it till maturity. Dual objective started. Sir, what will happen? Most easiest case, same as above. Why same as above? Think carefully. Your old method, asset is appearing at fair value. Under new method also asset should appear at fair value. So I did not disturb the value of the financial asset per se. But last 2 years I did not apply EIR. But hereafter I have to apply EIR. So I have to find out a EIR. And if you remember, FVTOCI interest income should be exactly equal to the interest income had you followed ACM. So ACM had I followed the new EIR, it will be something around 13.5% or something, if I remember correctly. At 13% the EIR will apply here also. It's just same as literally above. Only difference is hereafter also you have to continue doing fair valuations. Whereas in ACM you will not do any more fair valuations. So case 3, case 4 are similar. Now coming to case 5. You are jumping from FVTOCI to FVTPL. Tell me clearly, what is the change in the business model? Once upon a time your business model was to hold till maturity plus also can be sold. Now what is your revised business model? Only to sell. Okay, and your asset is already appearing at fair value. Under the new method also it should appear only at fair value. Do I need to change the value of the asset now? I do not need to change the fair value of the asset right now. So what I should do is, hereafter discontinue applying EIR. Why discontinue EIR? EIR is there only in ACM and FVTOCI, not in FVTPL. So whatever EIR accounting you used to do, hereafter let it go. Okay. And from hereafter, whatever fair value gains or losses will come only to PRL. Clear? And for last 2 years you already fair valued now. Because of that you will already have a, what will happen to this? OCA reserve in, or as on today, is reclassified to PRL. Sir, why is it reclassified to PRL? Which financial asset is it? Other than investment in equity. Since it is other than investment in equity, reclassification to PRL is permitted. So first 2 years you did FVTOCI accounting. Because of FVTOCI accounting, first 2 years you would have had a fair value gain. A fair value gain you would have parked it in a separate reserve account via OCA. Now that FVTOCI is discontinued, you are jumping to FVTPL. Whatever accumulated OCA reserve is there, that OCA reserve you have to cancel it and transfer it to your PRL account. The number will be 666. First 2 years ka accumulated OCA will jump off to PRL. Clear, sir? Sir, it's very easy, sir. You go through business model, keep on understanding old method of what is happening, hereafter what I'm supposed to do. Everything is easy. There is no retrospective concept. Prospective accounting you have to do. The last case is last for a reason. What is the last case? You did FVTOCI and now you are jumping to ACM. Now that you did FVTOCI, last 2 years you fair valued, but hereafter you are not supposed to do any fair valuation. And moreover, your balance sheet picture is like this now. You have investment in bonds appearing at now what value? 9,500. You are, let's say, at the beginning of third year. Okay. And you already created a OCA reserve of 666. Now, sir, hereafter I am going to follow ACM. Now that I am going to follow ACM, should I need to fair value hereafter? Not required. But do I need to follow EIR? Yes. But already last 2 years also you followed EIR only, as if you are following ACM. So EIR lo no change. 17.3% first 2 years you followed. Next 2 years also you will follow the same EIR. But first 2 years you fair valued. Hereafter you will not do any fair valuation. Clear? Now you tell me, sir, what will happen to this? First 2 years la whatever fair value gain you identified, what will you do with that? Good, sir. Look at this. Here also I created OCA. Means I created a OCA reserve. What did I do with this? We reclassified it to PRL. Because it's a financial asset bond investment, this is allowed to be reclassified. I reclassified. Here also if I do the same thing. Wrong. Why is this wrong? Listen carefully. In the previous case again, if you were following FVTOCI, what was your goal? Once upon a time. What was your goal? Hold till maturity, but also can be sold. That was your goal. What is your latest goal? Case 5. Case 5. Once upon a time your goal was hold to maturity and also can be sold. Latest goal is only to sell. That means you got a clarity that you will not hold it till maturity, you will pakka sell it. That's why we don't have a problem if you take it to PRL. But now what is the scenario? You got a clarity that you will never ever sell it. When you will never ever sell it, asla fair value gain you will never enjoy. How dare you to take it to PRL? Are you understand, sir? In previous case la, I was having intention to sell beginning also, now also. But now only intention to sell. The standard gave you a right to take it to your PRL. Now you had an intention to sell once upon a time, but now you will hold it only till maturity. If I write this entry, you are recording a unrealized gain into PRL, which will never be realized. That is wrong, no, sir. So the standard gave a alternative treatment here. What you will do is take this OCA reserve, knock it off from the investment itself. So the entry you will be writing is OCA reserve account debit to investment in bonds with an amount of 666. The moment you write this entry and check the impact, it will appear at 8834. What is 8834? Had you applied ACM from the very beginning, by now your account would have been having a balance of 8834. Hereafter also continue applying AC. This last case alone slightly sounds like a retrospective effect, but my goal is not that. My goal is not that. I had to do that because I did not have any choice. I have to kill OCA reserve, sir. You take it to PRL, you take it to retained earnings. Both the cases you are recognizing a unrealized fair value gain which will ever be realized. That is wrong, no sir. So I don't have a choice. I have to cancel the OCA reserve. So that's how you are forced. You can't remember these steps directly, sir. You have to understand, feel and leave it. Naturally you'll get it back. This 6 cases custody. Chalo sir. With that we are done with our financial assets custody. Now moving on to financial liabilities. Sir, if you see, financial assets 3 methods are there, but financial liabilities only 2 methods are there. Which method is not there? ACM is not there. Who is that? You have only 2 methods there, ACM and FVTPL. Which method is not there? FVTOCI. But FVTOCI is there only for financial assets. Why? Why you should not ask me now. You should know that. Why? Because in relation to financial assets, 3 business models are possible. One hold till maturity, one hold for trading. In between one fellow is there. Both. For that both fellow they created and curated FVTOCA. But liability you don't have a choice, no sir. Liability is not your right. Liability is an obligation. Since you do not have a choice, FVTOCA method is not required for you. So they did not create. You have only ACM and FVTPL. Sir, between these two which one? Answer by default is ACM. For all financial liabilities you have to apply only ACM. There are 4 or 5 cases where you have to do FVTPL accounting. Remaining all cases you have to do only amortized cost method accounting. Now you tell me ACM accounting. Initial recognition, fair value adjusted with transaction cost, interest expense, interest income should be measured using EIR and there is no subsequent fair valuation. Correct? Now, yesterday when we discussed this concept, we discussed certain journal entries also. Out of that, now I want you to tell me journal entries relating to financial liability. Tell me, sir, I raised borrowing, bank account debit to financial liability. Borrowing, a debenture, a preferential, whatever name you want to call, you call. This is what I am going to do. The amount whatever I am writing here, this is a fair value plus or minus transaction cost. Initial recognition, fair value adjusted with transaction cost. This is the first one. Next, at the end of each year, I have to recognize what? Interest expense. Tell me interest expense entry. Interest expense account debit to financial liability, and this will be recognized using EIR. Correct? Next, every year if I pay something, then financial liability account debit to bank. This is with contractual cash flow. Promised cash flows you have to pay like this. Sir, is there a possibility where E number and E number can be same? Yes. EIR and coupon rate also can be same. They need not be same also. But if these two are same, then opening balance and closing balance of the account also will be same every year. If they both are not same, then it will not be same. Next, on every balance sheet date, there is no subsequent fair valuation. That's all. This is how ACM story will work. Now, since already ACM debenture question and all we have done yesterday, I am again not going to take you through that ACM entries and all. We will directly go to the next level. Come here. Financial liabilities measured using FVTPL. Now, which cases are covered under this is, first one, financial liabilities are held for the purpose of being traded. Derivatives are classic examples of this. But derivative accounting we'll discuss separately. So I gave a short sale example here. You remember short sale stock lending? I borrow share from somebody, I sold it off. Later on again I will buy the share from the market and I'll deliver it to him. This is a financial liability. Why this is a financial liability? Understand. The moment I borrow share from her and I sell it off, now I have an obligation to deliver a financial asset to her. Obligation to deliver a financial asset to her is a financial liability. Correct? That means, am I trading with financial liabilities or not? No. Yes. Read the first line. When financial liabilities are held for the purpose of being traded, you have to apply which accounting? FVTPL accounting. Now tell me, FVTPL accounting initial rule is what? Initial recognition should be done at fair value. On the balance sheet date, again you have to do fair valuation. Gain or loss will go to PRL. That's all. Come read the example. The market price of SBI share is 300 rupees. Mr. A borrowed 1000 SBI shares from the broker and sold them immediately in the market. Chalo sir, wait. Now that you sold, You received money 300 per share. I'm doing in 2000. Later on you can multiply. The moment you sold the share, you have an obligation to buy back. So financial liability with an amount of how much? 300 rupees per share. Okay, continue. The borrowing is for a period of 2 months. So on 1st March I have borrowed this and sold it. 30th April I have to buy. But in between, balance sheet date is waiting. On 31st March, the market price of SBI share is 290. Sir, tell me, on the balance sheet date you have to fair value your liability or not? Now fair value of liability ka meaning is, sir, if I have to buy the share today and repay, how much will it cost me? 290. But actually recorded liability of 300. That means even though my book value is 300, the worth of this liability today is only 290. That's good news, bad news for me? Good news. Why? Liability ka value is decreasing. So what you will do, financial liability will cancel with an amount of 10 rupees and you will book the gain in your PRL. Now latest, your financial liability is appearing at what value now? 290. Now next month ending, this fellow went to buy the share. Surprise, share price is 315. Good or bad? Bad. In our books, financial liability is appearing at 290. But to discharge that liability, today I have to pay an amount of 315. What is the entry I should write? Financial liability to bank. To bank amount is fixed, 315. Financial liability I will close with 290. I am paying how much extra? 25. That is a loss that will go to PRL. Everywhere into 1000 shares, if you multiply, our entries numbers will match. What account is ACM accounting? Fair value accounting, FVTPL accounting. You understand, sir? This example now 3 times we discussed. 1. While explaining current liability, liability is held primarily for the purpose of being traded. Our context I told you this example, short sale. Then, one more example. Contractual obligation to deliver a financial asset. Financial liability ka definition, I use this example. Now, FVTPL accounting, I am telling you this example. Is stock lending scheme till now in this limited hours only we discussed 3 times. Anyway, second point. This we will understand more clearly when we do business combination chapter, but as such, if you already know, you know. Contingent consideration payable in a business combination transaction is measured using FVTPL. On this, exclusive questions are also there. This is quite an important stuff when we do Ind AS 103. Next. Financial guarantee under derecognition of financial asset with continuing involvement is measured at FVTPL. Did you see it somewhere? Just 30,000 rupees, whatever liability you created, that is that only. That is part of this exceptional category. Next. Financial liabilities which are measured at FVTPL to avoid an accounting mismatch. Now you see, sir, this is the most lengthy one among these 5. Okay. This, till last exam, I used to ask the students, if you want, I will teach. If you are up for it, if you can take this, I will teach. Because there was never any question on that. There was only one question which I only created in the class. That obviously will not come. So, why to trouble people? And I used to give an option. But RTP May 2025, question came. Now that question has come, I will not ask you, do you want or not? You will be served it anyway. So, but to understand this, you need a little bit of background, sir. So, go on listening the story. So tell me, what is the fair value of a bond? Sorry, the SFM no, sir. Simply, sir, ask. Array, formula I am asking. Number 100 is telling. Present value of future cash inflows discounted at your YTM rate, or since I am working out theoretical value, I will call it as required rate of return. Whose required rate of return? Required rate of return of the investor. Always remember, sir, discounting rate will be what return he wants. Investor wants, that will be the required return. Okay. In a bond cash flow, cash flows will be 2 types. One is coupon, the other one is maturity value. Required return of the investor, sir, if I ask you, sir, you want to invest in RIL bonds, how much return do you want? Okay, sir, some 45% I am happy. Not like that. Your greedy, stupid return. How much return you want is risk-free rate plus, because RIL is a risky company, for taking the risk you want certain extra return. That is called as risk premium. A risk premium depends on the risk of investor or borrower. Only two parties are there, sir. Sir, I want extra return based on how risky I am or how risky you are, sir. So obviously the borrower, how risky it is, investor will expect that much extra return. Okay, risk of the borrower. This, of course, risk-free rate is not in your hand or the marketly interest rate. So what will impact your required return from a bond is two things. One is market interest rate, one is the risk of the borrower. If market interest rate is high, RR also will be high. If risk of the borrower is high, then also RR will be high. Okay, now tell me this. For some reason RR increased. What will happen to value of the bond? What will happen to value of the bond? It will decrease. Sir, discounting rate if I increase, present value will automatically fall. Similarly, RR decreased, then value of the bond will increase. Now, if I ask you, why did RR increase? Tell me the reason. You can see either market rate has increased or the risk of the borrower has increased. Therefore, my expectation from the investment also has increased. Similarly, when RR decreased, market interest rate decreased or riskiness of the borrower has decreased. Therefore, I expect a lower return. Are you theoretically comfortable up to here? Sure. So, this is not at all related to FR. This is some other subject. But you should be able to link it. That is also in the same group. Okay, don't put surprised faces. Fine. Now, come here. This is company balance sheet of A Limited, guys. This fellow is having a portfolio of assets. And this portfolio of financial assets are, let's say, investment in bonds. And to make this investment, he made a borrowing also by issuing some 10% debentures. And they manage, this is a financial liability obviously, they manage this entire thing as a group. That means financial asset and financial liability are managed as a single portfolio. When you did portfolio management, did you come across cases where in your portfolio you have security A, security B and a short sale security C? Did you do security A, B, risk-free borrowing? A risk-free borrowing, short sale, they will have negative weights. Remaining investments will have positive weights. You would have come across questions like that. That means in your portfolio, there is a possibility that negative assets are also playing a game. Here, sir, this fellow funded his assets using a borrowing and they are managing it as a single portfolio. What is the meaning of this is, he will not keep the borrowing and sell the assets. Not like that. It will be sold as a package. If somebody wants to buy, they will buy the assets also, liability also. This is managed like that. Okay. Now, carefully watch, sir. Investment in bonds, since it's a financial asset, how many methods are possible? ACM, FVTPL and FVTOCI. And financial liability debenture, normally only one method. Now, who is that? ACM. Now, watch this correctly, guys. Suppose, sir, market interest rate increased. Market interest rate has increased. Now, what will happen to value of financial asset? Carefully think and answer. There is no hurry. You are not at all in a hurry. Answer is very, very important stuff. Market general interest rates increase, sir. So this one increased. If this increases, RR also increases. Required return of the investor. Who is investor here? A Limited only. A Limited ka return, required return will increase. So bond value will fall. That much you need not think, sir. They have inverse relationship. If RR increases, bond value will fall down. So value of financial asset will fall down. Are you happy or sad with this? Sir, your asset ka value has fallen down, sir. Sad or happy? Sad. Okay. What about value of financial liability? Sir, I am not asking about book value. Normal, market value, fair value. Fair value of financial liability will also fall down. Sir, why will it fall down? Sir, bond is bond, sir. Market interest rate increased. Obviously, RR of the investor, you are not investor here. Somebody else is the investor. That fellow's return increased. Obviously, bond value will fall down. Only thing is, I am not sad now. I am happy. Why am I happy? My liability value has come down. therefore I am happy. My asset value came down, I am sad. Tell me, overall you are completely happy, completely sad, mixed feeling? Mixed feeling. Take the reverse case also. Market interest rate dropped. Financial asset value will increase. You are very, very happy here. Financial liability value also will increase. You are sad here. Again, overall, you are either net basis la happy, net basis la sad, but not complete happy, complete sad. Are you understanding till here? Sure. Okay. Just last safe side, sir. If interest rate increases, whose required return will increase? Investor ka required return. Now watch this correctly. As far as these bonds are concerned, we are the investor. As far as this debenture is concerned, somebody else is the investor. Whoever is investor, that fellow's required return will increase, and consequently his asset ka value will fall down. Our asset ka value fall down, his asset is our liability, this value also will fall down. Are you understanding, sir? Chalo. Now look at the accounting problem here. Suppose I am following ACM here, I am also following ACM here. Will I do fair valuations? Since I will not do fair valuations, there is no issue only. But if you are measuring the financial asset at either FVTPL or FVTOCI, then definitely you will do fair valuation. When you do fair valuation, each side of accounting, each part of accounting will get accounted. I mean this part. Your sad part or your happy part relating to financial asset will get accounted. But financial liability ka basic accounting model is what? ACM. Since you are following ACM, each side ka accounting is not happening. That means your financial statement will only show only one side of the picture. Financial asset related happy or loss, only that will be reflected in your financial statements. But financial liability related gain or loss will not get reflected. Is it not misleading financial statements now? For example, sir, here I have 1000 loss, 900 happy. Overall my loss is only 100. But now only this is getting accounted, this is not getting accounted. Why this is not getting accounted? Because liability is accounted using ACM usually. This is called as an accounting mismatch situation. Accounting mismatch. Overall I don't have that much happiness or that much sadness. I have mixed feeling, but only one side of the picture is getting reflected in the financial statements. This is called as an accounting mismatch. Now, when this kind of scenario you encounter, what the standard says is you eliminate the accounting mismatch by measuring the financial asset also, financial liability also using FVTPL. That means you will follow FVTPL here also and you will follow FVTPL here also. If you follow FVTPL both sides, what will happen? Both sides fair value will happen. When both sides fair value will happen, financial asset related ka gain, financial liability ka loss, both are accounted where? In PRL. Offsetting, net effect will happen. Are you getting, sir? My entire goal is to bring reality into financial statements. Reality is not completely happy, not completely sad. I have mixed feeling. A mixed net feeling is not coming into my financial statements. Really, I am not that sad. But my P&L account shows a loss because financial asset side only is getting accounted. How will you eliminate the mismatch? Both of them start accounting at FVTPL. When both of them are getting accounted at FVTPL, both the sides will get fair valued. Gain and loss from each side will enter into your PRL. That's how you eliminate the accounting mismatch. I hope I am clear. Sir, are you sure accounting mismatch situation understood? Because the story did not get over. It's going to start now. You thought this much is? Haha. If it is only this much, why will I scare you? Okay, look at this. Sir, up to here if clarity is there, then I will go ahead. In this any doubt is there, we have to recap again because there is a question on it now. So tell me, if interest rates in the market increases, investor ka required return increases, his asset bond value will fall. If you are the investor, your asset value will fall. If you are the borrower, your investor ka asset, that means you are borrowing only, its value will fall. You are having both. Now that you are having both, one side happy, one side sad. It is a natural hedging case, to be honest. I am exposed to interest rate risk. I have an interest rate asset, I have an interest rate liability. When interest rate dances, both sides will have impact and those impacts will hedge each other. I will only exposed to the net gain or net loss. It's a natural hedging scenario. Are you getting it, sir? Chalo. Now watch this. This time I am showing you only one part. Focus only on this. I have a 10% debentures. A 10% debentures obviously is a financial liability which is getting accounted at FVTPL. Now sir, why did you account this under FVTPL? To avoid a accounting mismatch situation. Our story you leave it now. Okay, now the value of this debenture, let us say 1000 rupees. Now sir, marketly interest rate went up to 12%. You tell me what will happen to value of debentures? Market interest rate has increased, sir. Therefore, revised required return is 12%. Who is expecting required return here? Not you. Your investors. They want how much return from you? 12%. Required return has increased. What will happen to value of debenture? It will fall. Very nice. Let's say the fair value of the debenture is now 920. And now that you are following which method? FVTPL. You tell me, sir, what accounting entry I should do? From 1000, I have to bring it down to 920. Tell me the entry. 10% debentures, or simply I'll write financial liability account debit 80 to PRL. An amount of, in this any doubt is there? This is 100% correct accounting. Okay, this is one case. Leave it. Next case. Risk of borrower increased. Who is borrower? We only. I'm the borrower, no sir. My risk has increased. Sir, how do you know, sir? I already defaulted on some other loan. I am suffering losses. My product has lost its market. You have multiple factors. Once bad luck kisses you, it won't stop there. Risk of borrower A limited increases, and because of that, revised required return is 12%. Leave it here. The second case. Fair value of debentures. Okay, wait. 12 will be confusing. 13%. Fair value of debentures is now 880. In your books, present value is appearing. Sorry, book value is appearing at what? 1000. Now you have to reduce it to 880. Now what is the entry you will write? Financial liability account debit 120 to PRL 120. Till here clarity is there? Okay, now watch this. What this standard says is, if you became more bad, your financial liability value has fallen down. Have some shame at least. How can you increase your profit? On one side you are becoming bad. Why did I become bad? I already suffered loss. Sir, imagine I am Vijay Mali, sir. I took 10,000 crores from SBI. Okay, I started suffering losses. Now what will SBI say? Sir, 10,000 crores you don't pay, sir. 3,000 crores you pay. I will go away. Who offered this? SBI only. Why is he willing to accept only 3,000 crores? I became more riskier, sir. The more he waits, the chance of getting that also will deplete. So he says, I'm okay with 3,000. Deal is nice. So what did I do? Instead of 10,000, I paid only 3,000. 7,000 crores, I'm putting it in my P&L account and I'm increasing my EPS. He came for the deal because my profit and loss is already showing negative. And now I'm becoming a positive company because of this deal only. And my EPS will start shooting up if I put this in PRL. Our standard has a problem with it. The standard says, no bro, financial liability getting measured at FVTPL due to accounting mismatch is okay. But if your financial liability value changes because of changes in own credit risk, are resulting gains or losses should be transferred to OCL, reserve you kept, and not to PR. And this is not reclassifiable. This is quite deep, sir. On this question is recently framed in the exam, means RTP. A casual reading, the nothing will go into your head. This much of background is, background is all preparatory story, sir. The main story starts here. When you start fair valuing your financial liability ka value, why will it change? Financial liability ka value changes because required return of the investor changes. Required return changes because of two reasons. One is interest rate change, one is credit risk change. When interest rate change, your financial liability value changes. I don't have an issue. Happily take it off to PRL. But if you make a gain because you yourself became a bad company, that kind of gain cannot go to PRL. That has to be transferred to OCA reserve. And that gain or loss, whatever you are booking in OCA reserve, is not reclassifiable. Are you understanding what I am trying to say? This one, sir. Whatever story I told, all this I have written here, so you can go through it. Just to read this last note point. When the liability value changes due to change in required return of the investors, it will result into a gain or loss which is recognized directly in PRL. The general rule. However, if there is a gain, of course, or loss due to decrease in the value of financial liability, which is caused by an increase in entity's own credit risk, then such gain will be recognized in P&L, not PRL, P&L OCA reserve and not in PRL, and this is a non-reclassifiable gain or loss. We are talking about what, sir? Financial liability is getting measured at FVTPL. In that deep one case, sir, a gain or loss cannot go to PRL. It has to go to OCA. Sir, I did not create the subject, okay? It is there what it is. I am not complicating it. I am just showing you the reality. This is how it is, sir. I will just show you one more small point. Wait a moment. Okay. Yesterday, when we were talking about Schedule 3, there was something. I was showing you in equity what is there. Equity share capital is there, other equity is there. Other equity OCA items are there. OCA items, some are reclassifiable, some are non-reclassifiable. Now you see, reclassifiable, first item you read, you will be able to spot it. Gains or losses in investment in debt securities. It is what, sir? Other than investment in equity, any other investment which is measured at FVTOCI, that is reclassifiable only, no? First one. Next, come to second bit, B bit. Gains or losses relating to investment in equity shares measured at FVTOCI. Reclassifiable or non-reclassifiable? Non-reclassifiable. That is that. Now come to D bit, please. Change in the fair value of financial liabilities due to entity's own credit risk. The non-reclassifiable item. Sir, these are all OCA items ka background, so you should be able to link it. Yesterday I can't explain all this. I could explain only revaluation surplus to you. But today, 3-4 items are covered. Ind AS 19, one more. Ind AS 21, one more. Over. Cash flow hedge, last slide will come. Over all OCA items are sorted there. If you do not know OCA items, sir, later on some questions or problem will come in consolidation, business combination and all. How to close the accounts, they will very keenly ask. So for that reason. Okay. Okay. We were talking about this one, sir. Financial liability which is getting measured at FVTPL to avoid a accounting mismatch wala situation. When you do this, any gain or loss in your financial liability arising because of our own credit risk, that kind of gain or loss cannot be posted in your own PRL. That is an exception. That will go to OCA. FVTPL exception. In that, one more exception. And this is the only case where financial liability something is going to OCA. What did we say starting? FVTOCA is not there for financial liability. Exception. Now on this, I'll show you the question which came. This is a derecognition case. No, this is all basic stuff. I hope a question is there. It's there here. Come here, sir. Question number 22. Once go through it. ECL Limited has taken a loan of 10,000 rupees at 15% per annum for 5 years. This is a loan which is to be measured under FVTPL to avoid an accounting mismatch. Measure the fair value of the financial liability at the end of first year. A loan is how many years loan? 5 years. Already 1 year is over. He is standing at the end of first year and he is asking you to do FVTPL accounting. So you have to work out the fair value of the loan at the end of first year. What did we discuss, sir? Fair value ka formula for loan cases is what? Present value of future cash flows only. That's all you have to do. The required return from the company has gone up by 3%. Once upon a time it was how much? 15. Today it gone up by 3. That means what is the RR? RR of investor is 18%. Sir, why did it increase is important for us. And the increase in the required return is due to increase in the market interest rate. That means when RR increases, value of the liability will fall down. Discounting rate, sir, discounting rate increases, present value will fall. And now I am talking about liability. Liability fall is a gain for me. And this gain is coming because of own credit risk or market interest rate. Market interest rate. Now I do not have an issue. Happily I can take it off to PRL. So what you will do, already in my books, asset will be appearing, liability will be appearing at 10,000. Revised RR is 18%. 18% when I discount, its value is coming down to 9193. So from 10,000, I have to reduce it, downgrade it to 9193. So you will have a gain of 807. Gain totally recognized in PRL because it is not because of own credit risk, it is because of market interest rate. Next, case 2. The required return from the company has gone up by 3%. So now also RR is 18%, out of which 1% is due to increase in the market interest rate and 2% is due to increase in entity's own credit risk. So out of 3%, some is because of own risk, some is because of market interest rate. That means what you have to do, overall here also fair value is 9193 only, your gain overall is 807 only. But in that 807 rupees, which is because of 3% upgrade in your RR, 807 some is because of market rate, some because of own credit risk. Sir, how will I split it? 1:2 and all is wrong, sir. That is not ratio there, the discounting rate. What you should do is, presently your RR was 15. Imagine if only market interest rates would have gone up, then RR would have been 16%. Go take 16% as discounting rate, work out the fair value of the liability. So to that extent of decrease is your market interest rate change. Remaining decrease is because of own credit risk change. Okay, like that. So here what I did is, present book value is 10,000. At 18%, overall it is coming down to 9193 already calculated. So overall decrease is 807. Now 807, how much is because of market interest rate? So what I did is, I took only 16% discounting rate. I worked out the fair value of the liability. It came to 9720. So the decrease is how much? 280. That means from 10,000 to 9720, 280 rupees is because of market interest rate increase 1%. That means a remainder decrease, whatever is there, that's because of entity's own credit risk. So 807 is split it into two parts. 280 is the balancing figure. That's all. I wrote the entry. Financial liability account debit, total 807. 2 PRL 280, remainder is going to OCA reserve, and that is non-reclassifiable. Are you getting it, sir? E question, we classroom dictated question. Pakka will not come. But somebody listen to that seriously. RTP May 2025, they framed this question. Go through it. On 1st April 20X1, ABC Limited issues a 10-year bond with a par value of 15 lakhs and an annual fixed coupon rate of 8%, which is consistent with the market rates for bonds with similar characteristics. What is it trying to tell you is, we issued a 10% bond with a coupon rate of 8%. Okay. ABC Limited uses SOFR as its benchmark interest rate. You did IRRM chapter? You found SOFR, Sonia, all this there? You didn't find it, huh? Okay. You know LIBOR, MIBOR and like that, SOFR is also one base. Secured overnight financing rate. Okay. ABC Limited uses SOFR as its benchmark rate. At the date of inception, SOFR was 5%. Wait there. Sir, this particular bond ka coupon is how much? But SOFR is how much? SOFR is an interbank rate, sir. So you understand that as risk-free rate. So when market risk-free rate is 5%, you issued bonds with a coupon of 8%. That means how much extra are you paying? 3% is because of your own risk. That you have to catch from that entire story, sir. Now he is telling SOFR, at the end of first year, SOFR has decreased to 4.75%. So what is RF now? 4.75%. What is your risk extra return? 3%. So this is total 7.75%. So ideally, public should expect from you a return of only 7.75%. 7.75% is your revised required return. Okay, next. He says the fair value of the bond is 15,38,110. This value is consistent with an interest rate of 7.6%. What is it trying to tell you is the ultimate fair value of your liability today is 15,38,110, and this is consistent with an interest rate of 7.6%. That means your actual RR, what he has used is 7.6%. We'll decode all that. Timing, go on reading. The remaining cash flows on the bond are 1,20,000 per annum for 9 years and 15 lakhs at the end of 9th year. Why like that? Because total 10 years of 1 year is over, like that. These cash flows are discounted at 7.6% and which is equal to the above 15,38,110. ABC Limited assumes a flat yield curve that all changes in the interest rate result from parallel shift in the yield curve, and that the changes in SOFR are the only relevant changes in the market conditions. Following discounting factors and all they have given. What is the amount? See the question he is asking. What is the amount that is to be transferred to OCA at the end of first year when the bonds are measured at fair value? Lastly, he is telling that bonds are measured at fair value. We were doing this concept. You are in this. You are reading with that background. Imagine a question independently. You see, he is talking about a liability. Why is he giving fair value? Nothing. No explanation. Last one line. Bond is measured at fair value. Why is liability measured at fair value? Accounting mismatch ka story. A entire story lo one small point like exception case lo OCA part alone he wants. Deep. Okay. Now watch this, sir. What's the question number? 23. Okay. At end of year 1, we will work out. See, they have given, sir. Okay, fine. At the end of year 1 is not required. Fine. It's okay. Fair value of financial liability is 15,38,110. Number correct? At revised RR of, what is the revised RR? 7.6%. You need not calculate this. This fellow already gave you. Okay. Now, on date of issue, RR is equal to 8%. On the day SOFR is like your risk-free rate, which is given as 5%. That means the extra 3% is the risk premium. For the risk of our company, public expect an extra return of 3%. But as on today, SOFR 4.75%. Now 4.75%. Now revised RR of investors 7.6%. From this, can you identify how much is the risk premium? 2.85%. So, did your own credit risk change or not? Own credit risk. Change in own credit risk. Do you understand this? Now, before I go into any of the numbers, I just want you to observe one small point so that life becomes very easier. First day when I issued bonds, RR was how much? 8. By the end of first year, RR came down to 7.6. Discounting rate has decreased. Liability value will increase. This is not a gain case. The entire sum is a loss case. Previous example, sir, RR increased, liability value decreased. Adi gain. This is not a gain scenario. This is a loss scenario. First, understand that. Now, existing book value, existing carrying amount of loan before fair valuation. How much is existing carrying amount of the loan? Sir, how will we know, sir? Arey, sir, how will you not know? Which method are you applying? FVTPL. FVTPL initial recognition is at fair value only. You will not apply any EIR and all. So original date, whatever you wrote, that only will stay. How much is that? 15 lakh rupees. Fair value of loan at the end of year 1. Already question they gave, you need not even compute. 15,38,110. Tell me, sir, therefore, loss on fair valuation. How much is that? 38,110. Normally what we will do, since you are applying FVTPL, the entire thing you will go and dump it in your PRL. But based on this analysis, what did you observe? Our company ka own credit risk has changed. To that extent, you have to go into OC. That's the only thing you have to compute. Tell me, sir, your own credit risk decreased or increased? Decreased. By how much? From 3, it came to 2.85. That means 0.15%. 0.15%. Are you getting it, sir? Now, your job is, 38,110, how much change is due to change, how much is due to change in market interest rate, and how much is due to change in own credit risk? What is there, sir? One you work out, other one will be balancing figure, as simple as that. Okay. Now, so what is the RF today? 4.75% plus my original risk premium 3%, 7.75%. Take 7.75% as the discounting rate. Here I did not disturb the credit risk, I disturbed only the market interest rate. So I will get the fair value of the liability only because of change in the market interest rate. That will go to PRL, a remainder gap will go to OCA. Now how I will try is fair value of financial liability. If there is there is no change in own credit risk. If our company ka risk did not change, then market la RR would have been 7.75%. Your future cash flows are how much? 1,20,000 per annum into PVIFA 7.75% for 9 years plus 15 lakh rupees into PVIF 7.75% 9th year. So somebody, for the love of God, fast, 7.75% 9 years annuity factor. That fellow gave, he gave 7.75% up to 9 years. So this one 6.312. 15 lakhs, 7.75% 9th year. 51.1 paise. Don't play cheap games. 0.511 paisa. What will it do? Chalo, fill it up. Multiply, sir. Multiply and tell me. 15,23,940. Therefore, increase in value of financial liability 15,23,940 from your existing value of 15 lakhs. That means you are suffering a loss of 23,940 rupees because of interest rates due to market interest rate. But your actual loss is not 23,940. Your actual loss is 38,110. 38,110 la 23,940 is because of market interest rate. This will go to PRL and this balancing figure will go to OC. Tell me the number, sir. 14,000. That's all. That will go to OC. This is a question, sir. This takes lot of effort to understand, but it's all worth it, sir. The question comes for 8 marks. Answer is almost a small number, sir. Ultimately, see, 1538 also you did not calculate. They only gave. Your idea is to understand the provision correctly, understand this part of the story. That there is a change in the own credit risk. The moment that changes, something will go into OCA. That's all. That's a case, sir. Check the answer. It should match. It will match, obviously. Will it not match? 14,170 rupees. Sir, any doubt? Sure, Pakka. Sir, you have to. Yes, sir, please ask. I didn't understand your doubt. Ask again. We took the other one as a balancing figure, you mean? Here also do. What is there? Instead of taking 4.75 plus 3, take 5 plus 2.85. Take
directly you will get your desired answer only, 14,170 answer directly you will get off. Why I did not do that? If you are asking, that fellow gave PV factor for 7.75%, no. That's why I did not. If you try that, you will get directly 14,170 you will get off, 100% you will get. You have to, there is no option, it has to be that. Okay, last point, sir. You won't break, I understand, but after that, I can understand. Okay, last case of FVTPL we'll finish off and then we can take a break. So that is financial guarantees that are measured using FVTPL. Financial guarantees that are measured at FVTPL. It's a very, very, very important case. This independently is 8 to 10 mark stuff. Okay. Now I'll take an example of the question only, sir. This data we'll try to solve it so that in the process I can explain also. Chalo. Question number 24 you read, sir. Guarantee ka accounting. If you ask any CA inter boy, sir, guarantee what is the treatment? That fellow will say, sir, it satisfies the definition of contingent liability and therefore contingent liabilities only should be disclosed. Contingent liability ke classic example is guarantee only. But in Ind AS regime, sir, contingent liability is accounted as a real liability. And for that FVTPL accounting has to apply. Now, sir, it's like some fellow is taking a loan from a bank. I went there and gave guarantee to the bank on behalf of the borrower. When will that liability crystallize on me? When he makes a default, then only I have to pay. Correct, no, sir? Otherwise, I need not pay. Now, how will you do accounting for this kind of financial guarantee? Let's see with an example. Read the story. So, only first paragraph you read. That's enough for us. On 1st April 2021, Fortunate Bank has provided a loan of rupees 25 lakhs to Mohan Limited for 4 years at the rate of 10% per annum. And the loan has been guaranteed by Surya Limited. So, there are three parties. One Surya Limited, one bank and one Mohan Limited. Mohan fellow took loan. Surya guy, he gave guarantee to the bank, which is a holding company. Of course. Interest payments are interest payments are made at the end of each year and the principal is repaid at the end of loan term. Loan term is how many years? 4 years. If Surya Limited had not issued a guarantee, Fortunate Bank would have charged Mohan Limited an interest rate of 14%. So, if bank has to give loan to Mohan without any guarantee, bank feels more risky and bank will charge higher return of 14%. But because Surya gave a guarantee on behalf of Mohan to the bank, bank feels that our risk has come down. So we are happy with a 11% interest rate. So instead of charging 14, they charged 11 because that fellow's parent has given a guarantee to the bank. Surya Limited does not charge Mohan Limited for providing the guarantee because parent-subsidiary relationship is existing there. If he charges, he will take money. What is there? This is enough for us, sir, to start with. Watch this example. Question number, sir? 24. Watch this, sir. There are three parties here. One is Surya Limited. He is the guarantor. And there is Mohan Limited. This fellow is a beneficiary of guarantee. And the person who received the guarantee is not Mohan, no, sir. That is a bank. Fortunate or unfortunate, whatever bank it is. This bank gave rupees 25 lakhs loan to him at the rate of 10, I'm sorry, I told 10%. Okay. But in their mind, actually they wanted to charge how much return? 14%. But they charged only 10% because Surya Limited gave a financial guarantee to them. Sir, is standard, sir, even though guarantee accounting is mentioned, guarantee accounting is explained only in the books of guarantor. The standard does not cover how this fellow or this fellow will do the accounting for guarantee. Standard does not give any story about that. So this fellow received guarantee, Surya Limited gave guarantee. Our standard actually covers accounting only in the books of Surya Limited. Now, how you have to think is 25 lakhs into 14%. The normal interest, how much they would have charged? Compute this. 25 lakhs into 14%. 350,000 per annum. But actually they charged how much? 10%, which is 2,50,000. That means the bank agreed to forego an amount of
1 lakh rupees looking at the guarantee. So this I can call it as savings to Mohan Limited due to guarantee given by Surya Limited. Now watch this correctly, sir. I have a small concept point here. If bank agreed to forego 1 lakh rupees, that is because banker risk has reduced. Why banker risk has reduced? Guarantee is received from Surya Limited. Risk who took now? Risk who took, sir? Nobody took. If Mohan does not pay, who has to pay that? Surya. So Surya assumed this risk. And our risk measure is 1 lakh rupees per annum over a period of 3 years. Sir, 4 years. 1 lakh rupees per annum over a period of 4 years. Sir, if bank agreed to forego 3% interest income means banker risk has reduced, our risk only is now taken by Surya Limited. So Surya Limited point of view, if you ask what is the worth of the guarantee, how he will measure is on day 1, fair value of guarantee liability for Surya is equal to present value of interest savings due to for Mohan Limited. So how much saving is he making? 1 lakh into how many years? 4 years. What is the normal interest rate? 14% for 4 years. Please do this, sir. 1 lakh PV factor, you tell me. 14% 4 years. 2 point? Final answer you're telling. Okay. 2 lakh 371 to 2.9137. Okay, fine. 2,91,371. So Mohan, sorry, not Mohan. Surya Limited, what he will do is, first day, sir, on this you have to apply FVTPL accounting. Initial recognition should be done at what value? Fair value. So he will go and record two financial liability guarantee, an amount of 291,371. Sir, debit where? Listen carefully. If you receive money, debit bank, if you receive money. If you don't receive money, that's a loss, debit PRL. But here, you did not receive money, you did a favor to your subsidiary. Already we have learned this. When a parent does a favor to subsidiary, which will not come back, that should be debited to investment in equity shares of subsidiary. That's exactly what you will do here. In particular case, this is correct. For this sum, if the question told you that they gave you 1 lakh rupees, bank you debit 1 lakh, a 1,91,000 remaining, that you debit it to investment. So if you tell me, sir, the other fellow is not my associate, not my subsidiary, nothing, loss, debit to your PRL. Remember that concept of continuing involvement of 30,000 guarantee. Where did you debit? PRL you debited. Why you did not receive any money there? FVTPL accounting, no, gain or loss will go only to PRL. That's why all three options should be there in your mind, but E question ki investment is correct because that fellow is a subsidiary for you. Clear? Now, this is first day accounting, sir. Now let's move on. At the end of year 1. At the end of year 1, what you have to do? You have to do the fair value of your financial liability. Now, whatever technique you applied on day 1, same technique you apply now. Fair value financial liability is present value of remaining interest savings. Sir, out of 4 years, 1 year is over. Till now, default did not happen. Now, as a guarantor, I am little relieved. No. Originally, I took risk for how many years? 1 year is over. Till now, default did not happen. So, my feeling inside is little happy only. No. So, my liability value also has to be decreased. So, your measurement will be like 1 lakh into PVIFA 14%. This time for how many years? 3 years. Do the math. 2,32,000. Very nice. 2,32,163. So already my liability is appearing in my books at what value? 291. From 291 you have to come down to 232. Wait there. What this standard now says is, you are measuring financial liability guarantee based on the interest savings. That's what you did till now. But in reality, if that Mohan Limited, the borrower, he is becoming more and more riskier. He did not make a default in this, but outside he is becoming riskier. If he becomes riskier, the chance of bad debt also will increase.
and that is not getting captured into this. So what that fellow says is, this calculation you keep, also separately calculate loss allowance. Sir, loss allowance means what, sir? Array, sir, ECL ka steps are what? Identify the cash flow that you are not going to receive. If a default occurs, discount it to today, multiply it with the probability of default. That can be either a 12-month probability or that could be a lifetime probability. A ECL story is there. A ECL story you have to apply and work out the amount of loss you will suffer if that fellow makes a default. And now 1 also is one fair value of liability, 2 is also one more loss. So between these two, select the higher one. So between these two, select the higher one. Now read the question ka first paragraph, please. On 31st March 2022, there is a 2% probability that Mohan Limited may default on the loan in the next 12 months. If Mohan defaults on the loan, Surya does not expect to recover any amount from Mohan Limited. So there is how much chance of default? 2%. If that fellow defaults, we have to pay the entire amount to the bank. Now cash flows, which cash flow and not detailedly they did not give. So what we will do is we will assume entire 10 lakhs. Into, what is the chance of this? 2%. How much is that, sir? I'm sorry, loan amount is different. How much is loan amount? 25 lakhs. So 25 lakhs into 2% is how much? 50,000. So in one version, if you see, the worth of the guarantee is 232. In another outside angle, if you see, the possible loss is 50,000. We want to be prudent in our game. So measure the higher number as your loss. How much is the higher number? 2,32,163. So this one is taken as your fair value of the liability. Already your liability is appearing at 291. So from 291 come down to 232. So your entry will be financial liability guarantee account debit to PRL. So 291,371 minus 232,163. Check it out. 59,208. At 10 rupees, ignore it, rounding of error. You only did, of course. Okay, next year. Second year ending. There is a 4% probability that Mohan Limited may default on the loan in the next 12 months. If Mohan defaults on the loan, Surya does not expect to recover any amount from Mohan Limited. That means, now if I go to the end of year 2, again, sir, higher off. First one, fair value of financial liability. Second one, expected credit loss. Fair value of financial liability, now out of 4 years, 2 years is over. So I have to take present value of savings in interest for how many years? 2 years. PVIFA 14% up to 2 years. How much is that? 164,666. ECL you work out 25 lakhs loan into how much chance? 4%. That is only 1 lakh. Between these two, whichever is higher. This is higher. Anything is wrong, sir? Correct only, no? 164,666. So your liability should be measured at 164,666. But your liability is already appearing at what value? 232,163. Therefore, 232,163 minus 164,666. Financial liability guarantee to PRL 60. 67,497 will go to your PRL. Second year ending. Finally, one more time. At the end of year 3, again, there's no point of reading the question, sir. It will be same thing here. Fair value of financial liability. One more 1 lakh, because 3 years is over, 4th year ka payment is only there, into PVIF or PVIFA, both are same only. 14% for 1 year. 1 lakh, answer, sir, 87,719. Either this or your expected credit loss, which that fellow says that it is 5% chance of loss. So 25 lakhs into 5%, 1 lakh
25,000. This time this fellow got selected. So last time we measured our liability at 1,64,000. Now we have to measure this at 1,25,000. So how much your gain is? 164,370. Sorry, 164,666 minus 1,25,000. Your entry will be financial liability guarantee to PRL 39,666. Tell me, sir, now you are standing at the end of year 3. Your financial liability carrying amount is now 1,25,000. E question stopped here only. They did not ask you what happened in 4th year, but I will not keep it. Answer. Year 4, sir, last due date, your subsidiary paid full amount to the bank. You tell me how much is your guarantee worth? 0. Why 0? That fellow paid, sir. Do I owe anything now? I will not owe anything. Don't do calculations and all, that's basic common sense. I don't owe anything to the bank. So the worth of the guarantee liability is 0. You enter 1,25,000 will jump off into your PRL. Sir, what if that fellow made a default? Nothing he paid. We have to pay an amount of 25 lakhs. But my liability in my books is how much? What should you do? Increase it to 25 lakhs. PRL debit to financial liability guarantee 23 lakhs 75,000. So your financial liability will now appear at 25 lakhs. Next entry, financial liability to bank 25 lakhs, 25 lakhs. This is the worst thing that can ever happen. You gave guarantee on somebody's behalf. You thought that 5%, 2%, 1% like that. You booked 1,25,000. Ultimately 100%. He did not pay. So entire 25 lakhs liability will fall on your head. Update this liability, settle it off. Our question till date never came. See, they are asking only accounting up to 3rd year ending. 4th year ka story they never ask. So with that, sir, we are done with our financial liabilities which are measured at FVTPL. Now, post break we will start with debt restructuring is there. Following with debt restructuring, we will go into compound financial instruments, derivative, embedded derivative, and we are done. Okay guys, in financial guarantee which is measured using FVTPL, in the books of guarantor, first go and calculate the benefit because of guarantee. That's nothing but a savings in the interest cash flows. Fair value of guarantee given is present value of future savings in interest cash flows discounted at borrowing rate applicable without guarantee. The first day amount, with that create a liability. You will debit either bank or PRL or investment in subsidiary as the scenario may be. On every balance sheet date, subsequently remeasure the liability at higher of fair value, that is present value of remaining future savings in the interest, or number 2, loss allowance. The loss allowance concept is literally similar to the ECL method what we studied. So your expected loss amount into probability of default, whichever is higher. Any increase or decrease in the financial liability guarantee is recognized in PRL because the method is basically FVTPL. Now, in the books of the beneficiary, what accounting you should do, standardly there is no guidance given on that. But in case the subsidiary has paid any amount to the parent company, it's an expenditure what they are incurring for getting a reduced interest loan for a period of 3 years. So this cost also is amortized to P&L account on a straight line basis. That is an accounting which is suggested based on generally accepted accounting principles, but as such there is no standard backing for that. That's why question also will not come. This question, this part, whatever we have just now done before the break, where we are doing fair value of guarantee and all, that is obviously it came 2 times till now. That's quite important. Okay, moving on. Next one is restructuring or modification of a financial liability. Now, sir, this question recently came in the concluded May 25 examination, sir. The 12 marks or something this question has come. This question is already existing question in study material only. That question as it is came off, sir. Will limited company question. But otherwise also is a good concept in the sense. Let's see how to do this one. Sir, this is our company ABC Limited. This fellow is having a 10% loan of 10 lakh rupees. Coupon rate obviously 10%. Imagine for convenience, EIR is also equal to 10%. On this loan, The remaining cash flows are like this: 0, 1, 2, 3, 4. Each year you have to pay 1 lakh, 1 lakh, 1 lakh, 1 lakh, and finally you have to repay an amount of 10 lakh rupees. And obviously on this loan you are doing ACM accounting. Now, do you agree that a 10 lakhs carrying amount is the present value of discounted at the rate of 10%? Do you agree that or no? Yes, because when you are applying ACM accounting, always your balance will represent the present value of your future cash outflows, because this is a liability. If it is a financial asset, I would have said future cash inflows. But anyway, it will represent the present value of future cash flows, for sure discounted at your EIR rate. Now what happens, sir? This company ABC is into financial difficulties. This fellow will go and tell the bank that, bank, I'm in deep financial shit, I can't repay the loan, you have to give me some concessions, some relaxations and all. Now usually bank need not give this, but how bank will think is, if I don't support this fellow today, he will ultimately wound up and I have to stand in queue. So it's better to restructure the debt and modify the debt instead of troubling your client. So bank, what it does is, it has restructured the cash flows like this. Bank told, don't pay anything here. Don't pay anything here. But hereafter you will be paying 1.5 lakhs. Lastly you pay 10 lakhs. That means your future cash outflows are modified now, correct? When future cash outflows are modified like this, tell me now, the present value of all these revised cash flows, is it equal to 10 lakhs? Sir? That is not equal to 10 lakhs. Your ACM gets disturbed now. Now ACM will not work. But this is a loan transaction which has to be accounted only under ACM. I don't have a choice. Now, these are your revised cash flows, sir, and that is your existing carrying amount. I don't have any choice other than to apply ACM. Tell me, how will I make ACM work? There are only two ways. Tell me. There are only two ways in which you can make ACM work. Basic common sense, you need not know any standard for this. Alternative number one, good. Revise the carrying amount of the loan. What you will do, discount all these cash flows to today. One present value will come. That amount I want, amount is not there, restated, remeasure it. From 10 lakhs, remeasure to whatever number comes. Automatically your loan account is remeasured at present value of your future cash outflows. Automatically ACM will work. This is one way. Alternative 2, revise the EIR. Meaning, if 10 lakhs is 10 lakhs only, future numbers change off. Identify that discounting rate which equates the present value of these cash flows to 10 lakh rupees. Work out EIR. Revised EIR. You can ditch this EIR, work out a fresh EIR based on the do ACM hereafter prospectively. In two methods, like anything you do, ACM hereafter will work. Mathematically you should know this. Okay. Now we will see what the standard tries to tell you. What the standard asks you is, okay, fine, you have disturbed the cash flows and all. Because of that, there is a loan modification. Now you have to establish whether a modification, whether it is a substantial modification or not. So either it will be a substantial modification or it would be a simple modification. And the standard says, if it is a substantial modification, you have to do an accounting which they call it as extinguishment accounting. As name is like that, but in that nothing else is there. Very easy one. Extinguishment accounting. Now, if it is a simple modification, on this actually Ind AS 109 is silent. How to do accounting when it is a simple modification? 109 direct provisions are not there. But your ICS study material did not keep quiet. That fellow gave two alternatives. Given in ICS study material. Those two alternatives are these two alternatives. So anyway, that alternative accounting and all we will see later on. So never came in the exam till now. Why it never came in the exam is it is not officially covered in Ind AS 109. But as such, questions do exist in study material. Okay. Now that it's part of study material, part of syllabus only, it can come also. So there is nothing like that. So we will see that later on. Now, whether I have to do extinguishment accounting
or whether I have to follow the two alternatives. That depends on whether you have a simple or whether you have a substantial modification or a simple modification. Now, how will I know whether a particular modification is substantial modification or simple modification? How will I know? For that, two steps are there. Step number one, what you will do is identify present value of revised future cash outflows discounted at original EIR. One number will come. Meaning, observe the screen, sir. These are your original cash flows. This will not be there. In this place, blue cash flows came off. What you will do is take this blue color cash flow, discount it with your original EIR of 10%. Don't go to market interest rate and all. That is wrong. The moment you bring market interest rate, that amounts to fair valuation. You should not do that. ACM knows, sir, why will you do fair valuation? That is wrong. So you continue with your existing rate. One present value will come. To this number, if you pay any legal or any modification expenses, add that. Let us say I got an amount of 11,20,000 after this. This you call it as A. Step number 2, identify the carrying amount of the loan, existing loan, and call that as B. Let's say that is 10 lakh rupees. Not only we took 10 lakh rupees. Now you have to see percentage change. 11,20,000 minus 10 lakhs divided by 10 lakhs. See, you have to express it as a percentage of your existing carrying amount into 100. Now, if the percentage change is greater than or equal to 10%, this fellow concludes that this is a substantial modification. In our case, we got how much here? 11.2%. That's very clearly greater than or equal to 10%. Therefore, they identify this as a substantial modification. Now that it's a substantial modification, you have to apply extinguishment accounting. You have to apply extinguishment accounting. Now, sir, how to do extinguishment accounting? Very, very, very easy step, sir. Only 2 steps. First step, whatever legal or modification expenses you have incurred, go dump that in your PRL. Dump it. Now, general English meaning of the word extinguishment is what? Extinguishment means that making something disappear. Fire extinguisher is what? It will make fire disappear, like that. So, you have to make your existing financial liability disappear. Sir, but I have liability, no, I owe the money to the bank in these revised numbers. Why should I make my liability disappear? How the standard asks you to do is, if now that the change percentage is 10% or more, the standard feels that you have way too much modified the loan. It is as good as now you took a new loan and you repaid this existing loan. That's what the standard is asking you to feel. Now the modification is so high that I can't treat it as modification anymore. It must be treated as a fresh loan. If you take a new loan right now, how much liability will be there in your balance sheet? I want that. So for that, what they are asking you to do is cancel existing financial liability and create new financial liability. Now think carefully and answer. A new financial liability is also loan only. On this you have to apply ACM only. And if I have to apply ACM, what's the fundamental rule? Initial recognition should be at fair value adjusted with transaction cost. I don't have any transaction cost and all, leave it. Fair value is what? Present value of your revised future cash outflows discounted at today's market interest rate. Because I am talking about fair value today. Fair value, how will you get? Today's market interest rate you have to take. Then fair value will come. So new fair value, new financial liability at PV of revised future cash outflows discounted at today's market interest rate. Now, effectively, if you execute this, it will look like this. Your loan account debit 10 lakhs, existing loan died, to loan new. E number is the present value of
all this blue color cash flows discounted with today's market interest rate. Is step number 1 also you did the same thing, but then you discounted it with your original EIR. Don't bring that original EIR and all. This is a new loan. So if you take a fresh loan in the market today, what interest rate will be applicable for you? Use that interest rate. So let us say you are getting 10,50,000. That means 10 lakhs liability disappeared, new liability came worth 10,50,000. Gain or loss of us? Loss. Of how much? 50,000. Loss and gains everywhere will go to PR. That's all over. Sir, hereafter what will happen? Hereafter what will happen is the new loan. Obviously you recognize that present value of future cash flows. Hereafter you will happily go and apply ACM on that. As simple as that. But all this accounting when will you do? When it is a substantial modification. Substantial modification or not, how to know is E3 steps. PV of revised cash flows discounted at original year. Here, if you are not careful, what kind of mistakes will happen is, here you may go and take the market interest rate and all. You should not do. New market interest rate you should bring only when you have to fair value. Fair valuation will happen only when there is a new liability. New liability will happen only when it is an extinguishment accounting. So you are still in the process of identifying whether it is a substantial modification or not. Don't even use market interest rate here. Question everything will be there, no sir. You should know what number to be picked up. Original EIR to you start. Present value of revised cash flows. Add expenses. E number and existing carrying amount you compare. If the gap is 10% or more, then the standard feels that this is no more modification. This is extinguishment. You would kill the existing liability, create a new liability. Like that you got to account. Clear? Now, on this one question is there, I will show you. Now, later on, if you tell me, sir, the percentage change is less than 10%. If percentage change is less than 10%, this is not a substantial modification. Just for understanding, I am calling it as a simple modification. If it's a simple modification, sir, on this guidance is not officially there in Ind AS 109. So whatever your ICA study material says, that is final answer for us. That fellow gives two alternatives. Alternative 1, what he tells is, whatever expenses you are incurring, that expenses you transfer it to PRL. Legal expenses, modification expenses, dump in PRL. Next he asks you to remeasure the carrying amount of financial liability to reflect PV of revised future cash outflows discounted at original EIR. Meaning, earlier, casually, mathematically, you gave me two alternatives. In that, second alternative. What is the second alternative we wrote? Sir, you went and disturbed this. E place like E cash flows came. ACM will not work. I have to make it work. What should I do? Change this number. Instead of 10 lakhs, have a different number. A different number should be how much? A different number should represent the present value of these cash flows. In fact, that number is nothing but this number. What is step number 1 ka first calculation? PV of revised cash flows discounted at original. A number you have to achieve. So your existing loan amount will either increase or it will decrease. The gain or loss that will go to PR. The alternative 1. Alternative 2 is also there. Alternative 2, what he is trying to tell is, whatever expenses you are paying, I expense adjust to the carrying amount of financial liability. What is your existing carrying amount of financial liability in this example? 10 lakh rupees. Suppose you paid some 20,000 rupees expenses. At 20,000 treat it as repayment of borrowing. So 10 lakhs liability will now become 9 lakh 80,000. Now keep this 9 lakh 80,000 here. In 9 lakh 80,000 you map with your remaining future cash flows, work out a new EIR and finish off the sum. So hereafter you will apply ACM not with your original EIR but with a new EIR. So overall broadly if you summarize, ACM will fail now. You have to make ACM work two ways. Either revise the carrying amount or revise the rate. Don't do both, it will not match then. Any one you should do, ACM will again fall in line, it will start applying. All this is one simple modification case. If it is a substantial modification, you have to do extinguishment accounting. Extinguishment accounting, kill the liability completely, create a fresh liability which will represent present value of remaining future cash outflows discounted at market interest rate today. So these overall 3 accounting treatments are there. You can see here. Extinguishment accounting principles are derecognize the existing financial liability,
Recognize a new financial liability at PV of future cash outflows discounted at current market interest rate. Any legal charges, modification expenses incurred will be transferred to PRL. Any difference arising as a result of the above should be recognized as gain or loss in PRL. This is extinguishment accounting. When the percentage change is greater than or equal to 10%. If it is less than 10%, then that is modification, simple modification accounting. Here you have two alternatives. First alternative is legal or modification expenses, put it in PRL. Remeasure the carrying amount of financial liability to reflect the PV of revised future cash outflows discounted original EAR, and obviously increase or decrease in the liability will go to PRL. Second alternative, expense you adjusted to financial liability, you go and work out a revised EAR. On this alternative 1, alternative 2 question never came till now, but as a study material questions are there. This came in the exam twice till now. Which one? Extinguishment accounting came. I'll directly show you that question. We'll quickly discuss it. Easy only, that is. This fellow only. Question number 20. This is there in study material, sir. Earlier names changed, came in the exam. It also came in May 2025 exam. Sir, mail already it came. Now it will not come. That kind of analysis don't do, sir. If it will not come for 12 marks, it may come for 4 marks. It can come as a part of MCQ, or again it can come for 12 marks also. You never know. Once what happened, sir? Ind AS 108 operating segments. Once came for 14 marks. 108 is such a standard where every attempt usually it won't come. So people took chance. A, B, C, Z category people put. Next exam again came. Much cheaper question, 10 marks. Had you at least studied something, you would have cooked there. You forgot the entire recipe, left it. What will you do in the gone 8 marks, 10 marks, whatever it is. So like that, you can't take risk. Read this. Wheel Company Limited borrowed 5,000 lakhs from a bank on 1st January 20X1. The original terms of the loan were as follows. Interest rate 11%, repayment of principal in 5 equal installments. Payment of interest annually on accrual basis. Upfront processing fees is 58,70,096. EIR is given as 11%. You observe, actually the coupon rate is how much? 11. But your EIR is 11.5%. Why they both are not matching? Because of your processing fees. Transaction cost is there. Because of that, your cost of borrowing has increased basically. On 31st December 20X2, that means second year ending, Wheel Limited approached the bank citing liquidity issues in meeting the cash flows required for immediate installments and renegotiated the terms of the loan with the bank as follows. So, second year ending modification has happened. Interest rate is 15%. And remaining outstanding principal in 10 equal installments starting from 31st December 20X3. So hereafter, whatever outstanding principal is there, that will repay it over a period of 10 years. Payment of interest should be done on an annual basis. So record journal entries in the books of Wheel Limited till 31st December 20X3 after giving the effect of changes in the terms of the loan on 31st December 20X2. That means he is asking you accounting for first year, second year and third year also. Modification is happening at the end of second year. Now, sir, you keep the data and you go on telling me computation, sir. I will do this question. Quickly I'll solve. You can help me with the numbers if you can. So, 20th, what is the date of loan given? 1st Jan 20X1. Our company fellow took loan, sir. Entry for initial recognition is bank account debit to loan liability. With how much amount? Sir, 5,000 lakhs loan minus 58 lakhs, some number is there, 70,096. Tell me, sir, 4,000? 49, 49? 41? 29? Okay, understood. 904. This is your initial recognition, fair value adjusted with transaction cost. You can write it in crores or lakhs also, not an issue. Next, come to the end of first year. End of first year is 31st 20X1. First, ACM law, you have to record interest expense ka entry. What is interest expense ka entry, guys? Interest expense account debit to financial liability, which is loan here. So 4941 29904 into 11.5%. Please do it, ma. 5680 49. Okay, 568 lakhs 24,939. So this is your first year interest expense. First year you would have paid some contractual cash flow, loan account debit to bank. Now contractual cash flow, how much it is that fellow told if 5,000 lakhs that you have to repay over a period of how many installments originally? 5 installments. So your principal amount is 1,000 lakhs. Plus you have to also pay interest at the rate of 11% on 5,000 lakhs. 11% on entire 5,000 lakhs is outstanding throughout first year. So that would come to 550 lakhs. So overall it is 1550 lakhs. That's all, sir. With that, we are done with the end of first year accounting. Now, whenever you are applying ACM, sir, at the end of each year, you are duty bound to work out the carrying amount. Otherwise, next year accounting, a problem will come. So, what is the carrying amount of the loan? Originally, this one, sir, 4941 29904. 4941 29904. To that, you added 568 24 939. Loan amount, you have increased it. From that you minused 1550 000000. Good. 39 59 54 843. Very well. This is carrying amount of the loan at the end of year 1. Sir, I hope till here there is no doubt. Okay. Now come to year 2. Year 2, directly go to the end of second year, which is 31st December 20x2. Whether you like or not, you have to book interest expense, whether you pay or not also. So interest expense account debit to loan. So 39, 59, 54, 843 into 11.5%. Please do this. $45.53 0. Okay. So 455.34 807. Now, second year ending, did we make the payment? We did not. Read the question and tell me. Read the question. On 31st December 20x2, Wheel Limited approached the bank citing liquidity issues in meeting the cash flow required for immediate installment and therefore renegotiated the terms of the loan with the banks as follows. Meaning, at a very outset, casual reading, it gives a meaning that this fellow does not have money. He went to the bank for restructuring the debt. Specific reading will tell you that he does not have money to pay the installment. Go back a little couple of lines above. What did he say here? You should repay the principal in 5 equal installments. That means 5,000 lakhs loan divided by 5. Your each installment is? That means according to the language of the question, installment means only principal. And now he says, I don't have money to pay installment. That means indirectly saying, I don't have money to pay principal, but is second year interest I paid. So this much poetic heart, how will I understand? I also understood after looking at the answer only. But you can't find fault with him, because that fellow very carefully drafted. This is not some casual drafting. He very carefully planned and wrote. Principal installment on a word is attached only with principal, and he says, I don't have money for paying installment. That means indirectly he has money for paying interest of second year. Principal installment he did not pay. Interest he has paid. It is your mistake that you assumed both put together is installment. Principal plus interest. But question ka language la installment is supposed to understand as only principal without including interest. Interest you paid. So that's why when I come here, sir, I will still go and pay interest. Loan account debit to bank. How much is the interest I have to pay? 5,000 lakhs or 1,000 lakhs principal last year we paid off, if you remember. So how much principal is outstanding? 4,000 lakhs. So on 4,000 lakhs, coupon rate 11%. So that's 440 lakhs. This I paid. So contractual interest, not full cash flow. Contractual interest amount is paid. Contractual principal payment we could not pay. We did not have money. E stage, sir. Tell me carrying amount of the loan. 40, 39, 74, 89. Correct, ma. This is your existing carrying amount before you went to debt restructuring. Now this fellow remodified the loan. According to this modification, what are the new terms now? Read the terms again, please. Hereafter interest rate will be 15%. And whatever outstanding principal is there, which is 4,000 lakhs, that will be repaid over a period of 10 equal installments starting from 31st December 20 x3. You are standing today on 31st December 20 x2. Definitely there is a modification. Now that there is a modification, a substantial modification or simple modification, you have to identify. For that we have steps. Let's come to the first step. Step number 1 is identifying the present value of your revised future cash outflows discounted at your original EIR. Now your revised cash flows are across how many years now? Next 10 years. So year 1. It means this is on 31st December 20 x3. 2, 3, 4, 5, 6, 7, 8, 9, 10. Sir, you can do annuity factor, no sir. I would love to do that, but I can't do it. Why? This is not a bullet repayment of principal. Every year installment is there. So every year interest amount will be different. So I have to work out like this only, sir. I cannot do a annuity factor wala calculation. So what is your principal installment? 4,000 lakhs principal is outstanding, sir, to be repaid over a period of 10 years. So it would be 400 lakhs each year. This is all principal, sir, every year 400 lakhs. Now, interest you have to pay at the rate of 15%. Throughout this year, 4,000 lakhs was outstanding. 4,000 lakhs into 15%, 600 lakhs. Of 4,000, 400 you paid. Remaining outstanding is 3,600. 3,600 into 15%. 540. That means, as you pay each 400, a 400 into 15%, 60 lakhs interest is coming down. Now if you understand the pattern, go on deducting 60 everywhere. So this will be 480, 420, 360, 300, 240, 180 and 120, 60. So these are all contracted cash flows, sir. Principal, promised interest to the bank. I want total cash flow. So total it up. Total cash flow. This is revised for future. So it will be 1,000, 940, 880, 820, 760, 700, 640, 580, 520, 460. So my future cash flows are ready. Example, whatever I took, there I took easily bullet repayment. Every year interest annuity factor I did, but here the installment payment. You have to do in a table only, like this only, you have to do it for choice. Now, discount them at your original EIR. What was your original EIR, by the way? 11.5%. 11.5% ka PV factor, sir. Hit it on one by one. You will tell I should write down. Okay, fine, fast. 0.8969, then 8043 next, or 7214 next, 6470 next, 5803, okay, next, 0 next, 4667 next, 4186 next. 3754 next. Yes. Now, calculator should break off. Do it. PV of revised cash flows. On your calc, do the everything. Press GT and tell me the final answer. Don't fill up all that stupid numbers in the exam also and waste time. Everywhere you have to do approximations that lead away 1.5 minutes. Leave it. On calculator you do, just write the final answer. Fast. Okay, any number? 4515.28. Check this, Secretary. Good. So this is your PV of revised future cash flows discounted at your original EIR. If you are having any legal or modification expenses, add that here. I don't have anything in this question. 4115.28 lakhs. This you will call it as A. Your carrying amount of financial liability B. We already worked out and kept that. This fellow 3974.896 something. 8965. Okay. This is lakhs, sir. This is also lakhs. Now your goal is to observe the percentage change. 4515.28 minus 3974.8965 upon 3974.8965 into 100. Tell me the percentage. That's 13.59% or something. Anyway, this is very clearly more than 10%. Therefore, this is a substantial modification. Now that it's a substantial modification, you have to do extinguishment accounting. Extinguishment accounting, what will happen? Existing loan, you cancel it, create a new loan. Existing loan ka carrying amount is how much? So that number 3974. So what you will do is, existing loan, whatever number it is there, 3974.8965 lakhs, kill it, debit it, create a fresh new loan account. Now, a new loan should be measured at what value? This should represent your present value of revised future cash outflows discounted at today's market interest rate. Now, let's read the question. Revised cash flows, I know. 1, 2, 3, 4th column. This is your revised future cash flows, this one. But I have to discount them with what rate now? Today's market interest rate. Read the question. In the question, sir, nowhere they specifically told you that today's latest market interest rate is something. But in your revised terms, they use how much interest rate? 15%. So you have to believe that in the absence of any information, today market interest rate is 15%. Because there is no specific information given. Because old loan interest rate was how much? 11. Now interest rate is how much? 15. If no information is given, I have to believe that today market interest rate is only 15% because there is no other option with me. So, discounted at market rate of 15%. Now, sir, small observation, carefully watch. How much is the principal amount outstanding for you? 4,000 lakhs. That you are repaying it over a period of 10 years, along with an interest of 15%. So, in this revised cash flows, how much interest rate is there? Now your discounting rate is also 15. When installments, if you discount it with the interest rate, present value will be equal to principal amount. Any cash flow, if interest is included, you go and discount that cash flow with the same interest rate, interest will get cancelled. Effectively, you will have only the principal amount. Otherwise, again, don't think that I will have to prepare another table discounting all these cash flows at the rate of 15%. Of course, even if you do that also, 100% answer will be equal to 4,000 lakhs. So they wantedly gave the same rate so that this working note they will avoid, you can avoid from doing it. So 3974.8965 gone, a place la 4,000 lakhs liability came.
there's a slight increase. Something how much? 25.1035. Yeah? The loss, sir. This will go to PR. This came for 12 marks, sir. How cheap it is. See, it's not cheap for the first time. Okay, it will be heavy doing it for the first time. But at an outset, if you see, there are some defined steps. Basic time value of money accounting, there is nothing there. Sir, entire instruments ka crux is there in how beautifully you understand ACM. ACM, if you understand fully, over, sir. Instruments are nothing is there. Just a time pass, you have to study some questions. That's all. That's all. This will be the answer. Check the answer. Matching or not matching? Match. Why is it not matching? This one. 25 lakh 10,350. Okay, nice. So guys, this is about your substantial modification extinguishment accounting. The other two methods never came, sir, but they are very normal methods. You can try that on your own. This I have kept one question on that. Come to question number 19. Question number 19 is a question, it is based on simple modification. Simple modification means a percentage change did not cross or did not equal to 10% is less than 10%. Now, quickly read, sir. On 1st January 20X0, XYZ Limited issues a 10-year bond of rupees 10 lakhs bearing interest at the rate of 10% payable on December. The bonds are redeemable on 31st December 20X9. Issued on which date? 1st January 20X0. Redeemable on which date? 31st December 20X9. How many years maturity? He is clearly telling no, sir, 10 years maturity. At the trap, sir, don't compare this and this, sir. Had they not given this, you would have taken, some of us would have taken 9, no, sir. The wrong answer. Entire sum will be gone, sir. Careful. Okay. The bonds are redeemable on 31st December 20X9 for 10 lakh rupees. Issued for 10 lakhs, redeemable also for 10 lakhs, and he says no cost or fees are incurred. What's the meaning of this? Transaction cost not there. What's the implication of this? Coupon rate and EIR both will be same. The effective interest rate is therefore 10%, which is same as your coupon rate. Tell me, when coupon rate and EIR both are same, what will happen? Your initial recognition principal amount, whatever is there, that only will be the closing balance at the end of each year. Fantastic. Continue. On 1st January 20X5, considering you, he told of, that is after 5 years, XYZ Limited and bondholders agree to a modification in accordance with which no further interest payments are to be made. So we will not repay interest anymore, but the bonds will be redeemed on the original due date for an amount of 16 lakh rupees. That means due date la change is not there. 10 years loan, 5 years over, another 5 years is there. Next 5 years la I need not pay any interest amount, but at the end of 5th year I have to pay a lump sum consideration of 16 lakh rupees. So this is your modification. Legal and other fees of 50,000 rupees are also incurred. Show the accounting for restructuring. This is a study material question, sir. Examiner did not come. Now, as usual, what is your first step? You have to identify whether this modification is a substantial or a simple modification. Tell me step number 1. PV of revised future cash outflows discounted at original EIR. Your revised cash flow is only one number. Which one? 16 lakhs. When you have to pay that, after 5 years you have to pay. So what you will do? 16 lakhs you discount it to today. Using what? 10%. So 16 lakhs discounted at the rate of 10%, 5th year ending, it's coming to 993,440. To this any legal expenses are there, add, which is 50,000. So your A, step number 1 is 10,43,440. Clear, sir? B is your carrying amount. What is your carrying amount? How do you know? Your coupon rate and EIR both are same. So starting amount only will be the carrying amount at the end of each year. No ACM table and all required, sir. EIR, coupon rate, they both are same. Starting amount only will become closing balance each and every year. So that's how it's 10 lakhs. If you check the gap now, it's coming to 4.34%. It's not crossing 10% or not even equal to 10%. So it is a very clear-cut case of a simple modification. How many alternatives are there? 2. First accounting treatment is whatever legal expenses you are paying, put it in PRL and remeasure the carrying amount of the loan so that it will reflect the PV of revised future cash outflows. Already PV of revised future cash outflows we worked out here, which came to how much?
9,93,440. So from your 10 lakh rupees, reduce it to 993,440. That means you will have a gain of 6560. Put it off in your PRL. Expenses also put it off in your PRL. That's only the alternative one. Now your loan is appearing at what number now? 993,440. And 993,440 is what? PV of future cash outflows. Anyway, ACM will work here after apply ACM. Second treatment is, whatever legal expenses are there, 50,000, adjust it to loan amount. Loan amount how much? 10 lakhs, book value. You paid 50,000 now, adjust it. What is the revised loan amount? 9,50,000. What is your future cash outflow? 16 lakhs. So today 950 is there in your account. Ultimately you will pay 16 lakhs after 5 years. Go and work out a revised EIR. If you process this, you will get it as 10.99%. Sir, how will I work out that? IRR calculation, sir. You can do trial and error method and all, or you can also work out like this. 16 lakhs is your future value. Present value is 10 lakhs into 1 plus R whole power 5. So if you work out R is equal to 16 lakhs by 10 lakhs whole power 1 by 5 minus 1. R is equal to whole power 1 by 5. How will you work out? You know that 15 times 12 times square root minus 1 into power plus 1 into equivalent into equal. You know that method? You do not know? Really? Okay. Take your calculator. Right. Sir, 16 lakhs divided by 10 lakhs is how much? Don't do and tell, sir. See and tell. That much. How much? 1.6. Write 1.6 on your calculator, all of you. Just plain 1.6. Erase all memory, GT, everything you erase. Just write 1.6. Square root it 15 times. If you know it's fine, otherwise do. So if you have a power b, take a, square root it 15 times. Is step number 1. Some number you will be having no. From that, minus 1 is equal to whatever you have on your calculator, minus 1 is equal to you do. Step number 3, multiply with the power. Your power is 1 by 5 and 0.20 or divide by 5 anyway into 0.20 is equal to don't forget. Earlier you did minus 1, now you have to do plus 1, reverse it. Plus 1 is equal to also plus, okay. Then you originally squared it, now you have to square, originally you square rooted it, now you have to square it. How will you square it? Into equal to, like that 15 times you have to do. Like that if you do 15 times, you will get the answer for this number. Minus 1 also you do. Minus 1 is there here. 0.1098 or 10. Study material, obviously they will not follow all that, sir, but they will give you the direct answer because that fellow does in Excel sheet. So Excel sheet, if you do, anybody will get the answer. No, so, but ideally this is what, these steps then you can solve with your calculator. If you have financial calculator, directly you will get. Anyway, sir, don't worry. In SFM you will be learning all this later on. In your AFM, sorry. Chalo. Sir, with this we are done with your debt restructuring, debt modification is over. Now we will go to this one, sir, called as compound financial instruments. This concept is the most tested concept till now. From an examination point of view, entire instrumentally, if at all one question came multiple times, that is this model, compound financial instrument. If you are lucky, same models will again come, happily, easily, you can score the 12 marks or something. Now, what is compound financial instrument? I did not tell you. What is compound financial instrument? It's a contract which has the characteristics of equity also, financial liability also. Overall, it is called as a compound financial instrument. Now, you tell me this. For a financial liability, what accounting is there? Normally, ACM or FVTPL. But general accounting will be ACM unless you fall into those 5 exceptional categories, correct? So, financial liability will be accounted by ACM. Equity, there is no accounting. First day you account. Thereafter, no further accounting for equity because remeasurement, interest and all will not be there on equity. So if it is in equity, initial recognition, no subsequent remeasurement. But if it is a financial liability, you have to apply ACM accounting. But the problem is, my compound financial instrument has the characteristics of equity also, liability also. Now how will I do it is, on the very first day, you have to break the instrument into two parts for accounting purposes. Identify how much is equity component, how much is financial liability component. On that financial liability component, you will go and apply ACM. On equity, you will not do anything. You will just stay put like that in the balance sheet. Just a rough background if you have, we'll pick up the questions. Rest of it, we'll see in the examples here. I'll show you one example first. It's a little broader one. Once you understand that, then I'll show you the most popular exam question that came till now. Yeah. Check out this question number 25, sir, page number 35. Check out this, sir. Geo Limited has issued 10% debentures of rupees 25,000 redeemable or convertible after 4 years at par. So it's a convertible debenture which is redeemable or convertible after 4 years. The market interest rate on similar debentures without conversion feature, and a pure redeemable instrument ka market interest rate is 14%. But our debentures ka interest rate is how much? 10%. Why? We already discussed that convertible instruments ka coupon rate will be slightly lower than the market interest rate. So that's how it is. Debentures will be converted into equity shares having a face value of rupees 10,000. So number of shares to be issued is fixed here. Otherwise face value, how can they fix? Show the accounting in the following cases. First case, the option to convert or redeem is with the holder. Case 2, the option to convert or redeem is with the entity. Now, small recall to yesterday's concept, sir. What is the meaning of convertible or redeemable at the option of the holder means? For the next 4 years, compulsorily I have to pay interest, coupon. At the end of 4th year, if the investor asks cash, I have to pay cash. If he asks shares, I have to give shares. Correct? Now, when option is there with the holder, if he demands cash, we are obligated to pay cash. That means we are having a contractual obligation to deliver cash. Now that we are having a contractual obligation to deliver cash, a principal amount will be treated as a financial liability. Ultimately, whether he'll ask or not, I don't know. But accounting purpose, I have to treat it as a financial liability. So come to the first working note. Option to convert or redeem is there with the holder. So first what you will do is go and work out the fair value of financial liability. Wait. Financial liability, which accounting will be applicable? ACM. ACM initial recognition amount should be fair value adjusted with the transaction cost. And in case of loan, fair value is what? Present value of future cash flows. So what you identify is undeniable cash flows you identify. Next 4 years, anyway you have to pay 2,500, 2,500, 2,500, 2,500. Why 2,500? 25,000 into 10%. That anyway you have to pay. 4th year ending, if he asks principal, that also you have to pay. You are obligated to pay that. Include that also. Discount all this with the market interest rate for a non-convertible bond, which is how much? 14%. So that if you discount, you are getting an amount of 22,087. Wait there. What is the meaning of this is, for the cash flows that you are going to pay, ideally for your face you deserve only an amount of 22,087. But actually you received an amount of 25,000. That means how you must understand this is, I received 25,000, but my obligation to repay exists only for 22,087. That means a remainder amount 2,913, I received cash, but I don't have a obligation to repay that. That amount for which you do not have a contractual obligation to repay, that is not a financial liability, that will be identified as a equity component. So your accounting entry on the first day will look something like this. Bank account debit 25,000 to CFI financial liability. See sir, is some debenture, some other question will be preference share, some other question, some other instrument. So commonly I am calling it as CFI FL financial liability and CFI equity. Financial liability 22,000 went, 2,913 went to equity. Sir, hereafter what will happen? Hereafter what will happen on that financial liability? You will go and apply what? ACM. That is equity. Equity anyway subsequently there is no remeasurement. Don't touch that. Just simply stay put in the balance sheet. That's all. Sir, hereafter on that financial liability, when I apply ACM, every year interest expense to financial liability to bank. Imposition you will write for how many times? 4 times. Next 4 years you write. Instead of drawing the ledger account, I prepared an ACM table. Watch that. You started with 087 on that interest expense minus cash flow paid, closing balance. Like that, first year 2500, second year 2500 you paid, third year 2500 you paid, fourth year definitely you will pay 2500. But in computing our liability, we included even 25,000 also. Here I did not pay the 25,000 because whether I will actually pay the 25,000 or not depends on whether the holder asks cash or not, isn't it? But definitely for 2,500 I have to pay. So all 2,500 I paid. I am having a closing balance of how much now? 25,000. Now my balance sheet picture is like this. Other equity heading la CFI equity account is having an amount of 2913. Liability CFI financial liability is having an amount of 25,000. This is a present position, sir. Now I will see what the holder will do. Holder came, sir, I want cash. Okay, take cash. What is the entry? Already we prepared a liability account which is exactly reflecting an amount of 25,000. He is also asking cash of 25,000. Write the entry. CFI FL account debit to bank with that liability account closed. Now tell me, sir, this amount do you need to repay now? 2913? No. And instrument ka life is also over. Now what you do is a 2913 account you cancel, merge it into your retained earnings general reserve, somewhere you merge it off. Over, sir. This is accounting. Sir, any doubt in this? Or you understand, sir, it's a very, very straightforward accounting. What is the second option he has? He can ask you shares. Now wait. If he is asking shares, you have to give shares. There's no option for you. You have to deliver shares. But our accounting law, we mentally prepared for what? We prepared all the accounting books so that we will deliver cash. But he is asking what? Shares. So what you will do is, a liability unnecessarily you prepared. A liability cancel it, merge that also into CFI equity. Now you will write an entry where 25,000 rupees also gets merged into 2913. So your first entry will be CFI FL account debit to CFI equity. Now CFI equity, how much money is there? 27,913. Now you have to deliver shares to him. Kill CFI equity, issue equity share capital of face value 10,000, and the balancing figure whatever comes, that you transfer it to securities premium. Now look at this. The fair value, wait a moment. The fair value of equity shares issued, let us say, is 40,000. The shares whatever you are delivering to your investors, our shares ka market value is 40,000. A 40,000, the question did not give, I am just asking you a question. 40,000. In that face value is 10,000. Over and above face value, remaining 30,000 is ideally should be securities premium. You should not write like that. You should not go and identify the market value of the equity shares now. Why you should not go to the market and work out the fair value of equity shares is, your equity component is identified now 4 years ago. Na? 4 years ago. If you go and bring the market value of the shares now, that indirectly amounts to fair valuing your own equity, which is not allowed. That's why you should not go to market and bring the fresh fair value of your shares. That's why securities premium is given as a balancing figure for you. The real worth, if somebody is choosing shares, he is not stupid, no. He is choosing shares because the worth of the shares is obviously higher than 25,000. It may be 40,000. It may be 4 lakhs also. You will still write the same entry. If you bring a market value of the shares inside, that means you are fair valuing your own equity. Your equity is already fair valued day one. That's all. Again, no subsequent fair valuation. So that's why securities premium you have to write it as a balancing figure. I hope I'm clear. Right? This is case 1. Case 2, what is the second case is asking? Option to convert or redeem is with the entity. Now I will not show you the answer. See my face only. Now that, sir, option to convert or redeem is there with the entity, tell me, do I have an obligation to pay 25,000? I may have an intention to pay, that is different, but I don't have a obligation to pay. Since I do not have an obligation to pay, while computing my fair value of financial liability, should I include this 25,000 or should not include? Should not include, because 25,000 obligation to pay does not exist. Like how you computed working note number 1, again I have to compute working note number 1 again, but without including 25,000. Because previous case, like he has a right to ask, I have an obligation to pay. Now I have a right to pay, but I don't have an obligation to pay. Therefore, financial liability computation, like you should not include 25,000. Am I clear till here? Now, if you check the answer, at 25,000 I did not include. As a result, what happened? Present value came to only 7285. But amount I received is how much? 25,000. Excess amount I received 17,715, but I do not have an obligation to deliver cash. Since I do not have an obligation to deliver cash, this will be identified as your equity component. Entry change will not be there, amounts change will be there, but entry is same. A CFI FL, on this you will still apply ACM. On CFI equity, you will simply stay in the balance sheet without doing anything. Are you understanding, sir? Now if you watch the numbers ka size, earlier liability was large, equity is small. Now equity large, liability is small. Correct? Now your liability actually you have only for paying 4 coupons of 2,500 each. The moment you pay 2,500, 2,500, 2,500 and again last 2,500, your CFI liability will become 0. It literally becomes 0. So by the end of fourth year, if you check your balance sheet, CFI equity is alive, but CFI financial liability has become 0. Each stage, sir, redemption date comes, fourth year ending. Whose choice it is now? Entity or holder? Issuer entity. Now, in our books, liability is there or not there? Not there, because we don't have any more liability. Now, our company decided to issue shares. So fine, what you have to do, cancel the CFI equity, issue equity share capital with a face value of 10,000, is 7715 will become a securities premium balancing figure. Again, don't go to the market and fetch the real fair value of the shares issued or the irrelevant wrong crime. Don't do that. Next, possibility 2. Entity decides to pay cash. Okay, pay cash. 17,715 CFI equity you cancel. Bank you are paying an amount of how much? 25,000. How much extra are you paying? 7285. To whom are you paying? They are not equity holder. That fellow is a debenture holder, but he is an equity instrument holder. He is an equity instrument holder. He is as good as equity shareholder only. Anything you pay to your own equity instrument holder cannot go to PRL. It has to be adjusted into other equity. So retained earnings flow we adjusted. Sir, total you know how many cases you did? 4 cases you did. Option with the holder. He selected cash, he selected shares. Option with the issuer entity. We paid cash, we paid shares. 4 cases ka accounting. Now, what is common is ACM strongly you hold. A financial liability ka control you will have. And never ever fair value your own equity. In case the amount paid to your shareholders exceeds the CFI equity ka balance or it is below the CFI equity ka balance, that is a gain or loss only, but that cannot go to your PRL. The transaction with own equity fellow. Own equity, sir, with my owner, what is gain or loss, sir? If he wants money, he took. That is like a drawings. That's like a dividend declared. You have to adjust it directly into the equity itself. Don't bring it on to P&L account. Clear till here, sir? These are the 4 cases. Basic if you have, then 1 or 2 small adjustments only. Now, listen here. Sir, one fellow issued convertible bond, sir. Step number 1, what he did is, all future cash flows which we are obligated to pay, all these cash flows he discounted using market interest rate. Let us say he used market interest rate of 10% and he got an amount of 80,000. 80,000 is identified as fair value of financial liability. Example, some numbers I am writing, go on watching. Step number 2, you have to identify how much is your equity component. So total amount raised is 1 lakh, let's say. Out of that 80,000 rupees, we have an obligation to deliver cash as the liability. Remainder amount is 20,000 is CFI equity. If I ask you to write an entry at this stage, your entry will be something like this. Bank account debit 1 lakh, to CFI equity account 20,000, to CFI liability account how much? 80,000. Till here, I hope you should not have any doubt. It's pretty straightforward. Whatever we did till now, the same thing I wrote. Third point. This fellow incurred transaction costs, issue expenses, underwriting commission, he paid. Now, tell me, sir, a transaction cost is incurred purely on a liability instrument? No. Is it incurred purely on an equity instrument? No, it is incurred on a CFI. Correct? Now, what you should do is, a transaction cost also, you should split how much is attributed or related to financial liability, how much is related to equity component. Sir, how will I split? A ratio will split off 80,000, 20,000. 4:1, sir. I wanted to took that number 4,000 and 1,000. Tell me, financial liability, when you are applying ACM, transaction cost treatment is what? Adjust into the initial recognition amount of financial liability. So this one will adjust to financial liability itself. Now, if you are issuing equity shares, you paid underwriting commission. Where will it go? P&L account or other equity? You are issuing equity shares, sir. You paid underwriting commission. Can it go to PRL, sir? You cannot take it to PRL. Yesterday we discussed Ind AS 32. Transaction cost related to own equity instrument cannot go to PRL. It has to be adjusted in reserves only. Other equity will have to adjust. Now, this you can adjust in other equity, and complying with the study material answer, we are adjusting this to CFI equity. Sir, why like this? CFI equity, where will it stay? P&L account or balance sheet? Balance sheet. That is also part of other equity only. No, we will adjust there. This one we will account it to CFI FL. This one we will adjust it to CFI equity. So as a result, what will happen is, you are paying transaction cost, no? So to bank 5,000. In that, whatever is related to financial liability, adjust it against financial liability. Whatever is related to equity, adjust it to CFI equity. Do you understand, sir? There is one extra point. Compared to previous sum, the extra point is transaction cost ka split. Whatever relates to whatever part, a part ke you go and adjust. This is nothing new, sir. This is ACM ka rule. This is Ind AS 32 ka principle. This is not new for you. Already discussed principle. I am just applying it here. Clear? Now coming on. Now here I have a problem. Watch this carefully. If financial liability ka initial recognition amount is how much? 80,000. How did you get that 80,000? All the future cash flows that you discounted with the market interest rate of how much? 10%. So obviously 80,000 is representing the present value of your future cash outflows. But what you did now, you went and adjusted 4,000 rupees to your recognition amount. So 80,000 place lesser, now you will have only 76,000. And guess what? 76,000 will not represent the present value of your future cash outflows. Why will it not represent? Present value is 80. You went and disturbed it now. Because of that, what happened at 10% will not work. So what you have to do is, a 10% place, you have to work out a revised EIR. Let's say that's something coming to 11%. Examples. Are you understanding, sir? See, sir, ACM is a very easy, at the same time very powerful concept. It will work as long as your current balance is equal to present value of your future cash flows. You disturb that, ACM will not work. Either you change the carrying amount or change the discounting rate. I already changed the carrying amount. That's the reason problem came. 80 became 76. So I have to rework the EIR. But when the question came in the exam, our revised EIR also question only gave off. You need not do any extra effort for that. Question only will give off that revised EIR also. You should only know how and where to use it. Okay, so first step normal, second step normal, third step transaction cost. Transaction cost allocated to equity component and liability component. Equity component adjusted to CFI equity, liability component adjusted to CFI FL. But when you have transaction cost in a CFI, your first step, whatever interest rate you used, which ideally should become your EIR, will not be your EIR because of this adjustment entry. You have to go and rework your EIR. So hereafter, you will start your ACM accounting with 76,000 rupees as the base and 11% as your revised EIR. Definitely it will work. Are you getting it, sir? So this is how you will handle if there is a transaction cost. E question came 3 times till now. Once for 12, remaining for 10 times, 10 marks. Question came 3 times till now. That question is, where are you? Not you. You. Question number 28. Sir, instruments, sir. Study material all questions, RTP, MTP till date if you count, total 185 questions are there. Small, medium, fat, big, everything put together. In that, all levels good questions only if you pick up, they are there in your book. In this only big questions if you pick up, it will be 18 or 19. So such a huge chapter ultimately boils down to a stupid 18-19 questions. Practice twice, 1 or 2 will come. 15 marks, happily you will put in your pocket. It is that simple, sir. But conceptually you should be strong. Mathematically how ACM is working, what is happening in FVTOCI, reclassifiable or not. If this you are confident, you need not fall into the jungle of questions. You just practice this is sufficient. Read. ABC company issued 10,000 compulsory cumulative convertible preference shares. Compulsory convertible, as cash option not there. As on 1st April 20X1 for rupees 150 each. 10,000 shares into 150, 15 lakh rupees you raised. The rate of dividend is 10% payable every year. That means it is a mandatory payment. The preference shares are convertible into 5,000 equity shares of the company at the end of 5th year. 5,000 means fixed number of shares. FTF test passed, equity component. From the date of allotment. Okay. When the CCC is issued, the prevailing market interest rate for similar debt without conversion option is 15%. What is our coupon rate? 10%. Market rate is 15%. So that's how a equity element creeps into the picture basically. Transaction cost on the date of issue is 2% of the value of the proceeds. 15 lakhs into 2%, 30,000. And this fellow gives you effective interest rate of 15.86. Why did he give you that? After adjusting transaction cost, 15% will not work. 15% you have to use 15.86%. You should be clearly understanding why he gave what he gave. If you misunderstand that, I have seen people ka answer sheet, sir. Asal first step lane people used of 15.86. How wrong, sir? 11% when you have to use after doing everything accounting stage, you have to bring 11%. If first step, because question directly gave revised rate, if first step 80,000 calculation they used 11%. Wrong answer. Can't do that. Should be very, very careful. You should know what to be used at what stage. Anyway, this whatever we discussed, that only is summarized again, sir. Chalo, sir. He's asking accounting. Now that this question came multiple times, I'll just once do. You please help me in this. Question number 28. Sir, first and foremost, we have to work out the fair value of your financial liability. Every year, compulsorily you have to pay interest of 10%, which is 15 lakhs face value into 10%, which means 1,50,000. Like that for 5 years I have to pay into PVIFA 15% for 5 years. So that's 1,50,000 into, did this fellow give PV annuity factor? He did not give. You multiply, tell me annuity factor, sir. 3 point? Not 3, yeah? Okay, final answer you will tell. Huh? Okay, tell. 502, 823. This is fair value of financial liability. Therefore, don't see the answer what I see a route. You do, see, that's just formality I gave. 15 lakh rupees you raised, but you have obligation to pay only 502, 823. You don't have obligation to pay 997, 177. Correct, sir? Right. This is one calculation. Second, transaction cost. Transaction cost, how much are you incurring? 30,000. If 30,000, split it towards equity, split it towards financial liability. In what ratio? In the ratio of 997, 177 is to 502, 823. 10,000, 57, huh? 56, 056. Okay, this one 20. Okay, 19,944. Right. Equity is 19,000. Huh? Okay, fine, no problem. 19,944. This one is 10,056. Well, now he is asking accounting for all the 5 years. So, very first day accounting, what's the date? 1/4/20x1. Okay, fine. 1/4/20x1. Now listen here, sir. One small point. Bank account debit to CFI financial liability to CFI equity. When there is transaction cost, kindly remember this. Write the entry with the net amounts. don't post separate entries, subsequently mistakes chance will be there. You actually raised how much? 15 lakhs, but you paid transaction cost of 30,000. So effectively you would receive only 14 lakhs 70,000. Your financial liability ka original measurement actually came to 502,823 minus 10,056. Tell me this number, sir. 767. Similarly, this came to 997,177 minus 19,944. 977. You start with this. Don't write separate entries. Separate entries is correct only. But the thing is, sir, when you start applying ACM, by mistake, if you go and apply interest rate on this, you lose marks. Net entry, if you make no such chance of mistake only will not come. Okay. Now, for the next 5 years, my accounting is labor work, sir. Year 1, 2, 3, 4, 5. There is no skill in this. So your entries will be like interest expense account debit to liability, CFI FL. And every year you will pay money. So financial liability account debit to bank. I want closing balance. Tell me CFI FL first day 977,233. 977 sorry, that's equity. 492,767. 492,767. On this you will multiply 15.86%. Please multiply, sir. 7815. 78153. Okay. How much are you paying every year? 1,50,000. Closing balance, please. You will start with the 492,767. You are crediting 78,153. Again, you are debiting 1,50,000. Closing balance 420,920. Now, on this 420,920, apply 15.86%. 66,758. 66,758. And you are paying an amount of 1,50,000. 3,37,678. Now on this 337,678, apply 15%, 15.86%, sorry. 53,556. Okay. 241, 233. You should get 2, that's okay. 4 you should get, no? Okay. 241, 234 into 15.86. 260. 38,260. And out of that you are paying 1,50,000. 129, 94, 494. Okay, nice. 494. Now listen here. Now you are in the last year. Don't do any maths. 1,50,000 the moment you pay, you don't have any obligation to pay, no more. So take the balancing pair. 1,50,000 minus 129, 494. How much are you having? 30,000. Sorry, 20,000. 506. Correct only. 20,506. Interest expense to CFI liability. Interest expense you will send it to where? PRL, it will go off. Your liability component over a period became 0. Now when you are standing at the end of year 5, your position is like this. CFI equity, first day you recorded 977. You did not disturb that in the last 5 years. Last 5 years you created financial liability and you also closed financial liability. Finally you have to issue shares one day. So the entry you will record is CFI equity account debit 977,233. Go check how many equity shares you have to issue. It seems 5,000 equity shares. Face value 10 rupees if I take. So that will be 50,000. This will be 927,233. This will be transferred to your securities premium. That's all. 12 marks. See, sir, they will give you 12 marks for writing entries every year. For making your hands spin for that wages. Main accounting is very simple, sir. Okay. Now in this, I think one small printing error was there. I'll correct it. Put 9 here. Last entry it's printed as 77,233. 9 missed out. Bad. These things I remember in class. While making the material, I forget it. I could have corrected it in the material. Anyway, you correct it. This is balancing figure, sir. Don't go to the market and fetch the fair value of the shares what you are issuing. That is wrong. Okay. In this, the last concept in compound financial instrument, that's called as a buyback. Now, sir, if you pay any amount to your equity shareholders or equity instrument holders over and above the book value, that is a gain or loss only, but that cannot go to PRL. It has to be adjusted in other equity only. But if you pay any more amount or less amount with outsider, that is a gain or loss to be recorded in PRL. That means, indirectly what I am trying to say is, if you make a transaction with your own owners and you get a gain or loss, that cannot go to PRL. But if you make a similar transaction with outsiders, financial liability people, and you make a gain or loss, that has to come to PRL. Okay, just broadly understand this. Now, in background lo read this, sir. Buyback of compound financial instrument. This is the last concept of CFI, guys. E question very long back question came. Before that it came in RTP exam lo never came. And this is one area which institute did not test on CFI yet. Okay, so if at all they want to try something new, this is it. Read. On 1/1/2000, how to do what is the issue? Process I will tell you. Go on reading. On 1/1/2000, entity issued a 7% convertible debenture with a face value of 1,000. The maturity is on 31st December 2008. Stop that, tell me the life. Somebody tell 8 years please. How much? 9 years. The debentures are convertible into ordinary shares of the entity at a conversion price of rupees 50 per share or redeemable at par at the option of the holder. That means either the bonds will be converted into shares or it can be paid in cash also depending on whatever the investor asks. Interest is payable yearly in cash, of course. At the date of issue, the entity could have issued a non-convertible debt at an interest rate of 10%. So market interest rate is how much? 10. But we could issue a convertible bond only at 7%. On 1/1/2005, that's exactly after 5 years, the convertible debentures in the market have got a fair value of 1450. The entity made an offer to the holder of the debenture to repurchase the debenture for 1450, to which the holder accepts. Meaning, a 9 years life bond got redeemed at the end of 5th year. After 5 years is over, 6th year starting, we went and made a buyback of a compound financial instrument and we cancelled it. Now, if I have to make a buyback, obviously I have to offer more. I offered more. When I offered more, there is a premium on buyback. Now, premium on buyback treatment is what? Normal equity shares ka buyback if you talk, since you are paying to equity instrument holder, that extra amount paid will go to other equity, reserves and surplus will adjust. But if you are paying more money to your outsider financial liability, that more money paid is a loss, that will go to PRL. Who is this fellow? He is split personality, no? Our convertible debenture holder, half man is outsider, half he is insider. CFI, he is equity instrument holder also, he is a financial liability holder also. You paid more to him. Whatever he takes with this hand extra, go to other equity. He handle whatever extra he takes, put it in PRL. That means a buyback price you have to split into two parts. Because I am definitely paying more, but I am paying to him in the capacity of equity instrument holder and also in the capacity of financial liability holder. So a buyback price you have to split. So this is the extra concept we have. It's easy only, nothing great. Move. On the date of repurchase, the company could have issued, repurchase means after 5 years today, the company could have issued a non-convertible debentures with 4-year life at a coupon rate of 6%. Indirectly telling today market interest rate is 6%. Show accounting for initial recognition and also on the date of early redemption. Now forget about redemption for a moment. Initial recognition, how will you do? First you will work out financial liability amount. How will you work out financial liability amount? All future cash outflows you discount it to today, using market interest rate. One number will come. That's the financial liability. Over and above that, whatever cash you received, that is equity component. Now, while computing financial liability, tell me what all cash flows I should include. Interest, 1000 rupees into 7%, 70 rupees every year I will include. What about principal? Should I include or should not include? Should or should not? Should. Should. Why? Is it convertible or redeemable at the option of the holder? If that fellow asks cash, we have an obligation to pay cash. So redemption will happen and I will not note down today, no, that is a future transaction. As on today, I will not know that I will do a buyback transaction and all. So as on today, if he asks cash, we have to pay cash. So come to your first calculation. Financial liability, 70 rupees I considered, 1000 rupees I considered, discounted to today, I got an amount of 827, that is my financial liability. Actually collected an amount of 1000. Extra amount I received is 173. That is your equity component. That's all. With that I went and wrote an entry. Bank to CFI equity to CFI financial liability. So hereafter on this financial liability I will go and apply what? ACM. So ACM will go on applying. Now tell me sir, buyback is happening on which date? After 5 years. Now if I have to identify gain or loss in buyback, I want two numbers. I want buyback price, then I want my existing carrying amount, correct? First day CFI equity is recorded at what value? 173. For that what accounting will you do? Hereafter, no further accounting. So after 5 years also, shamelessly he will appear only at 173. CFI equity they don't have a problem. After 5 years, after 9 years, that fellow will appear only at 173. But CFI liability will not appear at the same amount. That fellow will definitely change. Why it will change? Because you are applying ACM accounting. So after 5 years, what is the carrying amount? I want to know. So what I did here is, I prepared an ACM table for a period of 5 years. So 5th year ending, if you see, I am having 904.53 rupees. But there is a smart way to do it. What is the smart way? That's all. Total 9-year instrument. 5 years is over. 5th year ending ka carrying amount should be present value of remaining 4 years ka cash flows. You need not have to do ACM table. That's why, out of guilt, I prepared alternative. We got the same number. 904.89. We got a rounding of error, sir. I rounded it off to 905. Here also we got the same number. Any alternate, sir, ACM table if you do, same answer will come. Future cash flows if you discount also, same answer will come. Okay guys, whatever is convenient you do. So now I am landed at a situation where in my balance sheet I have two items. One is CFI equity which is appearing at 173. Now I have a CFI financial liability which is appearing at 905. Till here story is clear? Now I cancelled both of them by paying a single short amount of 1450. You can very clearly see 1450 is exceeding the total of both these numbers. I definitely paid more. If more cut treatment how to do? The excess payment how will you account it? That depends on if 1450 la, how much did I pay to equity component? How much did I pay to equity component? How much did we pay to financial liability component? That means a 1450 has to be split. Sir, how will I split this now? Simple. First day, how did you split? First day, how did you split? You first identified the fair value of financial liability. From the total fair value, remove the liability ka fair value. Automatically, you will get the equity ka fair value. Like that only. Today, a bond has a remaining life of 9 years total. 5 years is over. Remaining life of 4 years. If 4 year remaining cash flows discounted today's interest rate, because I want fair value. What is today's interest rate given? 6%. So next to 4 years ka cash flows, go and discount it using 6% interest rate. Don't take 10%. 10% is your original year. I want fair value. So 6% latest market rate. 6% to discount. You are getting an amount of 1035. What is the meaning of this is your financial liability today has a fair value of 1035. But you are paying actually an amount of how much? 1450. And the extra amount 415 you are paying towards which component? Equity component. That's all over now. 1450 also you split. Now what you will do is compare. Liability I am paying an amount of 1035. Their book value is 905. I am paying how much? Extra 130 extra. This is a loss for us. This will go to PRL. Equity component I am paying 415. Book value is 173. How much am I paying extra? 242. This loss cannot go to PRL. It will be adjusted into retained earnings. That's all. Go right the entries. this CFI compound financial instrument ka maximum points are. E question did not come till now, but it is there. Study material one small example is there. E question I picked up from RTP 2009 or 2008. So the max of your compound financial instrument. Every case will be covered in this. Now guys, the entire concept of CFI, whatever we have discussed, it is summarized in this one page. So quickly go through it. What's the first point? Initial recognition. Determine the fair value of financial liability. How will you compute fair value of financial liability? Present value of undeniable future cash outflows discounted at market interest rate. That is one thing. Second one, fair value of equity. How will you get? Total gross amount raised on issue minus fair value of financial liability. Step 3, write the basic journal entry. If transaction cost is there, transaction cost also you have to split it towards equity, towards liability in the above ratio, whatever we have split. And whatever is related to financial liability, adjust it to CFI financial liability only. And whatever is related to equity, adjust it to CFI equity only. On the settlement date, if he asks cash, pay cash. If you have to give shares. But never ever fair value it. Early redemption, you have to just remember one point. Split the buyback price into equity and liability component at the market rate on the date of buyback. Compare the buyback price of equity and liability with their respective carrying amounts. The gain or loss on buyback relating to financial liability will be recognized in PRL, outsider component. And the gain or loss in relation to equity, owner component, will be adjusted into equity. Retained earnings, so general reserve, securities, so somewhere go and adjust it off. That's all. This is the end of your CFI. Whatever 2-3 questions we solved, sir, that covers everything. They are maximum questions, guys. Okay. So that's the end of your CFI. Now we have 2 more concepts left. One is derivative, the other one is embedded derivative. Now, sir, if you remember our yesterday's discussion, derivative can be accounted in 4 ways. No? One is it can be identified as a financial asset, it can be identified as a financial liability, it can be identified as equity component, or it can be scoped out. See, if it is scoped out anyway, I will not do any accounting. But if it is accounted as an equity instrument, what will I do? Any gain, loss, initial recognition should be done at fair value, thereafter don't touch it. And everything will be adjusted only into other equity, you will not bring anything to PRL. So that's about equity. Now coming to the first 2 cases. When derivative is accounted either as a financial asset or a financial liability, standard tells you only one secret ingredient. Just do this FVTPL. That's the ultimate secret. FVTPL ka principle is the most easiest principle. What is that? Initial recognition, fair value. Subsequent measurement, fair value. Gain or loss, PRL. That's all. Over. Answer. You understand? AFM lo when you learn derivatives for the first time, derivative is sounding complicated. Accounting of derivative very cheap. Derivative instrument complicated. Accounting is very easy. Because which method are we applying? FVTPL. FVTPL we already discussed. What is FVTPL? Initial recognition, fair value, subsequent measurement, fair value, gain or loss will go into PRL. What is there to get confused in this? Very straightforward. Now, what is forward contract? What is futures contract? What is call option, put option, what is a swap? All these are different. Means they are the original learnings of your derivative. That may be complicated. Accounting, not complicated. Accounting is fairly very simple. Provided your derivative is either a financial asset or it is a financial liability. I wrote some journal entries and all. Don't see all that. Directly pick up the question, sir. E question lot of info is there. Where is this question, by the way? Hey. Okay. 1 second, sir. This is an embedded derivative. These are all examination questions range. Okay. Come to question number 31. 43 page number, sir. Come to question number 31. I don't know why this institute like this question. 31 came 2-3 times, sir. 8 to 10 marks range. There's nothing in that. Very easy question, but still go through it once. On 1st January 20X1, SAM Company Limited agreed to purchase $20,000 from JT Bank in future. On 31st December 20X1, for a rate equal to rupees 68 per dollar. Wait there. What did Sam do? Sam agreed to buy dollar on a future date at a price which is decided today. Sir, now that price is decided today, in future definitely either a gain or a loss is waiting for Sam. Clear? And what did Sam agree to buy? Copper, onion. What did she agree to buy? US dollar. And US dollar is a financial asset only. Therefore, this is scoped in contract only, sir. Whether it is scoped in or scoped out, that discussion is irrelevant. That discussion you will do when the underlying asset is a non-financial asset. What Sam agreed to buy here is dollar. Dollar is money, cash, financial asset. So you should not have that kind of doubts. Continue. Sam did not pay any amount upon entering into the contract. Sam is a listed company in India, prepares its financials on a quarterly basis. Following the principles of recognition and measurement of India's, you are required to record the entries for each quarter ended till the date of actual purchase of US dollar. So actual, ultimately you took delivery of dollar. That's what he's trying to say. Continue. For the purpose of accounting, please use, he's begging you, the following information representing marked to market fair value of forward contract at each reporting date. First quarter ending 31st March, fair value is negative 25,000. 30th June 20x1, negative 15,000. 30th September 12,000 positive. Ultimately on the maturity date, the spot rate he gave 66 rupees. So this is a very simple point, but conceptually if you understand, even if they make it more worse also, you will be able to handle. Okay. Now tell me, sir, the derivative. Derivative, which accounting are we doing? FVTPL. Tell me now, sir. FVTPL ka initial recognition principle, please. 1st January 20x1. You are doing initial recognition of your derivative, which in this case is a forward contract. Like you said, initial recognition should be done at what value? Fair value. Very nice. Fantastic. Go read the question once. Sam agreed to buy each dollar at what rate? 68. What is the fair value of the contract? ₹68 is my purchase price of dollar. What am I asking? I am not asking fair value of dollar. I am asking fair value of the contract. This paper ka fair value. You are doing accounting for dollar or derivative? Derivative. I want fair value of the derivative, not fair value of dollar. Sir, dollar ka contract price is 68. Market lo some spot rate will be there. That is fair value of dollar. I don't want dollar ka accounting. What I want is a paper ka accounting. Contract to buy dollar. Paper is there. Paper ka accounting I want. So I want paper ka fair value. Forward contract ka fair value is how much? People are saying 0. Your answer is right. But why? Because you did not pay anything. Wrong answer. Next. I did not pay anything, sir, but if fair value some amount, I'll book to PRL and I'll record. No. Not because you did not pay. That's the wrong answer. Sir, earlier you remember when we gave guarantee, what did I do? 2 financial liability guarantee. Debit. PRL ke debited and created. No, FVTPL initial recognition should happen at fair value. I did not pay anything, true. But that does not necessarily mean that fair value is 0. Fair value can be something else also. Okay, look at this. Look at this, sir. Sam, in the forward contract, agreed to buy $20,000 at the rate of $1 is equal to 68. Right? Now, tell me this, guys. Forget about this entire derivative example. If I ask you, airports ka fair value is how much? Apple only, sir. 3,000. 10,000. Good. You did not tell me original market price in the market. Why? This is not a new one. 5-6 years old. So if I sell it, I'll hardly get 8,000 rupees. That means fair value of anything is like, if you sell something, how much will you get? That is the fair value. Clear? Now, if I ask you, what is the fair value of Infosys share? What will you do? Immediately open market, see the quoted price. If I have a share, if I sell it, how much will I get? So basically fair value concept is like the concept of exit price. If you want to get rid of something, how much you will get or how much you have to pay. how much you will get or how much you have to pay to get rid of something. Asset you are having, if you have to sell the asset, how much you will receive, that is fair value. Like that only, Sam just now entered into a forward contract. If you ask Sam, cancel the forward contract. Not really, just time pass. If Sam has to cancel the contract, tell me, what should Sam do? Your AFM knowledge. Sam should agree to another opposite forward contract you have to enter. Agree to sell $20,000 at the rate of, again 1 year forward rate. Bank will again quote the same rate. Tell me, sir, in one contract you are buying at 68, in another contract you are selling at 68, gain or loss is 0. So fair value of the contract is 0. That's how fair value is, not because you did not pay anything. You did not pay anything is pure coincidence. Okay, now watch this. If the bank quoted rate like this, your 1 year forward rate is $1 is equal to 66.68. Two-way quote is given. Your forward contract was to buy. So which rate got applied? 68. Now your opposite cancellation contract will not work at 68. This you have to do at 66. Pakka there is a loss of 2 rupees per dollar, 20,000. Total loss is 40,000. The fair value of the forward contract is negative 40,000. Starting entry you have to book it with 40,000. Are you understanding, sir? So fair value means if you get rid of something, how much amount you will get or how much amount you have to pay. That is called as fair value. That should be my initial recognition amount. It doesn't matter whether you pay or not. If somebody did not pay and there is no two-way quote, I will assume that only one-way quote is there. If it is a one-way quote, if I have to get rid of my forward contract, I will neither receive anything nor I will have to pay anything if it is 68 both. So that's the reason fair value is 0. If nothing is given, you assume like that only. All cases. Fair value is nil. Since fair value is nil, accounting entry is not required. Leave it. Next. Come to 31st March 20x1. Tell me, sir, what is the question telling you fair value? Negative. You know what is the meaning of this? If you cancel, I'm not asking you to cancel, that is your wish. If you cancel, you only have to pay an amount of 25,000 rupees to the other party. That means you are having a gain or loss or loss. So create a entry like PRL2 derivative financial liability. 25,000, 25,000. Next, sir. 30th March is over. Next, 30th of June. 30th of June, what is the fair value given? Negative 15,000. What is the meaning of this? If I exit my forward contract, I have to pay to the opposite party an amount of 15,000. But already I recorded liability at 25,000. But actual liability is only 15,000. What should I do? Reduce the liability. So, derivative financial liability account debit to PRL with an amount of 10,000. That means if you write this entry, your liability will be correctly coming out at 15,000. Next, move on. Next day. Next quarter ending, 30th September 20x1. What is the fair value? Positive 12,000. What is the meaning of this? If you cancel the forward contract today on 30th of September, you will only have a receivable of 12,000. The potentially favorable situation. That means you should have a financial asset. But in our books, what is there? Derivative financial liability is there. So what you should do? Kill the liability, create an asset. So you can write two entries also, or in a single entry you can manage also. How much liability is there already? 15,000. Cancel it and create a financial asset to the extent of 12,000. The entire thing, FVTPL, no, happily it will go off into PRL. You just need to understand what is the meaning of fair value in context to derivatives. That's all you have to know. If you exit, how much you will get, how much you will pay. Adi fair value. Let it be share, let it be derivative, let it be anything. Next. Finally, climax. Settlement date. 31st December 20x1. Tell me guys, what is the spot rate? $1 is equal to rupees 66. Our agreed forward rate to buy at the rate of $1 is equal to 68. When market everybody is buying dollar at 66, I am going to buy dollar at 68. So gain or loss? Loss. Therefore, how much loss are you looking at, ma? 68 minus 66, 2 rupees per dollar into $20,000. Overall loss is 40,000. So your liability you should have with an amount of 40,000. But in your books, what is there? In your books now, latest, you will have a derivative financial asset. Actually, you are not gaining, you are losing. What should I do? Kill the asset, create a liability. So tell me entry for that. PRL account debit 2. Kill the asset. Derivative financial asset 12,000. And now recognize a derivative financial liability with an amount of 40,000, no? 40,000. So total debit to PRL is 52,000. Now the next question, sir, how will you settle this now? So you ultimately reach a stage where you have recognized a liability of 40,000. Now you have to settle that and you have to close it. How would you close it? Now, if it is a net cash settlement, it's a betting game, then the answer would be only this. Me and the opposite fellow both entered into a bet. I lost, he won. I have to pay an amount, no? Pay and close it. This is the answer if you are doing a net cash settlement of gain or loss. But if you read the question language, Sam is actually purchasing the US dollar. Meaning what? Sam is taking physical delivery of the underlying asset. It is not a betting contract. Physical delivery they are doing. Now that physical delivery they are doing, physical delivery entry will write. If physical delivery is obtained, tell me, sir, you are buying foreign currency cash. How many dollars did you buy? $20,000. This $20,000 ka worth, each dollar worth is how much? 66. So you'll record this at 13,20,000. Sir, why should we record this at 66, sir? Why not at 68? I am purchasing at 68. No. Listen, guys. Foreign currency cash is also a financial asset. And since it's a financial asset, I have to recognize only at fair value. What is the fair value of each dollar? 66. What you pay is not fair value. What you are paying is contracted price. Fair value is a dollar. If you sell in the market now, how much you will get? Adi fair value. Each dollar ka worth is how much? 66. You are buying how many dollars? $20,000. So you will record this only at 13,20,000. But you promised to pay him how much amount? $20,000. Each dollar purchased at 68 rupees per dollar. Dollar will die. Answer will be 13,60,000. So now you are paying how much extra? This is how you will close and settle your derivative financial liability. That's how it is done. So, first day, no entry. Why no entry? Because at the time fair value was 0, so no entry. First quarter ending, there is a loss. I booked a loss. Second quarter ending, still loss. I fair valued and I remeasured my loss, liability. Third quarter, I made a gain. That means I should have a derivative financial asset. I killed all the liability, created nicely asset, feeling happy. 3 months of shock. Actually, what happened? Dollar rate crazily fallen down. Because of this, I am suffering an overall loss of 40,000. But in my books, derivative financial asset is there. Kill the financial asset, create a liability. Now, a liability, how to settle? When you record your purchase of the underlying asset, there will be a gap left. That means 13,20,000 worth of dollars. You are actually buying at 13,60,000. The extra amount, whatever you are paying to the bank, is your way of settling this derivative financial liability. That's how you close it off. Clear? Now, same to same question, sir, without much change. 31 is this one, this is over. Now, come to 32. Same question, sir. Numbers also almost similar only. Only thing is, instead of forward contract, it is a written put option. Means Sam wrote a put option towards JT Bank Limited. Sir, who is having put option? Who is writer? Who is holder here? Sam is the writer. JT is the holder. Put option holder will have what? Put option holder. JT is having right to buy. So, writer will have obligation to sell. So, Sam is having an obligation to sell dollars. Very sorry. JT is having a right to sell. Sam is having an obligation to buy. Put option. Put option. So, JT is having a right to sell. So, Sam is having a obligation to buy. The difference between this sum and the previous sum is, in the previous sum, Sam directly agreed to buy dollars. This is a forward contract. this is also buying only, but this is not a pakka buying, it's an obligation to buy. That was a means agreement to buy, this is an obligation to buy, but ultimately buying only. Now, rate, dollars amount, everything is same. Here also if you observe, Sam did not receive any amount upon entering into the contract. Actually, writer should receive premium, but here Sam is not receiving any premium. Why? Maybe that option is out of the money. Out of the money options, premium will be, need not be there. Premium can be 0 also. So maybe fair value is 0. So Sam did not receive any premium. Numbers and all are same, sir. First quarter loss is 25,000. Second quarter loss is 15,000. Third quarter no gain, no loss. Ultimately dollar rate is 66. So what is the first day accounting entry? Fair value 0. So you will not write any entry. First quarter ending. First quarter ending, what is the fair value? Negative 25,000. What is the entry you will write? PRL account debit to derivative financial liability with an amount of 25,000. Second quarter ka fair value is negative 15, but you already recorded 25,000 liability, but actual liability ka worth is only 15,000. Reverse to the extent of 10,000 rupees. Third quarter ki your fair value of the contract is 0. Since it is 0, you will simply reverse the remaining derivative financial liability also. And finally, on the maturity date, when dollar rate is 66, you have to pay an amount of 68 per each dollar. So you are paying how much extra? 2 rupees extra. 2 rupees is your loss. Directly debit to PRL or create a derivative liability and close it. Any which way it's fine. So these two questions only till now came on derivative accounting in your exam, sir. Both the questions came. Once for 10, once for 8 marks the question came. Popular question only. But see guys, instead of they giving you the mark to market fair values, they may simply give you forward rates and all. You should be able to know how to cancel your forward contract. A gain or loss you yourself have to work out. That possibility is also there. These two questions came in the exam till now. Yeah. One moment. Let's see if I have any better question. Okay, chalo, let's do this concept then. Last concept, sir. With that, we are done with this. Hedge accounting is there, but never came in the exam, so I will not be discussing that. But embedded derivatives we can talk. Listen, guys, this is a concept. It's a very easy concept because the concept is slightly deep, but little bit of attention you can score it. Okay, let's see. Embedded derivative concept runs like this, sir. You have a contract. That contract is not completely derivative, but in that a derivative element is included. There is a contract. A contractor derivative element is included. Sir, what is that contract? A contract is called as a host contract. A host contract when derivative element got added, overall it is called as an embedded derivative. Now this host contract could be a financial asset or a financial liability, or it's a contract to buy or sell non-financial assets on future. To this a derivative element got added. Overall a contract is called as an embedded derivative. Now, see, go on listening, sir. You will get clarity as we go more and more. But roughly understand the principal points. Now, derivative normally which accounting is applicable? Derivative, normal derivative, FVTPL accounting. Financial asset, ACM possible, FVTPL possible, FVTOCI possible. Financial liability, ACM and FVTPL. Contract to buy or sell non-financial assets, copper purchase contract, scoped out. For this accounting is not there in the standard. Correct? No, sir. There are some non-financial asset contracts which are closed by way of physical delivery. They are scoped out. That means what? Observe closely. There is a host. To that, one ghost also got added. Ghost accounting we already know, FVTPL. Host accounting also we know. But the problem is they are not separate. They are together. Now take the responsible job of a divorce lawyer and separate them. Once you separate them, this one will be accounted using FVTPL. For this, whatever accounting normally has to happen, that will happen. So your job is to separate two things. You have to separate the derivative from the host contract. Once you separate it, to that derivative you will go and apply FVTPL accounting. For the remainder, whatever accounting is applicable, that you will apply. Overall, our job is only that much.
Now, I have written some examples and all. Every example is not relevant for you right now. Just 2-3 examples you watch. Come to the first one. Investment, sir, based on our discussion earlier, bond ka value depends on what? Present value of future cash flows discounted RR. RR is based on what? Market interest rate and risk of the borrower. If market interest rate changes, bond value will change or not? Yes. If risk of the borrower increases or decreases, then also bond value will change. If equity share price increases or decreases, bond value will change? No. But if you take the story of a convertible bond if you take, convertible bond, what will happen? First 5 years you will receive interest. 5th year ending you will receive shares. Now, e bond ka price will depend not only on interest rate, not only on risk of the borrower, but also on the value of your equity shares. Because equity share value is increasing crazily, bond price also will crazily increase without any limit. Why? A bond, name a bond, inside heartly equity share is there. If equity share price is rising, bond ka value also is rising. Isn't it unnatural for a normal bond? Bond ka price should fluctuate only because of interest rate or risk. But company ka performance also is impacting your liability price, which is bond price. Isn't it, sir? So there is an unnatural element that is there. Presence of, equity influence on bond price is a derivative element in this. So investment in a convertible bond, the fluctuation in the market price of the share will also have an impact on the price of the bond. This creates a derivative element in the financial asset. Suppose you purchase a convertible bond and holding it. In that you are taking one big risk. What is the risk? Towards the end, how much you will receive depends on value of equity share. The value of this contract depends on the value of underlying equity share. Is it not the definition of derivative? So convertible bond by default, in that there is a derivative element included. First example. Another example, look at example number 3. A Limited made an agreement to sell goods to B Limited. Wait there. A Limited is an Indian company, brackets. B Limited is a US company. After 6 months for $1 lakh, that means A agreed to sell goods to B for $1 lakh after 6 months. If you stop here, what did they agree to sell? Goods. Goods is financial asset. No. Is it a contract to buy or sell non-financial assets on a future date? It's a contract to buy or sell non-financial assets on a future date. This kind of contracts are scoped out. This type of contracts are scoped out. But if you observe closely, a contract ka price is in which currency? From an Indian company point of view, is A Limited also exposed to currency risk? No. There are 2 risks for him. One risk is what? Price of the goods can change. What is the other risk? Even though price of the goods may not change, dollar rate can change. Are you getting it, sir? If price of the goods change, then gain or loss is possible. Price constant in the market, gain or loss is not there in terms of price, but dollar dancing, that also creates a gain or loss situation. So the presence of foreign currency invoicing creates a derivative element to A Limited. This is third example. Come to fourth example. This is subject matter, sir. It looks illogical, but that's important. Read. A Limited, Indian company, made an agreement to sell goods to B Limited, brackets, another Indian company, after 6 months for $1 lakh. Sir, I am A Limited. You are B Limited. We both stay in adjacent houses. I told I will sell machinery to you after 6 months. I am Indian company. You are also Indian company. We both should enter contract in which currency? Rupee currency, INR. But we both entered into contract in dollar currency. Is it looking natural or unnatural? Unnatural. Why? 2 Indian companies, what is the need for them to enter into a dollar contract? That means what? These people are speculating here. What speculating? I told dollar rate will increase. She said that much scene is not there, dollar rate will fall. Bet. So a betting contract we have to enter, no? At the same time, for our business purposes, we are buying and selling machinery also. Why to keep 2 contracts? In a single contract, we captured both. One, sale of machinery contract. One, dollar ka betting contract. Both are mixed. Sir, even though I rate contract like that, tell me, if I sell machinery to her tomorrow after 6 months, will she give me $, sir? How can she give $, sir? She does not have $, no, she will have what? Rupees.
How much rupees she will pay? A $1 lakh into spot rate equivalent she will pay. She can't anyway give me dollar. Then what is the point of keeping dollar as the price there? Pure dollar ka betting. I believed dollar rate will rise. She said dollar rate will fall. Chalo bet. Bet is included in my sale purchase contract. Now, if you observe, example number 3, example number 4. In both the cases, A Limited agreed to sell goods to the opposite party at $1 lakh. But case 3, case 4, what is the difference is? Case 3 is a genuine case. The opposite party belongs to another country. I don't have a choice. At least one party will be exposed to currency risk. Case 4 is a classic speculation case. There is no need for us to keep a dollar invoicing, but we kept. Okay? Case 5, ignore it. Then the main principle here, the derivative element included in the host contract must be separated and should be accounted using FVTPL method. The host contract will be accounted in accordance with other provisions of the standard. Now, 5th point. In the following cases, sir, this examination point of view directly not relevant, sir, but still it's an important point only, so I'm just discussing. In the following cases, separation of derivative from the host contract is not required. What is the original rule? You have to split them, you have to separate them. But the standard says, in these scenarios, don't separate. First case, the host contract is a FA or FL and is accounted under FVTPL. Why? What is the meaning of that? A host contract getting accounted at FVTPL. What is your objective of splitting it? After splitting, on the derivative anyway you have to apply FVTPL. Even if it is combined also, it is getting accounted at FVTPL. There is no point of splitting it. Sir, example. First one. First example. What is the first example? Investment in a convertible bond. Tell me guys, investment in convertible bond, will it satisfy your D point, SPPI test? Contractual cash flow test. Will it pass or fail? Fail. Why fail? Principal amount you won't get. You will get shares. A shares ka value need not be equal to your initial investment made. As a result, your SPPI test is gone for dogs. D point failed. The moment you fail D point, automatically will fall under FVTPL category. In the derivative is there, but you need not split that. Why? The whole instrument is getting accounted at FVTPL. Are the embedded derivative, but splitting is not required. Clear, sir? This is one reason. Reason number 2. The inclusion of derivative element is very natural and acceptable. That is, the host contract and the derivative element are closely related. Somebody is closely related, don't go and split them. That's the meaning of that, sir. That means a transaction will not happen if that derivative element is not there. It is that closely related, don't separate them. Example number 3. A Limited Indian company has made an agreement to sell goods to B Limited US company after 6 months for $1 lakh. Definitely A is exposed to currency risk. That's a derivative element only. But tell me, sir, is it possible to eliminate that? You will say, what is there, sir? Put it in rupees. Fine. In that case, who is exposed to risk? B Limited is exposed to risk. In a transaction with a foreign party, at least one party has to be exposed to currency risk. Otherwise, the transaction will not proceed. My goal is not to enjoy that gain or loss, but that is natural. I can't help it. In these cases, you need not split. But if you look at example number 4, tell me, is it looking naturally acceptable? That is purely a fake case. There you have to go and separate it. Next, C point. The gain or loss from the derivative element is not substantial. Meaning, with lot of difficulty you split. Ultimately, a gain or loss is chiller. You are a 1,000 crore company. A derivative of fair value gain or loss on every balance sheet, it is coming as 15 rupees, 25.5 like that. For the chiller, don't take the effort of splitting it. Ignore it. Immaterial. Final last one is impracticability. That means you will separate it, but you don't know how to work out the fair value of the derivative. If derivative ka fair valuation is very complicated, what's the point of splitting it? Don't split it. Ignore it. That's all is the story, sir. So ultimately, sir, exceptions, there is a purpose why we discussed that, but as such, in every question that comes in the exam, you have to split it. If you go and say you should not split it, why will they give you 8 marks for that? You have to ultimately split it only, sir. So E points actually for finishing of the concept I discussed. But in the question, you definitely have to split it. That will be your ultimate question. Okay. Now, question number 34 you take up. Sir, before you read this question, I have only one small query on derivative. Please explain me that, then we'll go to that question. Sir, there is a forward contract. This has got nothing to do with some momentarily, just answer this, it's important. A agreed to buy 1 TCS share from B at 3 months at the rate of 3000 rupees. Sir, two parties entered into a derivative contract. It's a forward contract. One fellow agreed to buy, another fellow agreed to sell. You call it as forward, future, they are all same here. Now, if this fellow is Mr. A, he agreed to buy after 3 months at the rate of rupees 3000. I want you to tell me what is his anticipation about share price. That means what does he believe? At 3 months time, market price will be higher than 3000 or lower than 3000. Sir, if you really believe that after 3 months share price will be 2000 rupees, will you go and enter into this contract to buy the share at 3000 rupees? No. So basically what is running in your mind, you feel that market price will increase. It will go beyond 3000. That is what your feeling is. Similarly, Mr. B, tell me sir, he agreed to sell the share at 3000. What is running in his mind? He believes that share price will cross 3000. In that case, he will enter into a sell position like this? No. That means what is running in his mind is at 3 months time, market price will fall and it will be less than 3000. If both the parties have got the same expectation, they are not stupid to enter into a contract with the opposite positions. Sir, who will win, who will lose, time only will tell. But parties have opposite expectations, then only they enter into this kind of contracts. Okay, sir? Both will win ultimately? No, only one fellow will win. Now, sir, this guy who agreed to take a buy position, that is also called as a long position. People take long position when they are having bullish view, when they believe that prices are going to increase. And people take sell positions or short positions when prices are expected to fall down. This goes with a general rule like in a rising market you should take a long position, in a falling market you should take a short position. This is the basic derivative strategy. Okay, so just a background if you have, this question we will use it to some extent. That's it, sir. Chalo, let's read the question. Entity A, an INR functional currency entity, the Indian company, sir, overaction, enters into US dollar 10 lakhs sale contract on 1st January 20x1 with entity B, brackets, also an Indian company, to sell equipment on 30th June 20x1. Moral of the story, on 1st January, A agreed to sell machinery to B after 6 months at a price of US dollar 10 lakhs. Both the companies are Indian companies. Contract is entered in which currency? Dollar currency. Very clearly that is not closely related. Now what data did they give? Spot rate today, rupee dollar they gave. On 31st March, in between balance sheet date is there, spot rate given. 3-month forward rate quoted on 31st March is also given. 6 months forward rate quoted as on today given. Spot rate after 6 months is also given. Some exchange rates are given, ignore it. Let's assume that the contract has an embedded derivative that is not closely related and requires separation. So he is asking you to separate it off. Please provide detailed journal entries in the books of entity A for accounting of such embedded derivative until the sale is actually made. So here you can very clearly see in the contract dollar element is a fake arrangement. People need not settle in dollars when we both are Indian companies. If dollar is there in our contract, that means these people are trying to do a speculative derivative contract in this. That means what happened in a contract to buy or sell non-financial asset called as equipment, a derivative contract is forcibly introduced into this. He is asking you to separate it. Clear? Now in whose books is he asking? Entity A ka books they are asking. So let's see. Sir, entity A agreed to buy or sell equipment to entity B at the rate of dollar, how many lakhs? 10 lakhs at 6 months time. And point both are Indian companies. Correct? Now, sir, if this fellow is entity A, tell me guys, entity A will in future receive dollar or pay dollar? Receive dollar. A dollar when he converts into rupees by at spot rate after 6 months, he will get his rupees according to the contract. Okay. Now, what is entity A's expectation about dollar? At 6 months, dollar price will increase or decrease? Sure. Pakka. What is spot rate given in the question? Today's spot rate. So today's spot rate is $1 is equal to rupees 45. If you are only A limited, if you believe that after 6 months dollar rate will become 40, will you go and enter into this kind of contract? Are you obligated to enter into this kind of contract first? Why? That fellow is your neighbor, sir. Why will we enter into dollar contract? If I am entering into dollar contract wantedly, that means I am anticipating some gain. When will gain come? When dollar rate increases, then only gain will come. That means entity A believes that dollar is going to rise. This anticipation, what is running in his mind, that is important for us. The entire question. Clear? Now, they did not ask, so I am not doing. What is entity B's thought process? Entity B, according to the contract, he will have a FC payable, dollar payable he has. Why will somebody willing to go volunteer for dollar payable? Because he believes that dollar is likely to fall. That's why B came forward for this. Okay guys? Now, your job is take this contract, whatever you have written, and split this contract into two parts. First part, you will identify the derivative element. Once you identify the derivative element here, sir, entire crux is there only in this chart. Once you cross this, nothing else is there. The remainder host contract. Now you tell me, sir, forget about this contract now. Independently, you believe that dollar rate is going to increase. You believe that dollar rate is going to increase. Forget about this example completely. You believe that dollar rate is going to increase. You want to do a betting transaction. You will take long position or short position. Sir, you know dollar rate is going to increase. You will take which position? Long position. Long position ka meaning is what? I know that in future price will increase. So I will today only enter into a contract to buy it at some predetermined locked price. Correct? If I believe dollar rate is going to fall, I will take a short position. In our example, Mr. A, entity A, believes that dollar is going to rise. If he has to do an independent betting transaction by entering into a derivative contract, he would take a buy position, long position. So what you will do now is, you will write like this. Entity A enters into a 6-month forward contract to buy dollar 10 lakhs at the rate of, go check the question, what is $1 ka rate in 6 months forward contract? Last but one point you see, 6 months forward rate quoted on 1st Jan 20X1. How much did they give you? 55 rupees. In reality, this fellow never went to bank also. He never entered into any forward contract. Why does he need to go to bank, sir? Already B is adjacent neighbor. He is entering into betting contract. No. Why will he go to bank? I never went to the bank. Accountant fellow will go. Arey, our boss has done something. We have to do accounting for this. For splitting it, a dummy contract. Had they entered it separately, this is how they would have entered. This is not real, notional. Okay, this is the first part. Now, from the main contract, the legal contract, in substance, I separated the derivative element here. Remainder element you write here. Remainder element will look like entity A agreed to sell equipment to entity B at 6 months for how much amount? If you go and write $10 lakh here, then the derivative element is still included in this. I don't want the derivative element. So what you do is, for accounting purposes, a dollar pricing, whatever is there, convert that into rupee pricing. Sir, how? How simple? Sir, $10 lakh, when will you get? After 6 months. After 6 months, forward rate is available with you. On left side only you wrote, no? Convert that. So $10 lakh into rupees 55 per dollar. Rupees 550 lakhs. Now tell me guys, left hand side the derivative element is there. Right hand side of the chart, is any derivative element now? No derivative element. Why there is no derivative element? Your derivative element was because of dollar. A dollar I converted into rupees. Now a dollar currency element I have eliminated it. Now, in left side number whatever you split, E portion, on this you will go and do FVTPL accounting. This one is scoped out. Dollar element gone, but it is scoped out. Why scoped out? This is a contract to deliver machinery after 6 months. Machinery is a non-financial asset. Non-financial asset contracts which are going to be settled by way of physical delivery are scoped out of this standard. That's why no accounting will happen for this. Are you getting it, sir? So, original question is this. See, I am telling you steps of thinking. First read the question, then understand who are you, entity A, entity B. You are entity A. You volunteered to receive dollar. That means what is running in your mind? Dollar will rise. A feeling you catch. After catching the feeling, if I have only this feeling that dollar will rise, what action will I do in derivative market independently? What action will I do? In a rising market, I would have taken a long position. Question they gave forward contract, I assumed an artificial forward contract. Had they given me futures contract, I would have taken futures contract. Had they given me call option, I would have taken a holder position in a call option. Whatever data they will give, I will take position accordingly. Question of forward is there, I took forward. Clear? Now let's start with the accounting. What is the date of contract? 1st Jan 20 X1. Tell me, sir, for entering into a 6-month forward contract with a long position, answer. Sir, you have to apply FVTPL accounting. What is the initial entry? Fair value. What is the fair value of this forward contract on day 1? 0. How 0? Sir, you took a long position, sir. I ask you to get out of this. What will you do? You will take a short position. A short position also will be taken at 55. So gain or loss is 0. Fair value is 0. Since fair value is 0, you will not write any journal entry. Fair value of forward contract is 0. Therefore, you will not record any journal entry. First day accounting over for you. No accounting is the entry. Come to balance sheet date. 31st March 20x1 on the balance sheet date. This is fair valuation, because FVTPL, on the balance sheet date you have to fair value. Fair valuation of forward contract. Tell me, ma, in the context of derivative, what is the meaning of fair value? Fair value everywhere same. If you exit out of something, how much you will get or how much you got to pay. Tell me, sir, if forward contract original position is what? Original position agreed to buy. Agreed to buy how many dollars? $10 lakh at the rate of $1 is equal to rupees 55. Now do a notional cancellation. How to cancel this? You will enter into another forward contract today where you will agree to sell $10 lakh. At what rate? 6 months contract, sir. 3 months already over. Now you want to cancel. What you have to do? Take opposite position in the remaining period forward contract. Remaining period is how much? 3 months. So in the question they will definitely give you on 31st March 3 months forward rate they will give you. Pick up that. On 31st March 3 month forward rate is this one, which is given as how much? 45. If 45 rupees, so go and enter into an opposite contract. Watch there carefully. Buying at 55, selling at 45. How much is your gain or loss? Sell rate minus buy rate. 45 sell rate, 55 is the buy rate. Loss is 10 rupees per dollar into 10 lakh dollars. Overall loss is 100 lakhs. What is the meaning of this is, if you enter into a derivative contract separately and our contract, if you exit on this balance sheet date, you only have to pay to the opposite party an amount of 100 lakh rupees. So your entry will be PRL account debit to derivative financial liability, an amount of 100 lakhs, 100 lakhs. Okay, now just reminder, did we really went to the bank and enter into a forward contract? No. This is a notional. Do you agree? This is notional. You created a notional forward contract. You started accounting for that. What is this? Fair valuation. Fair valuation of what you have to do? Notionally cancel your notional contract. Are you understanding, sir? Forward contract is dream. A dream low dream. A forward contract does not exist. And now a forward contract you are cancelling it notionally. Okay, move on. Now coming to your final settlement date. On 30th June. What is the spot rate? Spot rate. Last 60. Good. $1 is going to 60. We agreed to buy a seller buy at the rate of $1 is equal to rupees 55. What's the meaning of this? When market dollar rate is 60, under the contract we have a right to buy only at 55. Gain or loss? Gain. Overall, this is a gain situation. Therefore, gain is equal to rupees 60 minus 55. 5 rupees per dollar into 10 lakh dollars. Overall gain is 50 lakh rupees. But last balance sheet date, we recorded a derivative financial liability. Actually, I don't have a loss and a liability. I have a gain and an asset. What should I do now? Cancel the liability first. Derivative financial liability account debit to PRL. Is the reverse of the original liability. Now freshly record a derivative financial asset and book a gain to your PRL. 50-50. Clear? Now, sir, this is now gone. This is the only account you have. Sir, how will you enjoy this? How will you enjoy this 50 lakhs? You told no, you have a asset worth 50 lakhs. A 50 lakhs ka benefit, how will it come? Now, if it is a real forward contract, I will either do physical delivery or I will do a net cash settlement. But if forward contract reality does not exist, it is a notional forward contract. Now 50 lakhs how will come to you is, now that you are standing at 6 months time, e contract all these days you did not account. Why? Because it is scoped out. Now at 6 months time you actually are supposed to sell the equipment. You write that sale entry, 50 lakhs automatically will come to you. Let's see. Sale of equipment. Tell me, sir, you sold equipment to B Limited. So debtors account debit to equipment. If it is your PPE, then it's equipment. If it is your inventory, then you can call it as sales. We agreed to sell it for how much amount? Legal contractor $10 lakh. Accounting point of view, we splitted that into 550 lakhs. Come here, sir. This I'll record at 550 lakhs. But actually, this debtor owes me how much? According to the legal contract. Legal contract, original legal. Legally, he has to pay me how much? $10 lakh. $10 lakh ka worth today is how much? Sir, you agree? No, sir. Debtor is who? He is a financial asset. $10 lakh into rupees 60 per dollar. So my debtor should give me how much money today? 600 lakhs. But sale value is how much? 550 lakhs. Debtor will pay you how much extra? 50 lakhs more. 50 lakhs more is how you enjoy your derivative financials. Debtors, if you're directly paying you cash, take cash. That's how you close it off. Are you getting it, sir? So here, the entire thing, sir, what is difficult or what is where you should be careful, little careful is, that's what, sir. A original position, long position you have to take and you have to get an idea naturally. There's nothing wrong. Peacefully try one or two options, you'll get it. So you'll have two positions, no, sir, either long or short. Okay, so when will you make a gain? That you think like that. A is receiving dollars in future. He will make a gain only when dollar appreciates. So he believes that dollar will appreciate. Now, cut this scene. If this fellow believes that dollar will appreciate, going to a bank, which position will he take? He will take long position based on that. Where many people make mistake in this is they think like this. A Limited, in future A Limited is going to receive dollar. That dollar he will give it to the bank, and from the bank he will receive rupees. In future he is going to sell dollars. So to protect this transaction, he will enter into a forward contract to sell dollar. Who asked you to hedge? The forward contract hedging. This fellow is hedger, sir. This fellow, he wants kick in life. He is not a safe player and all. And moreover, who is giving you dollar currency? The real dollar, a dummy dollar. Sir, people go and fall in the trap of Forex chapter, sir. It is not that. This is not hedging a forward contract. It is speculative forward contract. You read that story to understand what he feels. For that feeling, what is appropriate speculative position, give that. And accordingly play. In left hand side, FVTPL accounting, right hand side is scoped out. In left hand side, whatever you wrote, the only for accounting purposes, reality, that contract does not exist. So you are doing accounting for something which does not exist. Sir, isn't it too far-fetched? Yesterday, what did I tell you? Ind AS strictly applies substance over form. How difficult it is, it doesn't matter. Is this fellow having speculative intent? Yes. Suppose, sir, a contract ka maturity is 1 year. In between 5 times I prepare balance sheet. Every balance sheet ki fair valuation keeps on happening. Your fair value intention, you are either happy or sad, no? A happy or sad feeling, tell it to your reader of financial statements also. That's the entire objective of doing this. Now, I'll change one small point. You will tell the answer, one line, then you can take a break. What if in this sum, entity B is not an Indian company, is proper US company? Then there is no need to separate it. Then what accounting will you do? There is no need to separate it at all. See, that means I will tell you this entity B is a US company, and therefore your contract price is in which currency? $10 lakh. Is it closely related? It's closely. Since it is closely related, I need not separate them. Let it go. So I will not do split accounting. Since split accounting is not there, derivative accounting will not happen. That means this will not be there. This also will not be there. Since these two are not there, this also will not be there. That means the next 6 months accounting will not happen. Sir, then when will you account? Directly at 6 months time. Now, just for understanding, sir, if B Limited is a USA company, then directly only single entry will record. 30th June, debtor or bank, whatever it is, to equipment or sales. With what amount? $10 lakh. What is the spot rate? 60. That's all. 600 lakhs. So directly will record the entry at once. Next 6 months I will not do any kind of split accounting and all. Why? I am not interested in dollar fluctuation there. Dollar is kept as invoice amount because that fellow is a foreign fellow. I did not have a choice. Do you understand, sir? Ultimately, you observe. Your money what you receive is 600 lakhs. Whether it is this accounting or this accounting. Ultimately, what went to P&L account is also 600 lakhs. Watch here. The revenue, where will it go? P&L account. If 50 lakhs, where did it go? Ultimately, P&L, how much did it credited? 600 lakhs. You do this model. Here also P&L, how much will be credited? 600 lakhs. Then where is the difference? Difference is, in the next 6 months, in between one balance sheet I prepared. In that balance sheet, no impact will be there in this scenario. Whereas here, my feeling is speculation. I am happy secretly inside on the balance sheet date. A happiness you have to reflect in your financial statements. On the balance sheet date, not here. Happiness or sadness? Here sad, loss. In loss, you have to reflect in your financial statements. So, our intermediate financial picture, we have to follow all this. Climax effect is same only. Ultimately, what you will receive will not change. What hits your P&L account will not change. But intermediate financial statements can impact presentations, communications will change off. So that's the whole story. Now, Suppose the same question is asked in the books of B Limited, what will you do? Explain. Same question they ask from B Limited's point of view. How you should think is, B Limited is somebody who agreed, volunteered to pay in dollars. Who will pay in dollars? Wantedly. Who believes that dollar will fall down? If somebody has a feeling that dollar will fall down, he will take which position? Short position. So you will write a contract like entity B enters into a 6 months forward contract to sell $10 lakhs at the rate of $1 is equal to 55. Since he took an opposite position, 31st March this fellow got a loss, that fellow will get a gain. Finally this fellow got a gun, that fellow will get a loss. Accordingly, he will record a sale transaction, that fellow will record a purchase transaction. So all reverse. This question came only once, sir. May 2024 exam it came. You know what they did? They gave some names. Entity A, B, no, some normal names they gave. Entire question is from entity A's point of view. Last record entries in B books. So when you read the question, already it's like little heavy question, no? People already prepared well. That fellow is also talking from entity A's point of view. You are also thinking from entity A's point of view. Last journal entry, what tough diagram they have drawn. Everything they did from entity A's point of view, wrote entries also. Question was from B's point of view. Last one line they wrote. So it's a test for your concept and focus also. Anyway, guys. So guys, this will be the end of your instrument, sir. Actually, there is hedge accounting also, but hedge accounting never came in the exam. There were questions in study material which they removed it also. So apparently not very important. But if you are interested in that concept book and this question bank also, questions are the small ones, you can try out on your own. Okay guys, see you after the break.